All right, traders, good day. Happy Monday to you. Welcome back to another week of trading, or at least another week of venturing around the markets. Hope all of you guys had a great weekend. That's good news to hear, Charles, about working with them to get this issue fixed. It's quite annoying. I don't know how many times I've posted a video and then, it takes a while to upload anyway. You post a video and then it doesn't work. And you're like, man, I got to upload it again. And just an annoyance. So hopefully they're working that out. Apparently it's been giving you more of a bother than me. I get it every once in a while, but it always stinks. Good to hear they're fixing it. But welcome guys to another Monday morning Q&A session. As always, I am here to answer okay. More stuff I have to learn. But welcome to another Monday Q&A session. As always, we're here to just hang out, answer some questions, and hopefully resolve any issues that you're having in your trading journey. So if you guys have anything that you would like to bring to the table to start off, go ahead and type it in and we can get going on the discussion. Nasty markets out there. Not a lot at all. Perfect time to just get away, do some education. These things are it's just bad out there. Gaps again, consolidation. Everyone on edge about the Greece news. So see what happens. Just want to be again, just like last week and the week before, just another week of being cautious. Just being cautious out there in the market. Make sure you're taking smart positions. Make sure your stop losses are indeed in place. You're not doing anything blind. You're not, doing anything crazy. And we try to navigate around the markets as best as we can. As best as we could. So what do you guys got for me? Nothing? I'm sure everything's not 100% crystal clear. If it is, that's great. It means we're doing a good job, but what do you guys got? I know some of you are towards the very end of your journey. Some of you are towards the very beginning. For you guys that are towards the beginning, you should be having some questions. Again, unless it's crystal clear, but this is the time to shoot it at me. So don't be shy. Sure. Yeah, we can talk about position sizing. The issue in my mind is how to work two different accounts for positions that are long and short, the long and short of it. All right, so you mean that when you say two different accounts for positions that are long and short, the long and short of it. Well, if you're dealing with two different accounts, if you're dealing with two different accounts for hedging, well, if you're dealing with two different accounts, you're essentially just placing two different trades. So let's say you were dealing with account A for the New Zealand dollar and you wanted to get short. What you would do is you would enter your account. You would enter your account A. You enter your short position. You then go over to your account B, and if you wanted to enter a long position, I guess, you would just do that on the separate account. So you would consider each account to be completely separate and just, you would still enter the trades the same way, but just on each account. That may not be, that may not be the question you're trying to ask, but if not, just type it in again. But that's what I'm getting for it. You said, how do I work two different accounts for positions that are long and short? Essentially, you take account A and you enter your long position on that. You take account B and you enter your short position on account B. You look at them as two completely different, accounts, which they are. Is that what you were getting at, or was there something more? we looking at a strategy for hedging or something, or? That was it in principle? Okay. Yeah, you would just treat each account separately then. Account A, treat that as your again, your long position. Do whatever you need to do the normal way on that. Account B, you treat that as your short position, and you just, when one stopped out, you cancel limits, cancel the orders, and other one stopped out. Hopefully you get some profit on it. Jason said, I watched $1 Million Traders at the weekend. Good TV. Yeah, those things are fun. Those things are fun. Makes you realize that you are indeed better than a lot of traders out there. Sometimes it may not seem that way. They have no training or trade plan or anything. Yeah, well, I mean, yeah, you also got to realize they're in a slightly different situation. They're kind of thrown into the fire right away, but it just shows you the emotional tugs that are in it. $1 Million Traders is good. I like Wall Street Warriors. It's not all about. It's not as in-depth trading wise. I like Wall Street Warriors. There's another one too. I forgot the name of it. It was like a 3-part series. I just watched it on YouTube actually, or I didn't just watch it. Someone just told me about it, and I was like, hey, I watched this already. Let me see if it's in my browser history. Abby Wambach, Warren Buffett, lots of Akil Stokes. 5 types of lighting. I just bought some new lights for the studio. Pranks gone bad. Trading emotion psychology. Where is it? 50 Cent. Entrepreneur, trading psychology. The risk of starting a Bitcoin business. When did I watch that? Try looking up Forex Traders Lifestyle. That may be it. I'm not 100% sure. Try Forex Traders Lifestyle. That may be it. I don't really know, actually. That may not be it. I don't think it is, actually. Nah, forget that. That's something else. Anyway, there was one that I found. Someone told me about it a couple of years ago, and I watched it. It wasn't. Nah, it was all right, but nothing special. But all right, let's get back to the question. So yeah, but they're just kind of thrown into the fire. No trade plan. They're just going off of feel. But it also is a little different. They're doing a lot of fundamental trading too. They're not sticking straight to the technical. So they're reading a lot of news and guessing events and different approach, I guess you would say. Different approach. A trading plan is more for the technical traders because we're looking at the charts and we're not kind of going off of feels and hunches and stuff like that. Gretchen says, regarding double tops, are there any additional filters other than RSI and structure to determine we should enter next bar market at the second top? No. No, the only filters, maybe if you can find some, the only filters that I would know for if you want to add them for trading a double top, obviously you got you want to have it in general. For double top, you want to trade a double top at a level you think the market's going to reverse at, just in general. So you're not, if you have a random double top in the middle of nowhere, it's not necessarily a double top you want to trade. So you always want to make sure it's one at a reversal area. If you want to add another filter too, you can say market is overbought or oversold. You can do divergence on the retest. And then of course the distance of retracement, meaning does it come down to hit the 3D2 or whatnot. These are the only filters I can think of. You can, I mean, if you want, you can add stuff. Maybe you need to see a pin bar, you need to see a wick go a certain level up. You may be getting a little picky there, but those are some things you can think of. But aside from that, this is what I see. A, is the double bottom or double top at a reversal area? Is the RSI overbought or oversold? Do you have RSI divergence on the retest? And then the distance of a retracement. Do we come down to hit a 3D2 or do we come down to hit, previous structure, something like that? Traders, millions bought a minute. Maybe that's it, Jason. I'm bouncing all around these questions. Traders, million by a minute. Let me see if this is it. That may be it. November 1, 2014. I'll get to your questions in a little bit. Just want to see if this is it. That may be it. That's there was another one as well, but that may be it. I just honestly don't remember. But yeah, this is, I mean, these are all the filters I would have for double tops. Again, you can maybe add one, say, hey, I need a pin bar or on the retest, the bar has to look a certain way. So the wick has to, it can't close above the first half of the wick. Again, you're getting really picky when you do stuff like that, but a candlestick formation is maybe the only other filter that I can think of putting in there. Fib confluence, is it valid in a 10 pip range? Are you talking about on the 10 pip range bar chart, Gabriel? Like on a range bar chart, are fibs still valued, I guess? What do you mean by in a 10 pip range? You mean if the fibs are 10 pips away from each other? Like if I have a 3D2, okay, 3D2 there, and then say I had a 127 from somewhere that was here. It's going to depend a lot on the time frame you're trading on. You see here on a 60-minute time frame, no, this really wouldn't count as fib confluence. However, you go to a daily chart, 10 pips, or a monthly chart, weekly chart, 10 pips is going to look like this. So a lot of it's going to depend on the time frame you're trading on. I would say this, in general, you're looking for zones in the market anyway. So you're not too concerned with the fibs. You're not too concerned in the same area. When you're looking for confluence, or when you're looking for just potential reversal reasons, you're looking for zones. So you may have a 127 here. You may have a 1618 there. And what you're saying is well, this is going to be my reversal zone right here between 6688 and 6692. Now, the closer they are together, the better that is. That gives you more confluence at that level. You can kind of shrink your zone down and say, well, this is it right here instead of something like this. But in general, we're looking for zones, and a lot of the time that's gonna also be based on structure. So you'll have fib confluence over there, and you'll say, oh wow, look at that structure looking left as well. But the question of 10 pips apart, having a set pip number apart, is going to depend on the pair. It's going to depend on the time frame. Again, we go out to a 60-minute chart on New Zealand. A 10 pip difference looks like this: 6680 to 6670, where it's a substantial amount of room. We go out to a daily chart on New Zealand dollar. A 10 pip zone now looks like this: 6680 or 68 flash to say. The 10 pip zone looks like that. So a lot of it's going to depend on the pair you're trading, because again, different pairs of different ATRs are going to look different as well. A 10 pip zone on a pound Aussie, for example, with a ginormous ATR is going to be different than a 10 pip ATR or 10 pip zone on a dollar CAD. But it really depends on the time frame you're trading. But in general, you want to look for zones. The closer they are together, the better, because you can shrink that zone down. But in general, look for zones. I don't know, me personally, I look for those zones, and then I always look left to see how those zones react with structure. Okay. When I'm counting technical scores on 60-minute trading time frame, I have D1 fib retracement and 4-hour inversion exit confluence between 56.01 and 56.11. What pair? Again, it's going to depend a lot on the pair. I'm telling you, a 10 pip zone on pound yen is a lot different than a 10 pip zone on dollar Canada. What pair are you looking at though? Or is that just that's just an example? Okay, it's gonna depend on the pair. Again, we can go down on pound yen or pound Aussie, something like that, and a 10 pip zone on pound Aussie looks like this. You see, I would consider that fib confluence if you have two things lining up right there. If you happen to have a 618 right there, and you happen to have a 127 right there, I would consider that Fibonacci confluence. You see how the zone is really, really small. However, we go to a pair, again, dollar Canada, the 10 pip zone is going to look like this, much bigger. So there's no, I don't have there's no set amount. There's no, you can't really say, hey, it's got to be within 10 pips. It's got to be within 5 pips. It's one of those things where your eyeballs are just going to have to see it. Are they in the same area? And you're going to have to make your best judgment on that, because it's just going to be different depending on what you're trading. And again, this was use my brain. Yeah, I wish I can give you an answer. Now you can set a rule for yourself if you want. If it's easier, if you operate better that way, where you need that, you want to eliminate as much subjectivity as you can, and you need a set rule, you can set a rule for yourself. You can say if it's more than 10 pips, than this, or you can make it ATR based. That way it's more dynamic per pair. You can say, well, if it's more than a single ATR away from each other, then it does not count as confluence. That's a good way to make it dynamic per pair, and then put in a set rule, and then it takes away that subjectivity. Now it's like there's no, is it close enough? Well, if it's within one ATR of each other, then yes. If it's more than one ATR away, then no. So you can do that. That's a way to make it more of a set rule, if that's going to work better for you. Ah, look at that. Gretchen just said the same thing. Maybe using long-term average of ATR. Yeah, that'll be one. That'd be a solution. But it is subjective. It's one of those things where you just gotta, and you hate saying stuff like this, but a lot of trading is like this. Now, a lot, we try to make as much as we can rule based here, but most of trading is, you just got to see it. You hate to say it. You just got to know it when you see it. You look at the trades Jason took this morning, with the gap fill trades. He just knew it when he saw it. Probably wouldn't have got a big CTS score out of those trades at all. But yeah, I think taking the ATR idea is a great way to start with a rule. And what you'll notice you guys start doing is you start with very strict rules, and then you slowly, as you get more experience, you slowly get away from them. They start to loosen up a little bit, and it's more of a feel, more of an art than a science. Good question though. Good question. Jason, you said you had a question about position sizing that you never shot in. You still have that question? Yeah, shoot it in. While Jason's typing, any of you guys have anything else? Um, I can give you. I don't know if I can give you any live examples. The markets aren't doing much, but give me what what type of trade you want to take a look at, Gretchen? Yeah, we can do a top down analysis. Is there a specific type of trade you're looking for, or is it, or you just want to see charts? Any counter trend and then trend continuation. All right. We'll have to go in the past. There's not much happening on these charts now. Well, we can do top-down analysis. Here's something I would do for top-down analysis. So let's take top-down analysis. Essentially, what you're doing is we're going through the IPDE process. So the first thing I want to do is identify. So I look on this chart and I'm going to ask myself, well, where is the market at relative to structure? Are we above? Are we below? And in this case, that we've broken all structure lines to the downside. So when I do my identification, I can say, I'm not going to type it here because I'll lose the chart. We are below structure. So my anticipation that because we are below structure, we should see a bearish continuation. If we're going to see a bearish continuation, the next question is, making that prediction, where are we likely to go? And then we just bring out, in this case, I'm actually going to need to go to a higher time frame because I don't have enough data loaded up on my my Aussie chart here. But again, the first thing is always identify what is the market doing? Where is price action at relative to structure? And I see we're below structure. So I want to make a prediction. Where is price action likely to go next? Well, we can probably go all the way down to this level right here, about 70, let's call it 71 even. 71 even. This is the next area of structure. So 71 even. So I identified what the market's doing. I made a prediction of where the market is likely to go next. I can also ask myself the question, well, how is the market likely to get there? I told myself that we're looking at 71 even. We can either do what? We can either go straight down to 71 even, or we can get a retest back in the previous structure and then go down. So when I go to my top-down analysis, when I look at my daily chart, whatever your higher time frame would be, I just want to get an overall perspective of what the market's doing. Are we going up? Are we going down? What type of trading opportunities should I look for? And I know that on this time frame, based on scenario, I know I can't get short here because I just, stops would have to go up there, and it's just not going to work. So I know by this point, only thing I'm looking for is a retest up in the previous structure and then a chance to get short after the pullback. So I take that mindset and I go down to my lower time frame, which is going to be a 4-hour chart for me. Daily to 4 hours, what I go from. And I'll identify my structure level. I'll say, well, if you have the DSRs, you can throw the DSRs on. It makes it easier. We have two structure levels. We have one right here, and we have one a little bit higher right here. And frame, these are the zones where we're most likely to get a retracement into. And then as I watch on my lower time frames, I just wait for price action to retrace, and I look for my opportunity. So we can do that by, we can start bringing some fibs on. We can say, well, Fibonacci retracement from our last, our biggest swing high to swing low. I'm going to get a 382 right there, right in the middle of that second zone. I can also take a Fibonacci retracement from my most recent swing high to swing low. You see I'm going to get a 50% in that area. The 618 a little bit higher too, but 50% of 618 in that area. And if you want, you can even take it, I guess, from this little swing right here, swing high to swing low. And you'll see I'll get a 786 in there as well. So as of right now, I would be looking for, this is my area that has the most Fibonacci confluence. I do have a 382 right here. But again, I'm looking at risk reward. I know if I enter right here by itself, I would need some type of conservative approach to get in. Right now, I'd be looking for a retest to this area. Again, I've got 3 fibs lining up all around the even handle. I've got 76 flat. I've got a 50%. I've got a 786. I've got a 382. I've got structure looking left. Boom. And I would just wait. I would just wait and see. Wait to see if price action gets up here. And then if it does get up here, decide how I want to get involved in the trade. So the higher time frames are basically looking at the big picture, deciding, you could put it like this, it's deciding what side of the market you want to be on. Do I want to be long or short? Where do I think, big picture, where do I think the market's going to go? What do I think the market's going to do? Then as you go down to your lower time frames, your trading time frames, that's when you're doing the bulk of your analysis. That's when you want to bring on your Fibonacci's, you want to do your harmonic moves, whatever you do in your normal routine of technical analysis, and really kind of pinpoint that area. Say, okay, well, this is the big picture from the higher time frame. I'm thinking retracement. Now, as I go down to the lower time frames, more of my trading time frames, where exactly should I look for this retracement to get in or to occur at? If we get a retracement to this level, then where do stops need to go? Where do targets need to go? Is this a trade that I could potentially take, or is it an opportunity that's good but just doesn't meet my trading rules? Does that make sense with the top-down analysis? Well, what problem are you having with it? Is it just you do need a lot of practice, but what's the main confusion point of it? Now, again, if you've been trying it lately, there's really nothing going on in the markets. So if you're trying it lately, there's not a lot of opportunity. So if it seems tough, it is. I got nothing on my radar today. Difference between major and minor structure. Well, if you have your DSR levels, you can do your DSR levels. You can have your major structures be 4-hour time frames, or 2 times, four times your time frame, and then your minors be 2 times your time frame. But you can think of major structure levels as structure levels you see on your higher time frames. So look at structure levels that you see on your daily. What are structure levels that we see on our daily, right? We have structure here, 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 right? These would all be considered major structure levels. Identify on your higher time frames. When you go down to your lower time frame, you see how you have this little blip right here? This is going to be a minor structure level. These little ebbs and flows in here, right here, right here, right here. You see these? These are going to be your minor structure levels, because these don't exist. These don't exist on your daily time frames. Right? We go out to a daily chart, you don't see these. You just see the big swings. So higher time frame structure levels, those are going to be your major structure levels. Lower time frame structure levels, the ebbs and flows within the market, those are going to be your minor structure levels. So you think of it like this, right? And it's how the market moves in what they call fractals, meaning you get the same movement on each pair. Say on a daily chart, you see this, right? Would we all agree that these are going to be major structure levels like this, right? Major structure, the major pivots in the market, right? Would you guys agree? Yep. So these are going to be your daily structure levels or your major structure levels. Again, your higher time frame structure levels. Now, as you go down to a lower time frame, what do you get inside here, right? The market does like this. It just doesn't go straight down, right? The market ebbs and flows down like that, right? We bounce up to get to these levels. These are going to be your minor structure levels. Does that make sense? I probably should have used a different color. But these are going to be your minor structure levels, the ebbs and flows within these bigger swings. So again, this is the swing from the daily, right? This swing high to this swing low is the swing on the daily. Really, you can say this. This is our daily swing right here. I'm just sticking that up some, make it a different color. Boom. 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 These are your major swings. Major structure, major structure, major structure, major structure. But you can see in the 4 hour, within this move, we have minor structure, minor structure, minor structure, minor structure, right? The little ebbs and flows within these are going to be your minor structure levels. So that's a great way to think about it if you want to separate the two from major and minor structure. But is there Jan, is there one place that is confusing you about the top-down analysis, or like I said, you just think it's a practice issue, you just haven't had enough time with it? Okay. Just think of the IPDE process again. Just think of, and this again, trading is a skill, guys. It takes time, but just think of IPDE, right? Just think of the IPDE process and split it in half, saying your identify, your predict, your big, that's done on the higher time frame. What is the market doing? Where's the market likely to go? And then you're deciding and you're execute, and that's going to be on your lower time frames. So just split that IPDE process in half. Use your higher time frames to identify what the market's doing, where are we at in compared to structure, make your prediction, where is the market likely to go next, and then also how is it likely to go there. And then when you go down to your smaller time frames, that's when you're still doing a prediction. You're kind of doing you're fine tuning that prediction, but that's where you're looking to say, okay, well now I need to decide how can I, if I can, sometimes you can't, but how can I involve myself in this prediction if it were to come true. What are the arguments against using 5 minute as trading time frame for swing trading, staying overnight? Or 50 minutes, excuse me. You can if you want. There's no, I mean, 15 minutes is more of a lower time frame. You're gonna deal with a lot more chop on the 15-minute charts. You can hold 15-minute trades overnight. There's nothing wrong with doing that. I would say that if you're managing a position, it's going to be a lot harder to do. Let's say you're managing a position at structure. And what I mean by managing a position at structure is you're looking something like this. You're looking for the ebbs and flows. And you're saying, okay, well, as the market goes up, I'm rolling my stops with price action, protecting my risk on the downside. 4-hour chart and hourly charts, daily charts, pretty easy to do it because, you don't, it takes a while for that retracement to happen. Most likely it's not going to happen while you're asleep. The 15-minute charts, again, it's going to be a lot more noise inside here. You still may go in the same direction, but there's a lot more ebbs and flows in there. So managing a position, you're either going to miss places to trail your stop, or you can easily just get stopped out on these false breakouts if you're holding for bigger time frame positions. So, I would stick to intraday trading. I don't think there's anything wrong with holding it overnight. That's a choice for the trader. You can hold 5-minute trades overnight. That's up to you. Just realize that the lower the time frame you go, the more noise you have to deal with, the more attentive you need to be to the market. So as a swing trader, a 4-hour chart, you can really just set it and forget it. You can execute a trade and then you can just, go somewhere for a few hours and come back and check it. 5-minute, 15-minute charts, you really got to watch these things because the market's going to move pretty quick. So it's going to require a lot more attention. Now, if you're someone that just is, if you're not worried about managing positions, moving stops to break even, you're just worried about, hey, I'm setting a trade and I'm going to have a target and a stop and that's it, then you'll be fine. But if you're looking to be an active trader, it's going to be quite difficult, or just you're going to need to spend a lot more time with it than you will on a higher time frame. Maybe because of recent market conditions, I'm having trouble. Yeah, it's really hard, going back to the top-down analysis. It's really hard to make any predictions on the majority of the pairs here. I would say that Aussie dollar and New Zealand dollar are probably one of maybe 3 pairs that you can actually make a solid prediction on. The rest are just in consolidation. You go up to a euro dollar. You go to a euro dollar chart, I can't make any prediction here. I can say we're either going to go down to here or we're going to go up to here. That's about it. So if you're finding it hard now, it's really just the market conditions. There's no, again, you can see there's no clear break of structure or anything. So we can't even, what is the market doing? We're going sideways. If anything, we're at structure right here. Look left. But there's just not a lot of predictions you can make in many of these pairs, especially the European ones. So that may be why it's a little difficult. Should we repeat some trend continuation 3-bar reversal, higher high, higher close we talked about? If you want to, I don't know if we should. If you want to ask me a question about it, sure. And I can show you more examples of it. I'm not sure if that should was supposed to be a could. Akil, if you are a counter trend trader, you are looking to catch the outside. If you are a counter trend trader, you're looking to catch the outside returns. You say we are. If you're a counter trend trader, you're not looking to catch the outside returns. A trend continuation trader is looking to catch the outside returns. Maybe I read that wrong. If you're a counter trend trader, you are looking to catch the outside returns. You say you are a counter trend trader, but you always talk about erasing any long thoughts from your mind in a bearish market. Well, here's the difference between counter trend and trend continuation. Right? Let's say the market is ebbing and flowing like this. So, right? Trend continuation traders, they're looking to catch the outside returns here. They're looking to hop on the pullback and catch the next move up. So this is what trend continuation traders are looking to do. Counter trend traders are looking to do this. They're seeing this right here, boom. They're looking for a hold of this, and they're looking to catch the pullback. So we could say it like this. Trend continuation traders are looking to buy the pullback in anticipation of higher highs. Counter trend traders are looking to sell in anticipation of the pullback. So counter trend traders are looking to catch the pullback. Trend continuation traders looking to catch the extension. So counter trend is right here. Trend continuation is right there. So you're saying, do I only look for counter trend opportunities when the market is at a potential reversal zone? Yes, yeah. Yeah, you only want to look for counter trend trading opportunities at a place where you think the market's going to get short. And same thing with trend continuation. Just in general, you only want to look to trade at areas where you think the market's going to go in your favor. If you're a trend continuation trader, I think it's very dumb just to buy it up anywhere. You want to buy it up at places where you think the market has a chance of getting long at. Same thing with counter trend trading. You want to sell it. You want to sell it at places you think the market has a chance of getting short at. Like the New Zealand dollar last week. I don't think there's any reason to buy that because the market was in the middle of nowhere. Same thing with, if we go back to Aussie dollar, you know, it would be a counter trend move to buy it down here, right? This would be a counter trend move because you're buying it as the market is in a bearish trend, right? But there's no reason at all to buy it down here. There's no reason to buy Aussie dollar. Trend continuation trader, would you agree? No. A trend continuation trader isn't looking to sell down here either. The two places that a trend continuation trader looking to sell is either on the breakout or on the retracement. No, New Zealand dollar wasn't a good place to sell either. What we were below structure already. There was no reason to sell. Well, where were we looking at, Jason, again? What was the level? We're looking at what, an ABCD pattern? Was it right? You remember the level? Is this our ABCD? Was this our ABCD right down here? This looks like it, right? No? Probably. Was this the level 67.0? Do you remember? 7.2? Probably, yeah. Yeah. Okay. Are you there? Can you hear me? I know your sound's going in and out. Yeah. Was this the level? 70, 67 flat? This was the level that we're looking at for the ABCD pattern? Yeah. Okay. So you said it was it would be a good trend continuation trading opportunity. It wouldn't. Why would you, what would be the reason to sell right here? Okay, yeah. No, yeah, well, that's different. If you got a retracement, yeah. At this level, this would have been a horrible trend continuation opportunity. But a trend continuation trader is looking to catch the retracement. So yeah, so they'd be looking for pullbacks. They'd be looking for a pullback right here. They'd be looking to sell all these opportunities, all these pullbacks. They'd be looking to sell. Yes, those would be good trend continuation opportunities, or opportunities that trend continuation traders would look for. Okay, I thought you were saying it would be the place where the counter trend trading opportunity would take place would be a good area for a trend continuation trade. I'm like, no way. Again, trend continuation traders are looking to get the end of the pullback. Counter trend traders are looking to get the beginning of the pullback. So this is all trend continuation right here. They're looking here, they're looking there, they're looking there. Counter trend traders looking here, looking here, looking there. With the trend, against the trend, with the trend, against the trend. Again, counter trend traders, you're looking You're looking to make your profit off of the pullback in anticipation of the pullback, of the relief, of the retracement, whatever you want to call it. Trend continuation traders are looking for the end of the pullback and looking to get paid, I guess, off of the extension. And again, at each of these levels, you can do your different techniques. Which one did you want to see, Gabriel? You want to see 3-bar reversal or just a fib failure one? Which one of the trend continuation techniques did you want to take a look at? Three-bar reversal. Okay. So if I were counter trend, I'd be looking at this chart thinking double bottom with RSI divergence. Yes, you be looking to ask yourself, when is the market going to get overextended, and when can I catch a pullback? But remember, just because you have a double bottom with RSI divergence doesn't make it a good trading opportunity at all. What do we? I guess we don't have to have it. What should we always be looking for? What do I always say is the most important thing to have? Yes, structure. So you can have the best double bottom with RSI divergence in the world, but if you don't have structure, I think it's a dumb trade. Me personally, again, structure is the key in my philosophy, but that's just my opinion. Because if you don't have structure, you don't have any protection. Especially if you want to go against a train moving this fast, right? This is a steaming train engine, right? 100-mile-per-hour truck coming your way. If you're going to step in front of this thing, you better be darn right. We didn't have anything on the weekly. I checked it. We did it in the live room. There was nothing there. Want to prove it? I'll show you on the weekly. I'll show you where your stops would have had to been on the weekly. Yeah, again, the key to trading is don't go broke. We want to put ourselves in high. We don't just want to take trading opportunities. We want to take high probability trading opportunities. So we don't want to waste money in the market, hoping and guessing, because we're going to go broke very, very quick doing that. We want to look for the best trading opportunities and the safest ones for us. So yes, a double bottom RSI divergence could be a good trading opportunity, but is it the best? And that's what's going to separate us from the 90% of traders that fail. We're not looking to just take any trading opportunities. We're looking to take the best trading opportunities, and we're going to save ourselves some drawdown in the process of doing that. So we had here's our lows, right? If we want to take this structure into account on the weekly, oh, where'd my little toolbox go? That's weird. Anyway, if we want to take this structure into account on the weekly, our stops would have had to been below this line. So we're looking at 67 flat. If you're willing to risk 200 pips on a stop loss, you go for it. I personally think that's a little far because this is the low of our structure, right? You see it? Stops would have had to been below here. Either that or you had to be willing to take every double bottom you see until we get past this level to justify your reasoning. So we're at a zone. We are at a zone on the weekly, Jason. You're right. But look how far this zone extends down. Are we willing to put stops underneath this structure? And unless you're shooting for, if you're shooting for a massive reward, then yeah, it would make sense. If you're shooting for something, if you're shooting for a reward, if you're shooting for a reward up to here, then it makes perfect sense. Then it's a very good trade because you can see that risk reward is very low. But I don't think we're shooting this far up. I don't think we're shooting for a move back in the 71 flats. Am I right? Hello? Am I right, guys? Am I wrong? Yeah, you just don't trade. Now, like like I said, if you're shooting for this, then it's a great trade. Trust me. If you're shooting for this type of target, then it's a great trade. It's a you're looking at a 5-to-1 risk reward. It's a great trade. I just think most of you guys aren't trading off the weekly charts. Most of you guys aren't putting yourself in trades where you're looking at holding for 500 pips. So for us, this wouldn't be a good trade. So you just don't take it. And you've got to learn to see trading opportunities that you want to take and just not take it. I'm sorry. You've got to learn. You've got to learn to look at a chart and be like, oh man, that looks good. And then sit on your hands. Again, that's what's going to separate us from the rest of the people out there. I think Jason's mic went mute again, or his sound went mute. All right. Let's find all right, let's see an example of a 3-bar reversal. So we're looking at a trend continuation trading opportunity. We're seeing price action, ebb and flow down. Let's just draw some lines in here. What line do I want here? What is there we go. Boom. Ebb and flow, right? So boom, we got a new structure low right here. New structure low right here. We're waiting for an outside return. We're waiting for an outside return. We're looking using the 3-bar reversal technique. So I'm taking my low bar right here, and we can bring in our Fibonacci retracement. We can go swing high to swing low. We look for our 382. So the first thing I'm looking for is for price action to hit my 382. Right? Boom. We hit it. Price action hits my 382 right here on this bar. I'm counting 2 bars back for a 3-bar reversal, right? Boom. 1, 2 back. And actually this one wouldn't work because it would have entered the same bar market. So let's do another example. Boom, there we go. We got our high bar right here. Count 2 bars back. 1, 2. We're looking to enter at the low of our lowest bar within this 3-bar range. So our entry would be right below this level right here. Boom. Next bar. Oh, come on, Keel. Next bar, we get a higher high, so we have to adjust our count, right? 1, 2. But same bar. Next bar. Oh, same high. We just wait. We just wait. And actually, hold up. We're I don't use this technique. 1 second, having a brain cramp. Yeah, we're adjusting with the bar. So as we keep shifting over, we're counting 2 back, 2 back. We're going to start pushing up right to here. Here's our entry now. And we just keep doing that. Boom. Here's our entry right here. And then we're filled on the way down. Monday morning brain cramp. So you be filled, you got to use a buy stop order to aggressively get in, but you be filled on a buy stop order right here. Questions? Now realize that if you're only going to shoot for targets at a retest of structured lows, you're going to have an inverse risk reward a lot of the time. So your reward is going to be here. Your stop, let's just say you're using an ATR based stop, ATR is 38. You're looking at an inverse risk reward if you're shooting for just those lows. And I would tell you this. Well, we know what if you have an inverse risk reward, you have to be right more than you're wrong. Correct? Yep. This strategy is not right more than it's wrong. I can tell you that right now. So I don't think it would be smart. I don't think it would be smart to I don't think it would be smart to do this strategy if you're going to have an inverse risk reward. Because it is not a high percentage winning strategy. So take that warning. Take that warning. If you consistently trade this, and if you're shooting for a retest of structural lows right here, if you consistently trade this, you're probably going to lose money slowly. If you shoot for the extension, the 127 instead, you can see that's going to stretch out your average risk reward. And that's going to put you in a much better position because now you're making more than you win than what you lose on when you, when the trade goes the opposite direction. That's why I always say if you're gonna trade this type of way, you've got to shoot for the extension. If you're going to consistently trade this type of way, I should say, you've got to shoot for the extension. Because if not, that risk reward just isn't going to line up. It just isn't going to line up. You also have to be prepared to be wrong and fire back again. If you're going to be a trend continuation trader, you've got to be prepared for the market to do. Let's see if this one's actually a winner. You got to be prepared for the market to shoot up here, right? Just like we saw of euro dollar the other week in the room. We got to be prepared for the market to shoot up here. And then if we get another 3-bar reversal up here, what do we have to do? Yeah, we've got to take it again because guess what? Our outside return was not broken, right? So our trend is technically still intact. If we're a trend continuation trader, trend following trader, we've got to take it again. Yep, you got to hop right back on and take it again. But when you get scenarios like this, you're going to make a killing. When the market's heavily trending, you're going to make a killing. Because you've probably got, I don't know how many winners in here. You probably got a handful of winners in here. So you're going to make a killing when something like this happens. When the market's like this, you're going to get eaten alive. There's going to be a lot of whipsaw in here. It's going to take you back and forth for a long ride. So those are kind of the pros and the cons that come with that type of trading. That's the same thing. It's the exact opposite for patterns. A lot of patterns are going to get destroyed while all this is going on. They're going to do well in here. Could we repeat fib failure? Sure. Fib failure is what we just did was fib failure. Fib failure is this, right? You got your impulse leg, your swing high to swing low. Fibonacci retracement, swing high to swing low. You're looking for a pullback into the 382 retracement. So the first retracement we use into the 382. And you're looking to hop on that short with target ones being the 127 extension, target twos being the 1618 extension. So again, you're looking for that impulse leg. That swing high to swing low. You're looking for a pullback into the 382. Yeah, didn't get it there. See if I can find a different example. If we're looking at Aussie dollar here, right? Well, let's go down to a 60. You're looking at, right, our outside return to our new structure low. This would be our impulse leg. Swing high to swing low. We'd be looking for Fibonacci retracement. We'd be looking for price action to come back into the 3D2. We'd be looking to use our entry technique here, whether it be an at market limit order, a 3-bar reversal, lower low, lower close, whichever entry technique you choose to use. But you'd be looking to get short with the direction of the overall trend. And you're looking to hop on the trend. Again, target ones, looking at a 127 extension. Target twos, looking at a 1618 extension. And of course, you can measure out an ABCD pattern. You can look structure looking left. You can adjust the targets, but these are the traditional rules: 127, 1618. I would certainly adjust, with structure. If you've got major structure, right above that 1618, probably don't want to shoot for the 1618, obviously. Why is it called a fib failure? Oh, no idea. No idea. It fails to pass the Fibonacci. I guess it fails the Fibonacci acts as resistance, and it fails to push past it. I guess. I don't know. Probably because it just sounds cool. Well, look, you can call it something else if you want. Does the name really matter? Not really, right? So feel free to rename it. You can, or send an email to Jason. I'm sure he's the one that called it this. Maybe he has a reason. Well, call it something else then. Call it 3D2 bounce. The 3D2 bounce strategy. Yeah, there you go. Call it three. Yeah, look. You can call it the purple teddy bear strategy. For all that matters is whatever you're trading, you know how to trade the right way. Who cares about the name, right? Call it the purple teddy bear. Stay with this Aussie dollar example. Okay, we're running out of time, so we'll do a few more. Save the Aussie dollar example. Still valid from retracing. Still valid from retracing Fibo 50%, 618. Is it stronger trend from 382? Yes. The lower the retracement, the stronger the trend. Now the trend is still, you're still trending until the market puts in a higher high, higher close above this level. But the smaller the retracement, the stronger the trend. And that's typically why you see, even if you take your ABCD patterns here, you see a longer extension. Right? An ABCD pattern extension from 382 goes down there, 50% goes shorter, 618 goes even shorter, 786 goes even shorter. So the smaller the retracement, the more powerful the trend. That is correct. Now with the original fib failure rules, if it hits the 618, then it's invalid, and you're no longer looking for it. So those were the original rules. If it hits the 618, then you're no longer looking for it. But that's if you're going to be a fib failure trader. If you're a trend continuation trader, you can easily look for it, up here. In fact, the higher it gets the structure, the better opportunity, in my opinion. But we also don't teach the fib failure anymore. So we're teaching it because you guys are asking about it. But that's nothing we teach. You notice it's not in the course. But it's a very simple strategy. So let's call it a day, guys. I will see you guys in the live room tomorrow. Spend today practicing this stuff. Practice, practice, practice. The only way you're going to get better. I have a feeling a lot of you guys aren't doing and this goes for you guys listening too. I got a feeling a lot of you guys aren't doing the amount of practice that you need to be doing. You should be spending hours in front of your computer practicing this stuff. It's the only way you're going to get it. Rewatching the videos, writing down what we're talking about in the videos and creating that trading plan, putting it into notes, writing if-then rules. Start experimenting with it. Don't just come to these sessions and then just be like, oh, well, that's it. I'll go to the live room tomorrow. No, you got to do something with it. If you don't work on it, you're not going to get better. Trust me. If you're just sitting here watching and saying, okay, well, fib failure, let's try that out this week, but you don't practice it, you're not going to get better. It's when you go back to the charts today and you start looking for opportunities, that's when you start coming up with ideas saying, okay, well, maybe I want to do a lower low, lower close technique for entry. Maybe I want to do a 3-bar reversal. Well, maybe the 50% looks like a better area to get involved in 382 because then I can take profits down at previous structure lows instead of needing the extension. That's when you start coming up with concepts like that, and that's when you start making that idea work for you. I said it's not a smart strategy if you're only going to take targets from right here. Well, what if you just enter at a higher point, right? You could be pretty profitable. But you're never going to know that unless you go out there and do the work and start scrolling through those charts. So that's your homework for tonight. You got slow markets. You got nothing to trade out there. So you might as well just scroll through charts. Rewatch videos, scroll through charts. I'll see you guys tomorrow. Until then, plan your trade your plan, and have a great day. Now, if you're just asking me whether you should buy or sell gold, that's not a question I can answer for you. It's not again, I'm not here to give signals, but if you have a question about, again, what analysis or something like that, let me know. But I hope you're not expecting me to say something like, hey, you should buy it. Hey, you should sell it. I'm not going to tell you guys what to do. That's not my trading philosophy. I never tell you guys what to trade. I always say what? Trade your plan. What does your plan say to do? I actually got a question on TradingView a couple of minutes ago. The guy was asking me, hey, should I take profit targets here? I don't know. What's your plan say? So I hope you're not asking that. I hope you're just not looking for a shortcut. But there's something I can address for you on there technically. Yeah, shoot it at me and we'll go over to gold and take a look at it. Gold. Where are you at? Gold, dollar. Oh, the guy messaged me back. It's probably angry. XAU, USD. Bring it up. Get it over so you guys can see it. There we go. Do you ever, David says, do you ever use or trade the 1 minute charts? I do not. 5 minute is essentially the lowest I go. What happens is the lower you go in time frame, the more noise you get, meaning you get more the sporadic, the sporadic action in the market that is really kind of faking you out and doesn't really give you a clear signal. So the 5 minute chart is typically the lowest I'll go, David. Now I do go to something called range bar charts. And these are, and you can use tick charts, Renko bar charts are similar. I'm not a big fan of Renko charts because of the historic data is kind of weird. But if I want to go lower, if I want to go lower than, repeat, okay. I was saying that I don't go to 1 minute charts. The lowest I will go are the 5 minute charts. And the reason being, I think once you get under 5 minute charts, the market just gets a little bit too choppy. I mean, there's so many false signals that it doesn't really give you a clear picture of what you're looking at. So 5 minutes are the lowest minute chart that I'll go to. Now, what I'll often do if I need to get, or if I want to get maybe a closer view at the market, say the 5 minute chart just looks bad, I'll go down to a range bar chart. And you can use a tick chart as well, a Renko chart, but I'll go to a range bar chart. And it's not a minute-based chart, so it's not necessarily a lower time frame than a 5 minute chart, but it gives you a different look at price action. It's all of the bars are based off movement. So instead of getting, say on a 5 minute chart, one bar, one candlestick would print every 5 minutes. These candlesticks print every time the market moves in a range of 5. So what it does is it gets rid of a lot of those really bad looking wicks, a lot of the consolidation candles, and it allows you to see, in my opinion, a smoother ebb and flow to the market. So if you're looking to get a clearer picture on things, I wouldn't necessarily go to the 1 minute chart. I think you can get into a lot of trouble down there, but you may want to experiment with range bar charts just to get a clearer view of the action. And you can see, even if we're just looking at how these things form, you know, this one formed at 906, this one at 907, this one at 907, this one at 908. So you got about 4 bars within the last 2 minutes. Sometimes you'll get that if the market's moving quick. Sometimes you'll get 1 bar in 20 minutes, so you never know. But yeah, I've never been a fan of the 1 minute charts. It doesn't mean I'm right on that. I've just never personally been a fan of them. I think, I don't know. I think I think you got to set yourself up. You got to give yourself a limit at some point, because you'll start trying to force trades. You'll start seeing something on the daily, and then I've seen traders go from the daily charts all the way to the 1 minute and just don't realize that the minute chart has absolutely nothing to do with a daily chart. But yeah, I'd stay away. Try a range bar. Sherman says, XA, is there a valid double bottom on the daily? Looking right here, Sherman. Looking at this. Yeah. No, this is not going to be a double bottom on the daily. just more of a consolidation. Reason being because we don't really get this. Our bottom comes off of this big wick candle. So it's not going to really be a double bottom off the daily. But here's the thing. Even if it was, the question you need to ask yourself is, yeah, there's no retracement. The question you need to ask yourself is this a double bottom that I would want to buy? And when you go to the higher time frames, it's probably not, because this double bottom is essentially, not only is it below previous structure right here, but it's in the middle of no man's land, right? Do we have any support here for this double bottom at all, aside from being all the way this little blip right here? Not really. So it's more just consolidation, not a double bottom, because we don't get that retracement. If you go down to the hourly, this would have been a double bottom down here. Let me just delete. Hold on. Delete this. This would have been a double bottom down here. Again, probably not one that you would have taken, but right in here, this move would have been a double bottom on the hourly. But on the daily, no, it's not going to be a double bottom. I'm sensing you're looking for a reason to buy gold. Do you want to buy gold? Is that what you're waiting for? You said day one. Okay, so let me ask you this: what style are you? Are you a CTS trader, Sherman? Or are you that far into the Are you that far into the course? Are you a CTS system trader? CTS. Okay. Well, build me a case then. Build me a case. Trying to understand. Okay. Well, again, there's no double bottom here. We don't have any type of retracement. Our initial bottom comes here, right, off this bar, and then we just essentially, this is just going sideways. So it's not going to be a double bottom here. This is essentially the market doing this. The market spiking down with that red candle, and then just really just putting in consolidation. Now you do have the RSI over oh, if I can drag this up. You do have the RSI oversold, excuse me. You do have RSI divergence, but here's the question. And let's pretend this is a double bottom. What else do we have at that level? What other reason can we use to buy this up? We've got, and again, it's I wouldn't consider this a double bottom, but let's just call it a double bottom. We have a double bottom. That's going to be 1 point. We've got RSI divergence. We got RSI oversold, which is 1 point. We got RSI divergence, which is 1 point. So right now you're sitting on a CTS 3. What would be the minimum CTS score that you need to trade, just in general, to execute a trade? CTS 4. All right. So do you have a fourth thing? Or would you need to wait for something else, say, to happen, like a 2618 or something like that? And again, this is, I would not consider this a double bottom, but we're just pretending. And with double bottoms and double tops, you want to see that clear. You want to see that clear retracement. You want to see the market spike down. You want to see it clearly retrace off that level. And the key to the double tops and double bottom is the retest. So it means that essentially the market spiked down. We had buyers protect that level, tried to push the market up. The sellers made one more attempt at getting short, and the buyers protected that level once again. Again, with this right here, we have the sellers going down, and then we just consolidate at this level. That's why I wouldn't consider it a double bottom. We don't really have a retrace here We essentially just have the market consolidating at the lows. Does that make sense, guys? I know it's difficult to see. It comes with experience, but that's why I would not consider this a double bottom. It's essentially the market going down and just flagging off. But going past that, even if we had a double bottom, I would say I don't think we have enough at this level to say that I would want to buy here. If we're doing our top-down analysis, our IPDE, identify, predict, decide, execute, the first thing that I see, and let me scroll out on here. Here's the first thing I see on gold, right? I see that we're slowly trending down, trending down, trending down. Boom. That we've got a lower low, lower close right here. What does a lower low, lower close tell you guys? What should we be thinking when we see lower low, lower close? We should be thinking bearish trend. So right off the bat, immediately, I would be cautious about taking any type of bullish trade when we're in a market that's clearly telling us bearish. Unless we were at a major level of structure. If we had major structure looking left, that's a different story. We don't really have major structure looking left. When we look left here, you can see there's really nothing at all. You can get a little minor blip right here. We're still pretty far away from that. But the next level of structure, I would say, is honestly down here. So there's no structure to use as protection for a counter trend trade. So I would be extremely cautious, maybe even waiting for, if you're going to take it, wait for like some 2618 type of action. But I would be sitting back just waiting for a bearish opportunity. I would be waiting for the market to come up to here and then looking for a chance to get short and ride this thing down. But back to the original point. Again, I wouldn't consider this a double bottom. This is more of just the market coming down and then just consolidating sideways. And we'll probably see a breakout one way or other, either up or down to that way. Does that make sense, Sherman? Yep, no problem. Now, I'll tell you what, if you're looking for a reason to get involved, maybe go down to a lower time. I'm not sure what time frames you trade off of. Maybe wait for something like this. Because with all that being said, there is a good sign that someone protected this level down here. You see a big wick like that. Someone said, okay, this is enough. If you're looking for a reason to get long, I would wait for, again, a 2618 type of opportunity. Wait for, currently we're doing something like this. We've been making lower highs and lower lows. We do have some divergence on here. If you want to take a shot to get long, I'd wait for a break and close above our previous structure high, something like that, or retest, and then doing something where you're getting a stop loss. You're getting involved on that pullback. You're getting your stop loss right underneath previous structure lows, and then looking for a chance to counter trend trade it back up. I think that's your best bet, waiting for a little bit of confirmation. Yeah, because not necessarily, it's technically not going to be a 2618 because we don't have that double bottom, but the same type of theory. So waiting for, here's our previous structure high, right? We've created lower highs. In theory, this level shouldn't be broken. Now, of course, the market will do whatever it wants when it wants to do it, so we never know. But in theory, this level shouldn't be broken. So if we get a break of this level here, we're looking at this as a potential rotation in trend, a higher high, higher close. We can look for a pullback. We know where we can put stops. Obviously, the safest stops are going to be below here, but I don't think it's worth taking that much of a chance. You can put stops right underneath here and just look to catch that pullback and maybe ride this thing back up like that. So it's something I would keep on your radar. Just watch it. Say, okay, well, I don't have enough to enter it right now. I'm a CTS4 trader. All I have right now is a CTS3. So I don't really have enough to enter this trade. But if price action were to do this, then I can look for this type of opportunity to take advantage of it. And you'd be surprised at how many times where you get an opportunity that you want to buy it or want to sell it, and the market just doesn't give you what you need. And you're like, come on, come on. But when you have that backup plan in mind, you'd be surprised how many times the market actually fulfills that backup plan and gives you that second opportunity. So it's always worth being prepared. Always worth being prepared. Free fall and gold. Why did man? What caused? Do you guys remember what caused that move? Hey, we're filling out the room a little bit. What's going on, guys? I haven't paid attention to gold in a while, so I'm out of the loop. I'm out of the loop on gold, but China was it China. Darn China. China's ruining everything. Yawn. Okay. China's gonna rule the world. I'm telling you. We owe them some favors, and they're gonna call in one of these days. China worries me. I've been watching all this. Been watching all this stuff I shouldn't be watching on TV, like ancient aliens and these conspiracy theory things. And China's got like these underground. They got like these. There's like a country. There's like an underground China, guys, and no one knows what they're doing under there. They have another country right underneath themselves. It's weird. They got all types of weapons that we don't know about. It's again, this could be television banking off my paranoia, but China worries me. They worry me. They worry me. Yeah, a lot of countries owe China a lot of money, and one day they're going to call in those favors. One day, I think they can. I think they can end up being. I think if they can. I think they can end up being the superpower. I think they can. I think China can be not bragging about the U.S. I think China can end up being the yeah, the superpower. I think so. Yeah, I don't know about Russia. I think too many people dislike Russia. Russia will be like the big bully. They'll just do what they want when they want to and dare you to stop them. I think China's they're a little sneakier. China will do stuff and play those mind games with you, and you never know what happened until it's already done. It's like, by the way, we China just bought North America. They own us now. Yeah, same thing with England. Yeah, yeah, they own you guys too, right? They're playing some games. What about the Illuminati? It's all about the ancient aliens. I'm telling you, aliens. Ah, all right. What other questions do you have? Hey, if you ever get bored, watch Ancient. There's a lot of good shows on TV. Watch Ancient Aliens on the History Channel. I'm telling you, Charles, it has you thinking about things in an entirely different perspective. Yeah, yeah. Now, a lot of it's junk. A lot of it they try to make work. I do believe in aliens. I mean, wouldn't I mean I think would be naive. I don't know if that's the right word. I think it would be naive of me to us to think that there's no other life forms out there. How how self-centered can we be? We're the only living ones in the universe, galaxies. Now, I don't know if they came here and brainwashed us and all that stuff. But there's life forms out there. It's got to be. Yeah, yeah, yeah. I believe in that stuff. Yeah. Again, how far you want to take it? Well, I don't know. Again, I try not to jump to conclusions off stuff I don't know. There's certainly like bacteria and stuff out there, and that's how I don't make this into a evolution versus religious thing, but there's certainly plants and bacterias out there. Um, it would not shock me if there's high cognitive beings out there either. I mean, maybe not in our universe, but if you think of how big space is, and if life was able, it's hard to believe that we were the only perfect match, the only perfect storm that was able to create life. There's out of everything that Big Bang created and the other Big Bangs all over the place, it's hard to believe that we're the only ones. That's just all I'm saying. It's hard to believe that. Now again, all the stuff about them wanting to come here and conquer us and control our brains and probe us and that stuff. Yeah. I think they figure humans we're gonna destroy ourselves before we have a chance at finding them. So, which is probably true, but we'll see. If aliens could reach Earth, they would conquer us. They would. Yeah. I don't. I don't think they would have a need. I don't. I think they're gonna let us conquer ourselves. To be honest with you. Think about it. If you're an alien, and I always believe that. Here's what I believe. And if you guys have a trading question, we'll get back to trading in a little bit. I always believe that if all right, if there are other life forms out there, they're probably much more evolved than us at this point. We're one of the younger life forms. So therefore, I always believe like this: if there's another life form out there, guys, they're probably I would guess that they're watching us like an experiment, just like how we would watch another life form. I would say that hey, um, they're probably watching us and taking notes and saying, hey, this is how these guys act. This is how, you know, stuff like that. I don't think they need to conquer us. I don't think if they wanted Earth, they probably could have had it already. But we're probably watching back, just waiting for us to destroy ourselves. And they probably watched the dinosaurs. They probably watched the other, um, they probably watched the whole evolution of us and just used it as some type of experiment and just studied us. That's what I mean. We would do the same thing, right? If we found something on Mars, right, we would watch it and just watch the evolution. Yeah, we are. Come on, we're destroying ourselves. We're horrible. We're horrible. It's sad, but we're destroying our planet, and we're gonna keep doing it because as humans, our whole objective is just to when we find something, we just use it until it's done, and then hope that there's another way. By the time it's done, we react after the fact, right? Just think about our economy, guys, right? All the recession and stuff like that. What do we do? We just we'll just keep pushing the snowball down the hill and let someone else worry about it, right? Well, U.S. here, we'll just print money until it gets better, right? No Social Security. We'll worry about that when it happens. Same thing. And when someone tries to be proactive and think, they're the crazy ones. Hey guys, we should stop doing this because we should stop drilling oil and all this stuff because we're going to destroy and blah 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 blah. No one wants to do it until the problem actually happens. Then you get the scientists that came out like, oh, I told you this, 2 decades ago, but no one listened. Obama fooled us all. Neil Armstrong and Buzz. Huh, that's interesting. Yeah. Again, I wouldn't. Yeah. I think we know a lot more than we know. And that's another conspiracy theory show I watched about what our space program actually knows and what the Russian space program actually knows. And it's that whole deal with human safety. That they told us we go crazy and start Armageddon here. So they don't tell us, which is probably good. We don't need to know certain stuff because we just react crazy before knowing the facts. All right. What other trading questions do you guys have before we get too tied up in ancient aliens? I wake up sometimes at night and there's a cipher sitting on the end of my bed. Back testing will do that to you. You start back testing enough, you'll start dreaming about these things. Good old back testing, man. I want to get back into back testing. I've got some. I don't know. You know what I want to read again, Jason? I want to read that. I want to read that RSI book again, the Complete Guide to the RSI. The Complete Guide to the RSI. I want to read that again by John Hayden. I read it before, but forgot half of what's in there. Mainly because it doesn't affect my trading, but I always like going back and if you guys have read books in the past, make a habit of go back. You don't have to read the whole thing, but as you evolve as a trader, go back and read some of those books that you once bought. You'll find that they make a lot more sense now that you're not just reading them for information, but you're reading them and kind of relating them to your trading. I've gone back and read a lot of the books that I've read early on, and early on in my career, I read the books just for general knowledge. Same thing with like YouTube videos. You're just like a sponge taking everything in. Even with a lot of Jason's old videos, I went through a lot of Jason's old videos this past weekend on YouTube, stuff from like 2-3 years ago. And you'll find that if you watch them again, once you have an idea, once you know what you are as a trader, you go back and watch these things. It's not just watching it for general information anymore, but you're relating, hey, how can I use this in my trading? It just gives you, yeah, like Charles said, a whole different perspective on things. So always continue that education. And people, they ask me all the time, why do you go back and watch your old training videos? Why do you go back and watch old pro trader videos or Jason's old YouTube videos or stuff like that? Because you can always find gems in them. There are always gems. Yeah. So, you don't need to do it now, but once you identify what it being, that's very important. That you get that trading philosophy, you understand the trader that you are. Once you're able to do that, you go back and just keep trying to sharpen those skills. It's a never ending process. You're always getting better. You're always getting better. Ooh, are we yeah, we did 66 pips. There we go. Nice. Pound dollar one as well. Yes. There we go. That's what I'm talking about. We had the bat pattern, if you guys remember, on pound dollar from last week. It came up one tick, one pip shy of my profits overnight, and came back down. You guys saw on the trade floor, I moved stops to break even. And I thought it was going to be one of those things where it's like, it just misses and gets me. But we just rolled up and hit target one for 66 pips. So last week, I was down about 152 pips. The week before that was up a lot. Actually, Jason hurt me that week. Come on, Jason. But I personally, I was up the week before, big. Then I gave back 152 last week, and then starting off this week pretty well. So I should just stop right now, right? Stop while I'm ahead, guys. Call it a week. just do nothing. Just do nothing. All right. Sherman says CAD yen is a better double bottom. Oh, is this a better double bottom on the daily chart? X at 94.47. RSI oversold. RSI divergence. Major structure on the weekly ABCD. Let's check it out. Daily chart. I'll tell you what, I like this. I like the structure level better, Sherman. We do have structure, so you have some protection right here. You've got some protection in this previous structure low. Or no, I'm sorry. You're looking on the daily as a double bottom. You're looking at this as your double bottom. Where's the ABCD pattern at? You said major structure in the week. I don't see the major structure here. Yeah, I think it's we'll do it like this. I think the double bottom is good. I'm not sure if you have any filters in there about how far it can retrace. If you have a filter that says your double bottoms can't retrace to the 3D2, then it's not going to be a good one. But again, that's just a personal filter I have in. I think the retested structure is good. You have the double bottom. You have the initial test here is overbought or oversold, excuse me. You've got a retracement up, and you've got a second test, which comes to that same level. So this is the optimal entry point, and you also have RSI divergence. Again, the issue I would have now, strictly as a double bottom, it looks like a good double bottom, assuming you don't have any filters about how far that retracement can retrace. The ABCD, A is at 97.10. Are you looking at an ABCD on a lower time frame of 4 hour? On a daily, 97.10. 97.10 is right here. Yeah, this is not, there's no ABCD here. This is just a straight move down. It's an ABCD on a lower time frame, but if you're trading on the daily, that's not going to make too much of a difference. So it's not going to be, on the daily, it's not going to be an ABCD pattern at all, Sherman. On a 4 hour, you're still a little short, but in that zone. But on a daily chart, this is just a straight move down. This is nothing right here. So you have a double bottom. That's going to be about it. No ABCD pattern. Now you do have the RSI divergence. You do have the RSI being oversold, which is good. The question is this a place where you want to buy the market at? And that's always the key thing. Is this a level that you think you should be buying at? And I know for me, I would probably say no. I don't think it's a horrible spot. You do have some consolidation over here. You do have some consolidation right here, but there's nothing really in the market that tells me that I should expect a reversal at this level. Then I also have the rule about the 3D2. If we hit a 3D2 retracement, I look at that as more of a trend continuation opportunity than a double bottom. But that's a personal rule. But I don't really see anything at this level that would make me want to risk my money getting long. So that's my opinion. Excuse me, my opinion. But you are going to have a double bottom. You are going to have the RSI. The RSI was massively oversold here. I got to change this green line to a red line. I keep saying overbought. RSI was massively oversold, and you do have a retested structure. But in general, it's not a level that I would be interested in buying at, just because I see no reason for the market to get long at this area. Now, I apologize if it seems like if I'm just beating down your ideas, but that's what the eyes are seeing. Now, I would tell you this, a level of structure that I would be interested in if we had a double bottom. If we were to get a double bottom down here, now this is a major level of structure I'd be interested in, much more than this higher level. So I think a double bottom down at this level would be a much better trading opportunity than this level. Still there, Sherman? Okay. So I hope that helps you out some. Again, I hope it doesn't seem like I'm bearing your ideas, but I don't think this is a bad level of structure. Um, I think I think it's an okay level of structure. It seemed to look good. Yeah, it's not a no, it's not a bad level at all. I just think this level is better. Typically, when we see again, you do have consolidation here. Typically, when you see two levels of structure that are pretty close to each other, usually the lower one's going to be more important. So this green circle, this is going to be the more important level of structure. Um, Again, I don't think this is a bad one. The market's come to this level. We've consolidated. We hit it 1, 2, 3 times. I don't think this is a bad level of structure. I just don't think there's a lot of safety in your stop loss um, here. And again, I'm a little biased as well because whenever we have this 3D2 retracement, whenever we get a 3D2 retracement, that's a big signal of trend continuation to me. So when I see this, I see a bounce to that 3D2. I think we're going to shoot. I think we're going to shoot lower. I think we're going to shoot lower. And another question is with your stop loss, let me ask you this. Where are your stops going to be on this trade? What level do you have your stops at? Or would you put your stops at? 1 ATR? All right, let's go down to a better looking chart. Ooh, dollar yen's not going well. What was that, CAD yen? CAD yen on the daily. Where's my daily chart? Daily, daily, daily. Here we go. So looking CAD yen on a daily. We're using a 1 ATR stop. All right, where are your targets going at as well? 64. It's a small, actually, let me take this one. 73, that's better. It's about 94.80, 93.80. And your targets are going with 97.03. Targets back in the, oh, so you're just looking at a move back up to here. Okay. So your risk reward is pretty decent. If you're buying at market, here's your reward. Here's your potential risk. Again, the question I always want to ask myself is, are my stops in a safe place? And when we look left, I would say this: if I would have them, this worries me. But if you're going to take a shot on this trade, I would at least get it below this level. At least get it below these spikes. You can still have a very good risk reward, but get them below. I would say get them below the 93.50 level, and you can still have a very good risk reward. You can still get a 2-to-1 on this trade, but I would certainly get them below this level because this is going to be a trap written all over it. You probably have a lot of traders that are resting their stops right underneath that 94 even level. You got that spike down to 93.74. Again, most likely taking traders out that had stops under that 94 even level. Probably said boop, 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 get them out the market, boom. So I would at least on this trade, I would at least get I would get them below 93.50s. And I think that'll give you'll still get a good risk reward out of it. And you'll get your stops in a safe enough position that you don't have to worry about getting getting ripped in the market. If you'll know you're wrong, and that's where we want to put our stops at. So I would get them there underneath 93.50s. Anthony says, with a double top, the trigger bar and the second bar double top, does it matter which one is higher? No. Yeah, again, I think the better level to wait to be involved at is right here, in my opinion. But again, this isn't, and here's the tough thing about trading, because it's going to deal a lot with personality and philosophy. This isn't a bad situation here. We come up and we have the market. It clearly consolidates at this level. Clearly consolidates at this level in the past. And you would think we're going to see some consolidation in the past, in the future. And one of the things that shot out to me is typically with double tops and double bottoms, the trader is looking for a move somewhere up here. I think this is an achievable target. If you would have said that you were shooting for up here, it certainly wouldn't be worth it, in my opinion, because I don't think the market has any chance of going. Well, I wouldn't feel comfortable in predicting that the market has any chance of going up there. But I do think there's a chance to run across here, because we can easily see something like this, right? A little head and shoulders action where the market consolidates on this side. We pop up, we come back down, and we consolidate on this side. We can easily see that. And I'll tell you what, Sherman, that would be enough movement. That would be enough movement for you to get targets hit. So I think you have a good area for target placement. I told you where I would put stops if you're going to put stop loss. I don't think it's the best trading opportunity, but I do think it's an okay trading opportunity. So it's not a bad one. It's not one that you should just, shut your computer down and go back to week one training. No. It's an okay trading opportunity. It's just a question of personality. What type of trader are you? Are you willing to take trading opportunities that are just okay, or are you a trader that needs to wait for the best of the best only? And a lot of that's gonna have to do with your aggression level as a trader, and that's gonna be different for each person we talk to. Some are very aggressive. Some don't mind taking a shot if the risk reward is great. Others, they're like, all right, well, my number one rule is I don't want to lose money. I don't want to put myself in any position where I've got a good chance of getting stopped out and given some money back. So I'm only going to wait for those optimal opportunities. Yeah, no problem. For me, CAD yen is not doing a controlled retracement, rather a sell-off, so I wouldn't personally go long. What's rather a sell, yeah, controlled retracement. Yeah, okay, yeah, that's fine. Yeah. Can you check a double top on euro dollar 60 minute? Right here. Yep, looks like a valid double top, Jason. Smooth move up. Nice little nice wick right here, buying pressure. Retracement back down. Got to retest the structure. You got about 13 minutes to see how this ends up. But technically, as long as you don't break and close, as long as you don't close above 111.12, you're going to have a valid double top at this level. Yep. One thing you probably want to be concerned about, though, is the fact that it looks like we break and close above this structure level. Let me just see real quick. Highs of this bar to close of this bar is 110.54. It's going to be close. 110.54. Close of this bar is, that's not right, 110.85. 110.54. Or the highs, I'm sorry. The high of this bar is 110.83. The close of this bar is 110.85. Yeah, so you do want to take into account that this is a higher high, higher close. Yeah, so keep that in the back of your mind before firing that trade off. But aside from that, it looks great. Market massively overbought. Retracement coming back. If you get two pin bars like this, if this candle ends up with a long wick to the upside, I would say that's a short. That's a short. Look for the market to come right back down to previous structure right down here. Probably this 110 even handle as a retracement. Risk reward, risk is going to be about 30 pips, 20 something pips, 13, 23, 33, right around 1140s. So not the best risk reward here because of those long wicks. Well, yeah, it depends on where you get filled at. Depends on where it gets filled at. I think it's a decent trading opportunity though. Purely counter trend. Decent trading opportunity though. However, be aware of that higher high, higher close, and be aware of this. This is the real reversal zone. I wouldn't imagine too many people are interested at this level, despite what the charts are showing you. Despite what the charts are showing you, I think this is the real level. In your experience, Nate says, hey Nate, a lot of new faces. Let me just do a poll question real quick. I want to see how far you guys are in the class. Many of you guys have been here for a while, but never talk, never chat. Oh, Real Madrid up 3-0. Charles is back. You gotta stop badmouthing him now. Nate says, in your trading experience, have you found patterns as prevalent in range bar charts as in minute charts? Yes. I actually think you see them a lot more in range bar charts than minute charts because, again, in a lot of these, and I don't. It takes. I didn't preload my range bar charts up, so I can't. I'm not gonna. It's gonna kill me if I try to load up different ones. But you'll often see stuff like this, Nate. You'll see movement like this on a minute chart. You'll see a candle that looks like this per se, right? Have you guys ever seen a candle that looks like this, right? Everyone seen this? Give me a yes. Yep. And typically this candle happens like this. Let's say this is a bullish candle, right? So you'll get a candle like this on, say, a 15-minute chart. And within this candle, here's what happens, right? The candle starts off here, and then inside of it, we do something like we go up, we go down, we go up, we go up. We have all types of movement inside this candle, correct? Right? We never know what this candle holds. We just know where it opens at and where it closes at the end of 15 minutes. When you go down to a range bar chart, you'll often see within a candle like this, you can easily get the market doing something like that, and that, right? And this is the same candle, right? Open, high, low, close. And you'll get patterns within inside that. So when you go to the range bar charts and it gives you a much smoother type of movement, yeah, you'll often see little advanced patterns that you wouldn't see elsewhere. Right? You'll get stuff like this. I'm not sure if this is one, but you'll get stuff like this. No, don't buy it. You'll get all types of here's a busted one, looks like. Again, I don't know if this is, I'm not measuring these out, so I don't know if these are actually legit patterns or not, but it's like a busted one right there. You'll get all types of advanced patterns inside these little ebbs and flows of the market. I mean, look at this right here. Bat pattern right there. How crazy is this, Charles? Look at this. This is why I used to love range bar charts. You could do this all day. Look at that. You would have had another busted one. This would have been a busted one inside here. Probably wouldn't have taken it because you're already involved in a different one. But you can see my hands are getting tired just doing this. But yeah, you get that stuff all the time. I mean, look at this, and this is between 1722 and this is about 5 hours, and it's kind of off because this is a slow period of the market. But you can easily have a day trading session where you get this back and forth. With that being said, it's you got to pay very, very close attention to the range bars because stuff like this will happen, and it will happen without you even noticing. You may be on a short bathroom break or a short coffee break, and you get back and then you miss two patterns. That's why I recommend if you're going to trade range bar charts, only I would watch no more than 4. I don't think I can personally watch more than 4, and I've got some pretty. I'm pretty experienced with watching lots of charts. I don't think I can watch more than 4 range bar charts and trade efficiently, that is. But yeah, I think there's a lot of opportunity on there, Nate. Now I've never tested advanced patterns on the range bar charts, mainly because it's extremely hard for you to get enough data to do that. But I've seen, in my personal experience, I've seen no reason to see that to say that they win or fail no better or worse than what you see on the minute charts. So again, I don't have data to back that up, but I would have noticed it by now, in my opinion, one way or another. Good old range bars. Very good during choppy markets. Jason says, check out the wick on the Euro double top. Yeah, good looking wick. Sellers beating it back down. Sellers beating it back down. Probably Charles. He's probably moving the market up there. Nazim is. One of you guys are. Again, if you guys are going to move the market, just shoot me an email first so I know. Little insider trading going on, right? Me is killing me. What did I do, Akil? Can you explain moving the market against you with account size above 5 mil? I don't know the exact account size that you need to move the market against you, but essentially, think about it like this. If you're buying a large amount at one time, what happens when anyone else, what happens when institutions buy or sell a large amount? The market moves right away. So if you're buying a large amount at once, essentially you move the market against yourself, right? Because if the market's doing this, right? If the market's doing this on a big pop and you're buying a large amount, right? You may get filled here, you may get some filled here, some filled here. You're essentially moving the market against yourself because you're creating the movement in the market. So you're kind of getting the train started before you're all aboard. So you may want to get your position on here, but because the market's moving, once you're putting your stuff on, you may get filled right here. Think about it like trying to catch a breakout on a non-farm payroll, where you have your orders at a certain place, but because the market's moving so fast, you get slipped, 10 pips, 20 pips, 40 pips in some cases on non-farms. Was he moving the market, Charles? Oh, kill the broker. Don't take the trade. Don't take the trade. Here's the thing, right? And people blame the brokers. And sometimes brokers do some funny stuff. People tend to blame the brokers, right? Do your homework on trading. If you're involved in something where the market is like there's nothing, there's when you set a limit order, when you set any, aside from an at market order, even an at market order, any type of order, it doesn't guarantee your fill at that level. All it's basically saying is you're holding your spot in line. It's like, I put it back to, I used to be a big, like, I wasn't a big gamer, but I used to play video games pretty often. And I remember stuff would come out like, a brand new game would come out, and I would go to the video game store 2 weeks in advance and reserve it, right? I'd say, hey, here's $20. Can you reserve this game, right? And in hopes that I can get it on the release date. Now, just because I reserved the game, guess what would happen sometimes? Well, sometimes I was number 10 on the list. Sometimes I was number 1,000 on the list. And if I was number 1,000, and if the video game store only got in 900 copies, guess what? I had to wait until the next shipment. So it's no guarantee that I'm going to get it right away. And the same thing with your limit orders. You may put a limit order at 110.80s to get long. Well, guess what? If you're number, 10 million that has a limit order at that level, by the time the broker gets to fill your order, the market may be at 111 flat. Especially when the market's moving, hundreds of pips within seconds, like a non-farms, or like Charles said, if you're trading some obscure pair with light volume. The market can move pretty quick, and you may not get filled where you want to. And it's, don't kill the broker. It's not their fault. Now, sometimes it is the broker's fault, but in that case, it's not. Ooh, 30 pips spread on a 4-hour. Hey. That's why you should stick to the major pairs. You don't have to worry about that type of stuff. Stick to the major pairs. Stop trading New Zealand, Canada. Stick to the majors, and hopefully you won't deal with that. I don't think I've ever had a 30 pip spread. I'm pretty sure if I did, I would stop. Matter of fact, I stopped trading. I stopped trading pairs like pound New Zealand because I had like a 7 pip spread. I'm not giving you 7 pips per trade. 14 pips per trade, actually. No. Yeah, same thing. Yeah, the market moves so quick on the Swiss. Yeah, people got slipped. 50 pips, 100 pips. Euro in a Turkish currency. 20 pips all the time. Gosh, man. Yeah, but the broker did like you, but they encouraged you. Here's some other Turkish pairs, Charles. Trade all of them. Gosh. All right, guys, we're at about 10 o'clock. Is there anything else before we leave? I'm supposed to hit the weight room up and do some squats today, but I messed up my knee this morning. And I'm a little worried about it. Reminds me of an ACL type deal, and I do not want to do that while squatting. That would not be good. So I may pass on that. But anything else I can answer for you guys? Again, I may get sick this week, guys, just because I'm up some pretty good pips right now. I may get sick and just call it. Got to keep trading through. But starting the week well once again. But it's only Monday. Only Monday. Yeah, I really want to do that, Charles. It's been, gosh, I don't know how much you've been paying attention to our syndicate, man. I've been so streaky as of lately. Here's how my weeks have been. It's either been start off poor and then grind all week to get back to break even, or it's been start off really good and then slowly give some back and end at break even, like month by month for like last 2 months. It's been horrible. Building mental toughness though. I'm building character. Yeah. Well, I'll tell you what. And I was if I was gonna do this over. I was gonna make a video on Sunday, and I had other stuff to do, but I was gonna show an equity curve. I still maybe I'll do it today. I was gonna show an equity curve. We always talk about averaging 3%. If you can average 3%, you're probably you're in there with being a very good trader. I would say the best traders are maybe like averaging 5% a month consistently, which is about what's that 60% a year. Good traders are averaging 2% a month, which is about 24% a year. So if you're averaging 3%, you're pretty decent. And I was going to show an equity curve of what 3% looks like each month, and then I was going to show the equity curve from our syndicate, which we're up 35% for a year. But it's been, it's not a smooth 35%. We had basically for the last, I think, 8 weeks, we've kind of just slowly gave some back. But people tend to not look at the big picture. People tend to just look at what's happening currently. You look at the last few weeks, a lot of traders will do this. They'll get into a funk over the last few weeks and be like, man, I suck. My trading is so bad. But they don't look at the big picture. And I had to catch myself and do that. I'm putting the stats in. I'm like, man, 152 pips lost this week. Oh man, I really stink. And I'm looking at the equity curve. I'm like, wait a minute, man. We're up 35% for the year. Our goal was to do 36% for the year, right? 3%. We can just not make it. We could just break even the rest of the year, and we've hit our goal. And sometimes you need that. Yeah. Sometimes you need that. Because we tend to think of the now. We think we get too excited, and we do this a lot. Or Jason does it as well. We started off the first. I think we hit like 40% in the first 5 months, and we know reality is going to come, but we're thinking to ourselves like, man, maybe we can hit 100% this year. Like it's doable. If we get hot, it's doable, and that's just the competitiveness in us. But then you got to realize, hey, just because you may not hit that big number doesn't mean you're still not doing well. Just because you may not hit that home run, like Canada, I got stopped out of Canada. Just because I didn't hit that 1,000 pip winner or whatever I was looking for, it doesn't mean it was a bad trade. You still banked a little bit on it. So we got to remember to look at the big picture and not just what's happening recently. So I'll see if I can, maybe I'll do that. See if I can put together 2 curves. I think that'd be cool to see if it kind of follows what I envision it would look like. But we'll see. All right, traders, I will see you guys tomorrow. Until then, plan your trade your plan. Take care. All right, good morning, traders. Hope you guys can hear me okay. Almost forgot that I'm supposed to be standing up. Welcome to another week of trading. Today is the Q&A, of course. I do expect a pretty active week of trading ahead of us, though. I took a look at just the news. I always take a look at Forex Factory and see what news events are coming out, and we have there's a lot coming out, so we should be seeing some activity. So just keep that in mind, especially between Tuesday and Wednesday. A lot of news for Canada coming out, a lot of news for the pound, and we got some dollar news, I think, later in the week. But welcome. Hope you guys enjoyed your weekend. Hope you guys are ready for another trading week. Hello, Charles. Anna, as always, we'll jump start it with some Q&A. So many of you are what? Many of you are towards the end, I would guess, right, of your 12-week journey. Am I right in saying that? Of course, if you're watching online, the recording, you can't answer it. But I think a lot of you are the week last week. Yes, get you guys out of here now. No, I like the big groups. You typically get more. You typically get more questions from the big groups than the small groups. One of the things that really stinks about this Q&A, I love doing it for you guys, but most of you watch the recording or just are a little bit shy about asking questions. And when there's more people involved, we get more questions because more traders are at the same level. More traders are on Fibonacci's at the same time. And, when we get the individuals that, like Nazim just wrote, and we get the individuals that are just starting, sometimes they're a little bit shy because they don't want to seem like they're behind. They don't want to be like, everyone else is talking about Gartley patterns, and they're like, well, Akil, what's a Fibonacci? So losing the big group always stinks, but you guys aren't supposed to be in here forever. You're supposed to go on and become consistently profitable traders. The goal wasn't to have you rely upon us for your trading, hopefully future trading success. You should be able to go out and do it on your own. But you guys know you always have access to, Syndicate, Live Room. You guys get discounts and stuff, and are welcome to stay in that as well. But man, it goes so fast. It goes so fast. One thing I'm going to talk about today, I didn't have a lot planned. I didn't get any questions from you guys as usual. So wasn't sure what direction you guys want to take it. But yes, we can go over to fib inversion. Perfect. Sure. So what is this? Just delete this chart. We can go over to fib inversion. Of course we can. So the Fibonacci inversion is just a different way of using the Fibonacci extension tool. So typically we'll do something like this. The market has put in a starting point right down here. We've put in a new structure high. So we have that impulse move, that swing low to swing high. We've got ourselves a pullback. And what we want to use our Fibonacci extension tool to do is to predict where that pullback is going to go to. So something like this. So we expect to say, hey, the market's going to go to, let's say, a 127 extension, or we're going to go to a 1618 like that. The Fibonacci inversion tool is essentially used when you don't really have the move to draw the extension from, because you don't really have the move to draw the Fibonacci extension from because this recent move is still happening. You'll see that at a reversal of trend. And let me see if I can find an example for you here. Typically, you'll see this at reversal. Let me see if I can find something. How long do we have access to the 12-week transformation? You have access to the training videos and material. That's yours. Yeah, you guys have that forever. You guys had that forever. All right, so here's the example. Not the best example, but essentially the Fibonacci inversion tool is doing this. We're taking, this is not going to be a good example. I wish I should have shot me that question over the weekend. I would have found the example. All right, let's say this. Let's say the market is doing something like this. We're moving up, boom, boom, boom. And let's say we're expecting, let's say we're expecting a market reversal here. So let's say we get a sharp move down. Bank of Japan comes out and says something in the complete opposite of what we think, and we get the market moving like this, right? So we get the market moving like this. What does this tell us right here? What type of move is this? This is a lower low, lower close, right? What does lower low, lower close tell us about the markets, or what should we predict once we see that? Right, reversal, a rotation in the trend. We just went from being bullish. We should now look for bearish. Now, if we want to predict where the market's going to go next, we would normally use what? A Fibonacci extension, right? If we're saying, okay, well, where's the next counter trend move? Where's the next stopping point for this market? We would typically use a Fibonacci extension. But because, and you got to imagine this, because the market went straight down, we didn't ebb and flow, we can't really draw a Fibonacci extension tool from here to here, right? Because we don't know where the end of the move is at. Does that make sense? I can't bring my Fibonacci extension tool from here to here because this move is still in progress. Again, assuming that we didn't ebb and flow, we just one big bullish candle or something like that. So this is when I would use the Fibonacci extension tool and invert it. Instead of going from your typical current impulse leg, you'd go from the previous move. So you're still going swing high to swing low, but you'd go from this swing high right here to the previous swing low, the inside move. So you're going the opposite way. Instead of going from, typically we're going from left to right, now we're going from right to left, and I can use that inversion tool to predict a few levels on where this extension may come to. Why not the 2260 level? For what do you mean? Why not the 22? For what? 2260. Hold on. Trend reversal. Well, this our last outside return is right here. I mean, let's look at structure, right? We've got swing low to swing high. We've got outside return. Where does our new structure high come in at? Right? We're walking through the market. Where does our new structure high come in at? Right here, right? So this is our new structure high. Our previous outside return is here. So, the market breaking this level, market coming to right here, it's still within our outside return, correct? Yep. So remember, it's not a rotation until we break that previous outside return. We can come all the way down here, hit off there, and still be in a bullish trend because that outside return has not been penetrated. Yep. Let's see if I can find another example of a fib inversion for you guys. Here would be one right here. Let's say I want to predict, and this is all right. Let's say I want our short-term trend. Long-term, we're bullish here, but short-term, here's what we're doing: Euro Aussie, right? Swing high to swing low. Outside return. It's a little choppy. Technically, we consolidate, but look at the big picture of it. Outside return right here. I guess these would be our highs. Boom. So we're looking at something like this. Let's say price action decided to shoot all the way up here, right? We go straight up, and I want to say, hey, well, where is this market likely to extend to? Again, I have no place to put a Fibonacci extension to because I can't do something like this, right? Because if this market keeps going, well, then I just got to keep dragging it, and it doesn't really make any sense because we don't know where the stopping point is. We don't know where the last swing was at. So instead, I'm going to take my Fibonacci extension tool from our swing low here, back to my previous swing high, again, going right to left, not left to right, and back down. And then I'll get a level that I can see or look for an extension at. So am I correct in thinking the Fib inversion predicts where a new structure low or structure high will be? Not necessarily, no. It predicts where the market is likely to extend to. Think of it, it's the same exact thing as a Fibonacci extension, just a different method of drawing it on. But it predicts the same exact thing that a Fibonacci extension predicts. If the market expands or extends, where is the next stopping point? So I think we're saying the same thing actually. Just I wouldn't call it a structure high, structure low, because I think of that. I just different terminology, but I think we're thinking the same thing. But think of it again. It's the same. It's the same exact tool as the Fibonacci extension tool, just a different version of just a different way of drawing it on. Because again, Fibonacci extension tool, we would do it like this, right? We would go swing high to swing low, and back down to get our 127, right? Fibonacci inversion, same thing. It's still swing high to swing low. We're just taking a different point in there. And you can use the two together to gain areas of confluence. You can see right here, you would have a 127 and a 1618 lining up right at that level. So again, think different, just a different technique of using that Fibonacci extension tool, especially in cases where, you can't hit, where you literally can't draw on a Fibonacci extension. Griffin says, maybe you can go through your approach of the P part of IPDE, identify, predict, decide, execute. What is the basis of your system? Like some say they trade double tops and double bottoms, other trade 2618s. Well, double tops and 2618s, I would call that more of the entry technique. The P part is asking ourselves, where is the market likely to go? Before we get into that, any other questions on Fibonacci inversion? Again, guys, you want to, what I've been finding lately is a lot of people have been overcomplicating this stuff. Keep it as simple as possible. At least that's the way my brain works. But don't overthink the Fib inversion. Again, it's the same tool. It's literally the same tool as the Fibonacci extension. It's just a different method of drawing it on. Let me see if I can find one more example, and then we'll go to the IPDE. Maybe we can mix it together. Pound Aussie. And I'm just pulling pairs out of my behind. All right. Here's a great example. So price action is doing this. That's not a good example. I need a reversal. Well, yeah, it'd be a good example. Price action has done this, right? Swing low to swing high, outside return, swing low to swing high. Now, if I wanted to predict where this, say my prediction is that the market's going to go higher, and I want to predict a potential stopping point for if the market went higher, what would I do here? What would I draw on? What tool would I use? Let's just give these things some labels so you can see. I would use a Fibonacci extension. Where am I drawing my Fibonacci extension from? Yep, from A to B. All right, so I want to predict where the market's likely to go up here. I'm using my Fibonacci extension tool, swing low to swing high. And I'm saying, okay, well, here's my 127, here's my 1618, and of course I'm lining that up with, any potential structure. Now, again, let's say we have a trend reversal, right? So we're in a bullish trend right here. What happens if the market does this? Does this violate the trend, guys, if the market spikes right down here? If we break and close beyond this, does this violate the trend? Yes. The trend has been violated. Now, in some cases, this movement will look like this. It's not always clean. And in this case, you can draw Fibonacci extensions, right? You can go boom, boom, and predict different levels. Sometimes you'll get moves like this where the market just goes straight down. So let's say the market goes straight down here. Your current candle is here. You have no type of retracement. So you can't take a Fibonacci extension from here to here. Does that make sense? Right? You can't use it because we don't know where this leg has finished. So we can't use a Fibonacci extension. Give me a yes if that makes sense. And if it doesn't make sense, give me a no. This is the Q&A. Again, it's not, check your pride and your ego at the door. If it doesn't make sense, tell me. You guys are paying good coin for this class, so let me know. If I can't answer it, then, send you somewhere else. All right, Gabriel, what doesn't make sense? So you just have no idea what we're talking about. Okay. Does it make sense that we cannot draw a Fibonacci extension tool from here to here because we don't know when this move, we don't know where the end of this move is going to be at? Okay. Well, it does make sense. Right? So this is where we would use that Fibonacci inversion. Right? We can't make a prediction from here to here, but we can do our previous swing high to our previous swing low. Again, this is still our swing high to swing low, it's just backwards. And you would use that Fibonacci inversion tool like that to then make your prediction of where price action is likely to go. So again, you're still predicting an extension because you're predicting the market's going to extend beyond where it's at, basically. It's just a different way of doing it because it's that reversal type of move. All good? Yay, nay? I think I get it. Well, the cool thing is you have these recordings. You can always go back and watch them over and over again. And of course, the best thing to do is go through literally just find some charts, just scroll through them and just start drawing these things on, start drawing inversions on. And the more you go through the process, the more it makes sense. Now, Gretchen wants to take a look at the prediction part of IPDE. So identify, predict, decide, execute. And the prediction part is really no more than we can using those Fibonacci tools and using structure together, and of course harmonics in essentially predicting where we think the market is likely to go. So let's take trying to find another random pair here. Let's go Euro Yen maybe. I'm not sure what these pairs look like. I don't believe so. Man, do we have any, let's see if I can find, do you have any pairs that are above structure or anything, guys? Let's see, go to my dailies real quick. A lot of these pairs are really just in no man's land. Where are we likely to go? Anyone else having mic problems? Just you, Jason. All right. So here's an example right here on Euro Aussie on the daily. So the question that Gretchen had was going through our process of IPDE. And for you guys that are newer, that's the process that we go through every time we look at a trade. It stands for identify, predict, decide, and execute. And Gretchen's question was on the prediction part. How do we make our predictions? So we'll walk through the process. And the first thing we want to do is identify what is the market doing, guys. Most recently, are we bullish or are we bearish? What do you guys think? Are we bullish or are we bearish? What is the current market condition? Are we bullish? Are we bearish? Yeah, we're bullish. We have this going on. We've been putting in higher highs and higher lows, right? Higher highs, higher lows. Most recently, the break and close above structure. So we are bullish. Now for the prediction part, the question is, where is the market likely to go? And what is the main thing that we're looking for? What leaves clues? What acts like a magnet in the market? What is the main predictor of where price action is likely to go and or stop and or reverse next? What would you guys say? Structure, structure, structure. And what's the trick we use to identify structure? It's got 2 L's in it. Starts with a look. Yeah, look left, look left. So we look to the left of our screen. We have violated this level of structure. So we've already got a higher high, higher close, right? Pretty obvious on this chart. Where is our next level of structure? Right here, correct? I wouldn't even worry about the even handles too much. Those are good psychological levels, but structure is going to be the most important thing you look for. Especially if you're in the higher time frame. Even handles aren't going to, I mean, look at the even handles on here. You've got even handle, even handle. These aren't going to really tell you too much. So they're important in their own right, but structure is going to be the main thing you're looking for. Right, so look left, structure leaves clues. Here's our next structure level. So it's safe to say that if price action continues up, right? I guess I should type this in. Where is? If price action continues up, we should hit this level. So this is good. This is the level on our radar. I fully expect this level to get hit. Now, the next question we want to ask ourselves, and this is where the prediction part comes in. Prediction is kind of a two-part thing. It's, let me finish this. I can't talk and type at the same time, apparently, guys. But it's a two-part thing for prediction. One is, where is the market likely going to go next, right? That one's the easy one. We look at structure. And the next part is, how are we going to get there? And that's really the prediction part that we used in our everyday day trading. So we know the market's going to come up here. We don't know, but we predict the market's going to come to this level, right? Somewhere up in this structure level up here. The question is, how are we going to get there? And there are typically two ways. Really, there are only, if the market's going to get there, there are only two ways it's going to happen. Should we take the body of the candle for what, Nazim? To identify the level? I like to take the, if you're going to draw the zone, I would take the highest in this case, because we're going up. I would take the highest high to the highest close, that zone, and then vice versa, the lowest low to the lowest close, if it was support. So for resistance, highest high to highest close. This is as high as we can. This is as high as the market has gone here, 53.36. This is as high as the market was able to close at, 52.22. Both of those are very important. The close is very important because that tells you that someone pushed down, the sellers pushed down price at that level. They did not want to close above that level on this time frame, of course. The highest high is important because that's where the market was able to get to before getting rejected. So I draw the zone between both of those points. That's what our DSR indicator is going to do as well. But for a target, oh yeah, I would always go with the close instead of the high or the wick for targets. Yeah, unless you're in need of a few extra bucks, the close is going to be a much safer place. And for targets, again, I want to get my money off the table as safely as possible. I am not a gambler. I am a gambler, but not in these markets. But I don't want to get greedy for an extra few pips. If I'm in a winning position, I want to get out of it and put some money in the bank. That's my first goal. No need to get greedy. But going back to our question, how is the market likely to get there, guys? There are two ways. What are they? If we're predicting that the market's going to come up to that zone, that box I just drew out, how are we likely to get there? Two ways. Yep. We can go straight up, or we can get an outside return. So our predictions look like this. If then thought process, if price action continues up, then I'll look to get short right here. If price action goes down, then, again, look left, structure leaves clues. Then I'll look to get long here in anticipation of this move. And now when you're setting up your trading day, you have basically two things to think of. You have a plan for what you're going to do if the market goes higher today. You have a plan for what you're going to do if the market goes lower. Make sense? And then you just wait for the market to tell you what it wants to do. If the market goes up, you just wait. You wait until it goes up and wait for that short position. If the market goes down, then you just wait for that potential trend continuation trade, assuming that you're allowed to trade that type or that style. If the market goes sideways, then you sit back and count the money you didn't lose by trying to be too aggressive. Would you enter the trade if there's no retracement? You mean right at would I just enter right now at market in anticipation of going to that level? No, I would not. For two reasons. First, I have no idea if the market's going to go up to this level. Yeah, so I have no idea. So I never want to put a position on when basically no man's land. And here's the main reason. If I were to get long right here, right, I would anticipate profit taking up here, correct? Would you guys say I'm right? You would probably look to take profits right at the close of this zone. Yeah. Here's the problem. Where do stops need to be? Stops need to be where I'm wrong at, right? Here's where stops would have to be. All the way below these previous lows, our previous outside return. So with this, I'm looking at an inverse risk reward of about what, 3-to-1 maybe? 2.5-to-1. Basically 2-to-1, which means I've got to win 2 out of every 3 trades I take like this just to be at break even. And in this case, I wouldn't be at break even. So I've got to win 3 out of every 4 trades essentially. So I got to be a 75% trader. So I wouldn't hop on it at market because there's no safety. There's no way I can put stops. And I have no reason to think right now. I really, it's a coin flip right now whether the market's going to go up or down. Does that make sense? I couldn't tell you whether the market is more likely to go up there straight or to go down and retest first before going up. I can tell you that structurally and technically speaking, that we should get to that level, but I have no idea how I don't know the path. I have no idea how we're going to get there. So by just trying to hop on it right now and take a trade at market, it's essentially like me closing my eyes and flipping a coin. What if there is some fundamental favor of the trade? That doesn't change our risk reward, does it? If we have some fundamental news coming up that says euro is going to explode and the Aussie is going to get shot down, right? And we're saying, oh man, everything is saying long. Like for example, I want to be long the pound dollar this week. I want to be long the pound dollar. I want to be long the dollar yen. I think those markets are going to explode. I really think the dollar yen is going to explode up. Pound dollar depends on Tuesday's data, which I'm not going to be awake for, so I'm going to miss it. But you guys over in the UK, you're going to have a field day with that pair potentially if you can get on the right side. But even though I want to be long this, right? Let's say I want to be long euro, I want to be short Aussie, I want to get long this pair. Fundamentally, it doesn't change anything about my situation, right? I'm still looking for targets right here. I'm still looking for stops down here. I've still got to be 75% just to break even. I've also got to be willing to risk, and we shouldn't even do it in pips because this is just a general example. But I've got to be willing to risk a lot more than what I'm willing to gain. And I don't want to put myself in that situation. Now, I would say this. I think it's okay to have a fundamental bias as long as you trade the technicals, right? I do a lot of, I have worked extremely hard to make myself knowledgeable about fundamentals. I am at the point in my trading career where I'm starting to develop fundamental biases. If you ask me a question on the fundamental side about whether I want to be short or long something, I can tell you that. But here's a perfect example. But I would say this. You can't trade. You can trade off of both, but one has got to be the core of your trading. You've got to choose. Because when it comes down to making a decision, if you're trying to do both, you're going to end up bouncing all over the place and dealing with what we call a confirmation bias, meaning that whenever you think the euro should be long, you're going to ignore short opportunities and only look for long opportunities and vice versa. And that's going to get you in a lot of trouble because there's going to be no consistency in your trading. I think it's okay to have a fundamental bias as long as you're still executing your trades for a technical reason. Good chance that there's a very good chance that Bank of Canada may cut rates, or at least be more dovish this week. They have I think they have a statement on Wednesday. Fundamentally, I think this pair is going to explode up and break past this previous structure level. If you ask me, I think we're going to blow right past here. We're still in a bullish trend on the weekly. If I zoom out, I don't have a weekly chart for you. If I zoom out, we're still in a bullish trend on the weekly. But I think there's a very good chance that we explode past this level. However, as you can see, we have a beautiful Gartley pattern there, right? As a technical trader, what do I do in this scenario, guys? Assuming, let's say I'm not trading this Gartley because there's too much risk to it, obviously, but say I'm a daily trader. This is my trading time frame. I've got this fundamental bias that says, oh man, Canada's going to tank. Dollar is going to be strong. I want to be long this pair. What do I have to do? I've got to take this trade because my trading plan is not dealt off fundamental ideas. It's dealt off the statistics and doing the same thing over a period of time. So the only place I think it's okay to have those biases is if your technicals line up with your fundamentals, using it for extended targets. So let's say that we expected strength in the dollar CAD this week, and fundamentally you're saying, okay, everything fundamentally has told me to get short Canada, and now you have a Gartley pattern that matches that idea. Well, now it's okay, in my opinion, and you got to make a decision. You want to be consistent about it, but it's okay to say, okay, well, I'm going to shoot for an extended target level, maybe in a trend continuation type of scenario, because now the fundamental, the bigger picture is lining up with the technicals. And I hope that didn't confuse a lot of people. There's a time and a place to do it. I guess that's what I'm trying to say. I'll do a structure up here. But all trading decisions, as far as execution, entering the trades, all of that should be based on technicals and not fundamentals. Trade it if your plan is to trade all Gartleys you identify. What other way would your plan be? Aside from trading all Gartleys that you identify. I don't think there's any other scenario. I think it's a very poor idea to hunt and pick which advanced patterns that you're trying to trade, if that's what you're getting at. Not sure if you were. I think it's a very poor idea. I think it's a very poor idea to say, I'm going to trade this Gartley. Oh, but tomorrow I'm going to trade that Gartley. I'm going to pass on this Gartley. Because you'll find out that some of the trades that you don't want to take are typically the ones that do the best. Yeah, the trades you don't want to take are the ones that typically do the best. The ones where, like, we got an example coming up on New Zealand dollar. We've got forgot to adjust my monitor, so it's a little weird. Hold on. New Zealand dollar here. Good example. New Zealand dollar, we've got a bullish bat pattern here, right? What's the overall outlook on the Kiwi, guys, on New Zealand? Maybe this will make it easier. What direction do you want to be involved in on the Kiwi? Not even caring about the fundamentals, and they may cut rates again. I made a video the other day about not wanting to be a ABCD pattern or 3 drives, about not wanting to be long the Kiwi, right? We want to be bearish. However, we've got a bullish pattern. Guess what I got to do? I got to take it. I got to take the pattern. In my back testing, I did not quantify patterns that were bearish patterns in bearish markets or bullish patterns in bearish markets. Nope. You took every trade. So that's what you got to do when you're trading with these advanced patterns. Once you start hunting, once you start picking and choosing which ones you want to take, again, assuming they fit your rules, some of them will be above your pay grade. The risk profile will be too bad, something like that. But all else equal, you start picking and choosing which ones you're going to take, then you're just trading randomness in the market. You're just it's just random. And again, once you're random, it's like a coin flip. It's like, hey, it's maybe this time I'll win, maybe that. There's you have no control over it, and you usually end up in a bad position. I'm still trying to understand what would make you go long the dollar. Would it be what would make me go long the dollar CAD? Technically, well, for me, nothing technically. Technically, everything's saying bearish. There's nothing technically here on this time frame that says go bullish. Going back to the dollar CAD. But I was using it as an example. Again, my fundamental bias is bearish. Or I mean, my fundamental bias is all bullish for dollar Canada. If I were trading off of fundamentals, I would want to get long. First of all, the dollar is strong. We know that. Second of all, I think we have some bad news coming out for Canada. But technically, everything is saying bearish. And if you're a trader that tries to trade both, you're going to get that paralysis by analysis. You're not going to know what to do. You're going to be like, oh, the fundamentals say bullish. But there's a Gartley in their structure that says bearish. What do I do? Do I do this? Do I do that? And you wind up either making no decision or you make an emotional decision where you start seeing the market move like this. You're like, okay, I was wrong. Let's get bullish right now because the market has gone up 68 pips today. And you break your plan. You usually goes downhill. But yeah, I have no reason. I would love to get bullish. I have no reason to get bullish on this time frame. There's nothing telling me that until we break and close above this structure level. If there was a place to get bullish higher time frame, it would have been down here. We were actually looking for areas down here. We just never got the opportunity. We caught a few opportunities down here. We never got the long-term opportunity. Yeah, you got to take all trades that meet your rules. You are more likely to pick and choose with structured trading. Am I right? Yes, you're more older. Yeah, there's a lot more analysis that goes into structured trading. The pattern is the pattern. With structured trading, you do want to be on the correct side of the market. So you can have a double bottom in the middle of nowhere, a double bottom in the middle of a bullish market, and you're gonna have to pass on that double bottom because it makes no sense to try. Or I guess it would be a double top in a bullish market. You wouldn't want to trade that double top in that bullish market. So the structured trading is a lot more that good. There's a lot more analysis that goes into it. You want to align yourself up with the underlying market direction or what you think the market's going to do. And that's why I say it's a bad idea to try and trade double tops like an advanced pattern. Advanced patterns, there are a lot of moves in there. They're a lot more powerful than double tops and double bottoms. Double tops and double bottoms really aren't anything, to be honest with you. They don't really have too much importance at all. They have importance only if they come at certain levels. Again, if we came down like this and got a double bottom right here, is this a buy, right? Am I buying it right here? No, because there's no reason at all, right? It's a double bottom, yes, but guess what? Every time this happens, it's a double bottom, basically, right? At some point. At some point, this is a double bottom. So yeah, with those simple patterns, it's more about the overall market and where the market's at and really structure than the actual simple pattern. Same thing with ABCDs too. And again, those are just, in my opinion, those aren't strategies. It's a bad idea to be an ABCD pattern trader or a double bottom, double top trader by itself because you're going to get eaten alive. But those are tools that you can use. Those are techniques you can use to do your analysis in the market. When you get an ABCD pattern that double bottoms at previous structure, now you're starting to build that case. You're starting to put those clues together and really build that case for entry in the market. So advanced patterns are simple. That's why a lot of traders, newer traders, flock to them because it doesn't take a lot of thinking. It's, hey, if it completes, you trade it. Structured trading, it takes a lot more analysis, which is why traders often flock to structured trading. Those of you that will go on to be good, you will often find yourself flocking to structured trading because it works that part of your brain more. You get a lot more. It's, I don't say it's more beneficial. I don't know the word for it. You just typically, if you have a passion for the markets, you typically gravitate towards that. If you have a very, very, very strong passion and the time to trade it, you typically gravitate towards that because you're doing more analysis in the market. You're seeing more. You're getting better at deciphering the tools. If you're just worried about making money, then those are, you advanced patterns, mechanical systems, stuff like that. But you'll see a lot of traders start with patterns because they're easy, use that as a way to make some money. And then, when you're looking for a pattern, say you're a swing trader, right? You're looking, you may have a pattern on the radar for 3 days in advance. You got nothing to do all day. And if you have a passion for the market, you find yourself going back and looking at market action. And the more you look at it, the more you start to notice things. The more you start to notice things, the more you start to think of ideas. How could I trade this? And you just eventually go back to the basics, structure and price action and stuff like that. It's very interesting. You go from simple to advanced, back to simple with a more advanced way of looking at it. I remember I used to trade breakouts and triangles and stuff like that. I'm getting back into that some more. At least that's my next goal, to get involved in more of these flag patterns. Those are brilliant patterns: flags, pennants, triangles. Again, trading all of them, probably not a good idea. But trading them the right way, like we saw from New Zealand the other day, when you get something that's doing this, these ascending triangles. I mean, look at the last few pairs we saw do this, right? We saw pound Aussie breakout, we saw euro pound breakout, we saw New Zealand dollar breakout. Those are brilliant. Those are brilliant strategies to trade, or brilliant, I guess, techniques to trade. The hard part is doing it the right way, consistently. That's the hard part. So, all right, we got about 10 minutes left. Good day, good talk. Is there anything that you want me to go over again that we talked about today? We talked about Fibonacci inversions. We talked about making predictions. We talked about fundamental and technical biases. Can we look at the RSI? Sure. What's your question about the RSI? Hidden divergence versus normal divergence? Sure. Hidden divergence versus normal divergence. Hidden divergence is, or normal, let's put it this way. Regular divergence is going to come in a counter trend move. Hidden divergence is going to come in a trend continuation move. So a good example of regular divergence is like this. Price action is going up. Boom. We're putting in higher highs. The RSI is going up. We're putting in lower highs. Make sense? Regular divergence, higher highs on price action, lower highs on the RSI. There was actually where was that article? I'll give you the article I wrote. I did a blog post with Trading Powered on it. Just I go to Central Bank. I'll remind me before we leave. I'll show you some sites. But yeah, this is RSI divergence. So regular divergence, higher highs on price action, lower highs on the RSI. What do you mean by do two things have to line up? As the market is giving you higher highs, the RSI should be giving you lower highs. Does that make sense? As price action is giving you higher highs, RSI is giving you lower highs. Good example is right here. We look down at Canada, right? Price action is giving you equal and lower lows right here. RSI giving you higher lows. Nope. Divergence means it has to be the opposite of what price action is doing. So if it's exactly the same, you can go in and measure it if you want the exact little digits. If it's exactly the same, it's not going to be divergence. It means they got to be different. So if you have equal highs on RSI and equal highs on price action, then it's just nothing. So price action is doing one thing, RSI is doing another thing. Now, hidden divergence is the opposite. This one's a little bit confusing. You probably don't want to worry about it yet. I think you're gonna if you say you just started, trust me, my recommendation is take the course 1 week at a time. Because what's going to happen is you're going to learn a lot of stuff, but you're not going to master any of it. It's going to go all through one ear and out the other. So my advice is to focus on one thing at a time, and hidden divergence probably isn't something you want to focus on. But here's an example, let's say, of hidden divergence. Let's do a bullish example. Let's do a bullish example. All right. So say price action is doing this. You're looking at the opposite side now. You're looking at the bottoms. Price action is putting in higher lows right here. Let's actually do this. Let's make it easier. Boom. Looking at a pullback. Price action is putting in higher lows because we're in that trend continuation opportunity. We're putting in higher lows on price action. RSI is doing the opposite. RSI is putting in lower lows. That's going to be the hidden divergence. Essentially, you're looking at hidden divergence for trend continuation opportunities. So you're looking at the pullbacks. For regular divergence, you're looking at counter trend opportunities or when the market's going to run out of steam. You're looking at the extensions. My advice, don't worry about hidden divergence. Especially if you're just starting off, it's gonna confuse you, and then you're gonna mess that up with regular divergence, and you're gonna end up having paralysis by analysis, where you think you're seeing one thing, you think you're seeing another thing, but you're really not seeing anything because you're just confused. That's my advice on the two. Because typically I find traders not an issue, but traders find it difficult to look at regular divergence. And when you add something else, it just blows the brain up. Does that help you out some? Did it confuse you? Probably did a little bit. Yeah. Well, again, think about it like this, Gretchen. Regular divergence, counter trend. So you're looking at the extensions. You're looking at the new structure highs or new structure lows for regular divergence. Regular divergence is counter trend. You're looking at new structure highs in a bullish trend. You're looking at new structure lows in a bearish trend. Hidden divergence is trend continuation. So you're looking at pullbacks. Bullish or bearish, you're looking at pullbacks. All right. Hidden divergence, you're looking at the pullbacks in the market. Regular divergence, you're looking at the new structure highs or new structure lows. I know the definitions. I just don't understand why hidden divergence signifies trend continuation. Oh, okay. She said at the beginning. Well, here we have price action. We have price action trading right here, right? We have the market extending up. We have a pullback, right? We have a lower low on the RSI. RSI is telling us more selling pressure right here, more selling pressure right here than what there was right here, but the pullback is shorter. Right? If we saw equal selling pressure, you'd think that we should see equal selling pressure be able to retrace to the same level as before. We're seeing more selling pressure at an area, but the market is unable to push, or more strength, I should say, or less strength at the area, but the market isn't able to push as low. So think of it like this. The bears are trying as hard as they can. The bears are trying harder than before to push the market down, but they're making less progress. So they're putting in the same effort, or even more effort to push the market down as they did previously, but they're making even less progress. Follow me? Because you would think, right, if they're putting in more pressure, if they're trying harder, they should be able to push the market down harder or further. But they can't. They're trying harder and they're getting a worse result. Good sign that, hey, they're going to give up and just say, you know what, I'm done fighting at this level. Let's wait for another opportunity. Greta says higher highs will usually get higher lows. Yes, correct. Yeah. Higher highs on price action should give you higher. The RSI and or whatever indicator you could be stochastics, MACD. Price action and the indicator should be in sync. So if price action is giving you higher highs, then so should the indicator. Now, Jason says, good book called RSI, The Complete Guide. I'll tell you what, if you read that, they're going to tell you the exact opposite of what you ever heard about RSI. So I urge you at this point in your trading not to read that book, unless you're so disciplined that you're going to take it for what it is and not look to change your trading. I would warn you that. Have you read it, Jason? It's a completely different look on how the RSI is used. So I would encourage you guys at this part of your trading, don't read it, because I think it's going to harm you more than it's going to help you. It's going to have you second guessing a lot of things because you're probably not as confident in your trading right now. And you're still kind of in that sponge mode where you read stuff or you hear stuff and you're taking it in and you're going to try and implement it. So I would not recommend reading that book. Now, I mean, in the future, it's a good read. It's very interesting. I actually enjoyed its take on the RSI. Now, I read it when I was at the point where I had no intentions of using anything I read in the book. So I read it with that mindset involved. But yeah, that's one you save. That's one that I don't recommend reading. How about that? Let's put it like that. I was going to say save till later, but that's a book I don't recommend. It's going to have you drawing all types of, your RSI is going to end up looking like this. You're going to be measuring. This is how your RSI is going to look. Yeah, but it explains an entirely different technique for using it, which is essentially different than most of what you're taught out there. It essentially explains a way that you can trade. You can trade price action without even looking at price action, only looking at the RSI. Here's a way to use it. Like I said, this was the same strategy. Remember I told you the story? Some of you guys may remember this. I told you the story about a trader we knew that had a strategy that was about 90% correct. It was this strategy. Yeah. It was with the works of and John Hayden didn't do the work. He just wrote about it. Someone else did the work. But it was these works, yeah. And it so much had to happen. You had to see, I don't remember the whole deal, but you got to watch the RSI. It's got to dip above 80 and then go below 66 point this, and then pass the 50 line, then come back up. Then the second test after it redips again, and then you hold it until it's confusing. But yeah, he had a strategy that was about 90% correct. It only gave you like two trading opportunities a year, though. That was the problem. You got about 2 trades a year. Maybe like 5 trades a year, though. I mean, we'll give him some credit. Maybe like we tested it live. It just wasn't a lot at all. Like 5 trades a year on a 60-minute chart. Yeah, so it was yeah, it was good. It just didn't, genius guy. It just didn't offer the opportunity needed, which was the problem. You need opportunities. You can have a brilliant strategy. If it doesn't happen, you can't trade it. Like, what's the point? It's like having a big fancy car in your garage with no gas pedal. Looks nice, but you don't really do nothing out of it. Anyway, let's call it a day. A lot today, so make sure when Charles gets this up, go back and watch the recording over and over again. And we got to practice this stuff, guys. You got to practice it. I'm telling you, it means nothing if you just watch the recording and do nothing with it. You gotta practice it. I'll see you guys tomorrow in the live room. I'll probably see you guys later today for Syndicate video. There's a lot going on, so I might have to record something. We'll see. I gotta go to the dentist, so I'm not sure if I'll be able to talk later. Not that I can talk now, but see you guys tomorrow. Until then, plan your trade your plan. Best of luck in the markets. Guys, good morning. You wanted sound, so that's what you get. You get sound. How's everyone doing today? Good. Great. Small room this morning. But we got Charles here, so that's all that matters. So welcome to another 12-week transformation training. As always, if you guys, well, not training, but a Q&A session. It used to be technically a training session. Now it's more of a Q&A session, since we have we have people venturing in at random points in their trading career. Some of you guys are very new to the 12-week transformation. Some of you guys have been here for a while. Now, I'm trying to look for the quote. So I had a quote I wanted to start the day with. It was someone that left it on one of my YouTube videos. There's so many. Here it goes. Ian wrote this, and it's from the Market Wizards book, the first one, I believe, which is, in my opinion, the favorite one. I wasn't a fan of the new one or the one after that, but he said it was a question they asked to a trader. The trader name was Michael Marcus. He said, "What other advice would you give to a novice trader?" And he said, "Perhaps the most important rule is to hold on to your winners and cut your losers. Both are equally important. If you don't stay with your winners, you are not going to be able to pay for the losers. You also have to follow your own light, because I have so many friends who are talented traders. I often have to remind myself that if I try to trade their way or on their ideas, I am going to lose. Every trader has strengths and weaknesses. Some are good holders of winners, but may hold their losers a little too long. Others may cut their winners a little short, but are quick to take their losses. As long as you stick to your own style, you get the good and bad in your own approach. When you try to incorporate someone else's style, you often wind up with the worst of both styles. I've done that a lot. The question I have for you guys is, what do you think your strength is? Do you think, and this is for you guys that either are actively trading right now or just have had trading experience in the past, do you think your strength is holding on to winners? Do you think your strength is cutting losses early? Do you think it's both? Is there a weakness in there? Is holding on to winners a weak point for you? Is it a strong point for you? What do you guys think? Just do a little self evaluation real quick. What do you think your strength and weaknesses is or are as a trader? What would you say? I would say me personally, I could do a better job at cutting losses early. I think Jason does a wonderful job of getting out early. He typically has much smaller risk appetite than I do. I'm a little riskier. I like to give the market breathing room, and I often take when I lose more than what I could have lost. Um, Now it helps me out on the flip side because I do get saves sometimes, but I think I could do a better job of cutting losses early. I don't think I'm too bad at winners. I think I'm pretty good at getting the most out of a trade. So I would say my weakness is cutting losses early. I can do a better job at that. Either they're in deep thought, Charles. They have no idea. What do you think, Charles? What is yours? If you have a weakness, of course. Charles is like, what is weakness? Seriously, guys, you have no opinion. What do you think? Or have you not gotten that far to even realize what it is? I think my weakness is that I don't give the market enough room to run. My stops are usually too tight. Okay. So cutting losses a little bit early. In the past it is. Okay. Gretch is like not that far yet. You got a few other people typing in. And it's gonna lead over to um, an idea that I'm gonna show you. So it's not just a random question. Let's give a few more seconds for these guys to type in. I get stopped out, see the market rally 150 pips in my favor. Yeah, that's one of the reasons that's one of the reasons my losses aren't as tight, or my stops, I should say, aren't as tight as they used to be. That happened to me a lot where I was barely stopped out and then it rolls around. So that's one of the reasons I started giving a little bit of extra breathing room. But as we always talk about, there's a give and a take to everything we do in trading. You give the market a little extra breathing room, it's going to save you in some of those it's going to save you in some of those trades. But also those losing trades, you may consistently take 2 times your loss, or you may consistently add 10 pips to each loss. And when you add 10 pips to each loss, that eventually adds up. It eventually adds up. I don't know with Forex, but with stocks, yeah, stocks, Forex, any market, it's all the same. With stocks, I tended to hold too long without an exit plan. I was the same way. Well, I was the exact opposite. I wouldn't hold on to my winners long enough. I was talking to a buddy of mine yesterday about trading, and I was telling him about the stock market. And, my big story, the big story I like telling people because they're familiar with this one is Apple. I bought Apple at $99, right? And whenever I tell people that, oh, you bought an Apple at $99, you're a millionaire by now. And I'm like, well, no, I sold it at 200. And they're like, well, why did you do that? Well, because in hindsight, I doubled my money, right? So in hindsight, it doesn't feel too bad. But looking back at it, I have, aside from me doubling my money and saying that, okay, well, doubling your money is good. If I give someone $1 and they give me 2 back, that's positive. I had no exit reason for it. And that was one of my weaknesses in the stock market. I would kind of go to just a point where it felt like the market gave me enough, and I wanted to put some money back in my account. So I was kind of opposite of you. You said you hold too long and you watch it retrace. You're like, oh, it's going to come back. It's going to come back. And it never does. Charles says, I tend to be more risky in my entries, but I like to know where I'm getting out, which means I never thought about holding on to a trade for a trend move. I prefer to be in and out in a set rule. I have dabbled in some trend ideas before as well. I think it comes down to patience for me. I think it is. I think one of the issues with holding on to longer targets is it's really the fear of leaving money on the table. You know, one of the good things about having set targets is that, you know, when they're hit, they're out, money's in your pocket. Once the money's in your pocket, the whole world is great, right? Everything is great once money's in your pocket. That is until the market spikes up 150 pips in your direction. You're like, oh, how come I didn't get that? Coulda, shoulda, woulda. On the flip side, the problem is when you're shooting for those bigger targets, it's the exact opposite. The market's shooting up to those bigger targets and starts retracing, and you're like, oh man, if I just would have took it out already, I could have had 50 pips in my pocket already. That's tough. So how do we solve that? How can we solve those these emotional issues? Anybody? How can we kind of find a middle ground? Each person's comfort level is going to be different. How can we find a middle ground between making us feel happy, pleasure? Because again, what do we want to do? We everything we do as humans is to gain pleasure and avoid pain. So how can we gain pleasure, but at the same time, you know, not be so scared, not be so fearful that we kind of get pain from the what could have been? And I had there's another quote this morning I heard on my buddy Brandon Clay's podcast, which in about a month my interview will be coming out. He's got it on the shelf. It's so great he couldn't release it at at first. I'm waiting to hear that. What did I say this morning? Sometimes we become overconfident because we don't have enough confidence. Maybe that doesn't relate. That's a good quote anyway. Sometimes we become overconfident because we don't have enough confidence. Well, let me get my screen back up. But yeah, I agree with Charles. Charles, I think we talked about this idea before. In going for an extended target after the first targets are hit or stop is break even. And a perfect example of this is the pound dollar trade. Now, are you guys familiar with this trade? We talked about it a lot last week. I know not everyone's in the live room with me, but do you guys remember what we've been looking at on pound dollar? Or what you've been looking at in your analysis on pound dollar? If not, we can always start over a little bit. Do some price action analysis. All right. What's this going to be down here? We're thinking just reading a price chart, the basics of reading a price chart. What is this down here? Yeah, no. I'm learning, Gretchen. I'm still learning this educational thing. Got to remember, you guys aren't as smart as me. No. A lot of you guys are much smarter than me. I'm not the smartest person in the world at all. I just wanted to say that because it sounded very cocky. It was great. You guys will never know as much as I know. So listen and don't speak. But this is our starting point, right? We go from our starting point. This is our swing low to swing high, right? New structure high right here. We go, boom. What is this right here? This is day one 12-week transformation stuff. Outside return, right? Pretty simple. This stuff is, for you guys that have been here for a while, this should be second nature for you. And hold on, let me turn off my, man, when you know, I just can't have the tablet or the phone on because everyone's buzzing me up with emails and whatnot. Leave me alone. Just leave me alone, please. All right. So we got our outside return. Outside return is followed by, boom, what is this? Bang. New structure high, followed by another, boom, outside return. All right, you guys are getting the hang of this, right? Followed by, what is this up here? New structure high. So we're going through our IPDE process: identify, predict, decide, execute. What we identified, new structure high. You guys have done that already. Well done. What is our prediction when we get a new structure high? What is our prediction? I'm going to go over to a white screen real quick and just draw this in. New structure high. First, what is our overall prediction? What is the market? Let's start. There's going to be two questions. First question: what is the market likely to do? Right? Trend continuation. Right? We're predicting the market's going to go higher, right? Yep. Bullish trend, long. So that's the first question. First question is the market likely to go higher or lower? Is the market likely to go higher, new structure high? The next question is, how are we likely to get there? And there are two different ways, right? We can either just go straight up, or, and this is what you guys said before, you guys are so good, you're ahead of me already, or we can pull back and then go straight up. And of course, the market can crash all the way down, but this is just a prediction, right? So as soon as we're at this moment right here, I'm saying that, well, if the market's going to pull back, where do I expect it to pull back to? Where's the first area? Our previous structure high up here, correct? Let's make this a little thinner so you can see it. Would you guys agree? The first area that I would predict the market to pull back to is going to be our previous structure high. And if we're going to continue up, where's our next level of structure? This is a little difficult. There's no real major, there's a bunch of minor little blips in here. There's no real major structure until probably here at 6,400. We can worry about that a little later. So in my mind already, what I'm thinking is bullish continuation, bullish continuation, bullish continuation. So that's what I get from the daily charts. I don't place trades. I don't execute trades off the daily charts. I only use it to do analysis like this. I only use it for the big picture. I go down to my lower time frames. I'll go down to the 4 hour. You know, the 4 hour in the daily chart will essentially give you the same thing. I go down to the hourly, and here's what I saw this morning. So I have that big picture idea in my head, right? But I'm not really too concerned with it. It's in there, but it's not the biggest deal in the world. I go down to my hourly, and I say, okay, well, this looks like an impulse leg right here, right? We break structure looking left. Or maybe to align that thin wasn't the best idea. There we go. This looks like an impulse leg, right? So I can call this, where are we at here? Drawing tools, there we go. I can look at this as being, right, a swing low to swing high and X to A. I've got an A to B right here, initially. Would you guys all agree? Give me a yeah or a Y. Yep. So I'm scrolling through. Can I scroll through? Oh, I can scroll through one chart at a time. Nice. I'm on TradingView instead of Ninja. Mainly because I like the little shiny things over here. It makes me look like a professional, like I'm actually reading the tape. I'm actually not, but it looks cool. Look good, feel good, trade good, right? For you guys that have ever played sports, I always say look good, feel good, you know, play good. If you look good, you feel confident about yourself, right? If you feel confident about yourself, you play better. Same thing with trading, right? You feel good about yourself, you trade a little better. Yeah, I advise all my girls all the time. Even when I used to do it, I'm like, look, I got one girl on my team, one of the All-Americans, and she calls herself Beauty Track Star. That's her Twitter handle. and she is, she's a woman. A lot of the track athletes you see, a lot of them aren't really, I don't want to say womanly looking, but a lot of them are, a lot of them, when you come to play a sport, makeup and looking your best isn't the main concern at all. But for my girl, it is. So she puts up, she's one of the handful of women out there. She gets her hair done. She puts on makeup, gets her nails done, and it looks like she's going to prom. And I'm like, and a lot of the girls on our team didn't understand that. Yeah. And she's like, you know what? She's like, I don't understand why, just because we're athletes, why can't I look good when I'm running, when I'm competing? And for her, when she looks good, it makes her feel good about herself. She's like, I look good, you know how it is. You guys, you buy something new, you get a new pair of jeans, or for the women, a new dress or something like that, and you go out, new pair of shoes, nice hat. And you got a whole different walk when you go out, right? You walk outside, you're like, it's not like you're in shorts and a t-shirt. You go outside dressed nice, you're like, yeah, posture's good. Jason said you got swag, you got the juice. You feel good about yourself. I know I do that. I have a good day of trading. I walk outside, I typically have bad posture. I walk outside, heads up in the air, got a little bounce to me, feeling good about myself. Can't tell me nothing. Same thing with her. Mojo. Yeah, she goes to the starting line. She looks good. She feels good. She's very confident in herself, and she performs well. So I don't know how do we get on this conversation? Because of the shiny things. There we go. If my charging package looks good, I trade better. It's been proven. But anyway, back to trading. But confidence is key. There's a trick for that. If you have, if you are lacking confidence, do positive affirmations every morning. Look in the mirror and do I am, I will statements. One of the things I used to do before my trading day every day, I sneak them into my trading plan, but I would tell myself, hey, Akil, I am a good trader. I will effectively trade the markets this way or today. I will be disciplined. Stuff like that. Those they're called positive affirmations. They will brainwash you, and in a very, very good way. Yep. I'm a big Tony Robbins fan. Awaken the Giant Within is a great book if you guys ever get a chance. It's a tough read, but it's a great book on the mental side of things. It's not trading related at all, but just in empowerment in general. That stuff does work. You can brainwash yourself. If you tell yourself something enough times, you'll start to believe it. Your brain doesn't know the difference. We'll get back to this real quick, but there was a study done. I think I told you guys the golf story already, but there was a study done on Olympic skiers, and they had 3 sets of skiers, and one of them, there are 3 ways of practicing. One of them actually practiced on the course. One of them practiced on the course. One of them did some practice on the course and did some visualization. And then the others just sat back and did visualization of the course. And the ones that did practice and visualization and the ones that did no practice and just visualized it had very, very similar results. Same thing with this, was a prisoner of war. I forgot where it was. Was that the prisoner of war that came out and hit the hole in one? Or you're saying cyber? Oh, I thought you were saying the name cyber. Yeah, there's this prisoner, and he was a POW for a long period of time, and they said that all he did while he was in his cell was just he just visualized his favorite golf course and what it was going to be like playing each hole when he got home. He did this for years and years and years and years, and was finally released. And when he came home, hit a hole in one on that golf course. It works. Your brain is an amazing thing. Your brain is an amazing thing. If you visualize something, you will see the results. Now it's better to actually physically do it, but you can get about, I think it was 60% of the results just by visualizing it. You can get 60% of the way there. So think about that. Now don't go telling yourself that you can fly and then jump off a bridge and try to fly. That's no. You'll get 60% of the way there and then hit the ground for the other 40%. So don't do that. But for stuff like trading, it works. But let's look at this. So we have an X to A here. We have an A to B. So we're clicking through the Fibonacci retracement, swing low to swing high. This comes to a 618. So we're thinking what? What pattern are we looking at for a 618 here? Gartley alert, right? So we're saying in order to have a Gartley, I've got my X to A. I've got my X right down here. What do I need to draw this on? Boom. There we go. I got my X. I got my A. I got my B. I'm looking for my C. In order to get a C leg, a valid C leg, what type of retracement do I need? I'm taking my Fibonacci retracement tool from my A leg to my B leg. What do I need the market to hit? Jason says, why are you on TradingView? For no reason. I was using it this morning. So yeah, just on here. And the shiny lights over here. I like shiny. Yeah, what do we need for a valid C leg? Come on, Gartley pattern traders. What do we need to hit? Nope. C leg, C leg, C leg. There we go. 618. At least a 618. There you go. So we're waiting for the 618 to be hit. We're saying waiting, waiting, waiting. Close, 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 close. Oh no, we're going down, we're going down, we're going down. Bang. All right, we put in a lower B. We never get that 618. So we're like, okay, well, probably not going to be a Gartley pattern. Let's go ahead and delete what we have going on here. Probably not going to be a Gartley pattern, right? But when we put in our lower low here, right, this is going to become our new B leg. Because now we're looking at swing high to swing low. Now we got to make sure this still meets our Gartley pattern requirements for the B leg. Make sure we don't hit that 786. And we don't. You see my 786 is going to be here in blue. And we can still put a Fibonacci retracement, but instead of from here to here, we're looking from here to our new B leg. And as we push forward, bang, you can see we put in a new higher high. So I'll walk through it one more time, the process I'm going through, because it may be a little confusing. Initially, I'm looking at this. X to A to B, B to C right here. As the market comes down, this is going to be nothing, 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 because we never hit the 618. You swear it's TradingView? The sound is gone. Is anyone else having sound problems? All right, I'll leave it. Let's go. I'll go to all right. I'll go up to Ninja. Hopefully this helps, Jason.
Order filled.
All right, where were we at? We were right here. Swing low, swing high. We're looking at that. Let me just get my numbers on it, my letters on here. X, A, B, C, D. All right, so we got our X right here. Boom. X to A to B. We're looking for a C. I don't think it's TradingView, but I think we were having issues here, Broadband. Ah, come on. You can't say now you don't think it's trading view after I just closed down my trading view and all the hard work I did drawing those tools. But here's what I'm looking at. So right now I'm thinking nothing. Right now I'm thinking nothing because we never got the C leg requirements. We had our 618 for our B leg, making it valid. We never got the C leg 618 requirements. So I'm thinking nothing, nothing, nothing. Once we do this, boom. You see how we put in a deeper C leg here, guys? Do you guys see this? The higher high, higher close? Give me a yes if that makes sense, if you're seeing it. Right over here. Let's change this to arrow pointer. Yep. Once we put in this higher high, higher close over here, I can do this. I can now make this my B leg because this is now the lowest pullback, right? The lowest pullback is right down here. And this is now going to be my C leg. Does that make sense to everyone? Are you following me on that or not? How my C can go from here to here and my B from here to here, because now this is the lowest pullback and this is the highest pullback in the opposite direction. That's kind of the on-the-fly adjustment that you make with patterns as they ebb and flow. All right, everyone's got that. So now I've got a C leg up there. I want to make sure it hits my 618. It does indeed. So now I'm looking at a potential Gartley pattern completion down at what? My 127, right? Fibonacci retracement from A leg to B leg. 127. I'm saying if price action gets down to our 127.5807, then I'll enter long on a Gartley pattern completion, right? And we came down, and you can see we filled our Gartley pattern completion, decompletion right down here. So nothing special about this, right? Basic Gartley pattern. Do you guys see anything? Is there anything different we can do with this? What do you think? I mean, it's a deep Gartley pattern. It's good. Not a lot of risk compared to the reward. This is where that initial analysis comes in handy. Now, we talked about supply and demand a little bit. We don't do it too much, but would you guys say that this is a big momentum candle right here? Yeah. So we talk about supply and demand a little bit, just trying to figure out where smart money's at and looking at these zones. It's pretty safe to say, I would say some institutional money is down here. Again, it's not something I teach, but something you can learn to recognize. Safe to say when you see a candle like this, retail traders aren't causing this. So we have a nice structure zone right here. And if you remember correctly, this structure zone is right at what? 58.10? If you remember correctly from the higher time frame, well, what do you know? Look, we're right on previous structure highs. So all that analysis we did in the higher time frames earlier doesn't go to waste. It's used right here. So what you could do, and I think someone mentioned this earlier, you can use this Gartley pattern as an entry reason into a higher time frame trade. Trying to catch that trend continuation move. Make sense? Yep. But, here's the problem. We just talked about it earlier. It's very hard to what? Man, man, Akil, I don't know if I want to hold targets for a full continuation move because, well, what if the market reverses, right? What if I hold that winner too long and it comes back and stops me out for a loss or stops me out for a break even? Now I have nothing, right? Is that the fear, right? Initially, you're like, yeah, ride it up. But then what if the market, instead of riding up here, comes back and retracing you? Now you're break even. Now you got nothing out of the trade. And this is what Charles said can come in handy. This is one of the benefits of trading multiple positions. We talk about this in the syndicate all the time. Jason, as I say, we would see a lot better results if we took multiple targets in the syndicate. Now we're doing it with our personal accounts, which is fine. Those matter. But we've only been taking a single target. And here's something you can do. You can say, you know what? I'm going to take that one target. Let's just assume you're trading two targets. I'm going to take that first target. I'm going to get it off right here at my initial Gartley pattern, my traditional Gartley pattern target. So I'm going to see if I can get what? 40 pips out of the trade. 44 pips. Once 44 pips is in your pocket, how do you feel? Good? Bad? Comfortable? Do you feel a little better than if you had nothing? How do you guys feel when you get 44 pips in your bag? You feel a little better, right? You're like, at least I made something, right? Stops remove the break even. So you've made something and you can lose nothing. Not a bad position to be in, right? I made something. I can lose nothing. You're playing with house money. In a way, you do it to hit second targets. You are dependent on hitting second targets a certain amount of the time to get those equity returns. But this is why we're picking and choosing opportunities on when to shoot for extended targets. So what you can do is you can say this. I'm going to take the second half of the position and I'm going to let it ride. And you can let it ride to the C leg. You can let it ride to the A leg. In this case, they're very similar, so it would be one or the other. Or you can play for an extension. You can ask yourself, well, where do I think the market's going to go? Obviously, the larger you look for it, the more risky it's going to be. But where do I think the market's going to go? Well, a bigger ABCD pattern is going to put me here. 6420. We talked about that 6400 level being a good level. That's a level I like. You have a smaller ABCD pattern that can be here. Well, looks like we already hit that smaller ABCD pattern, so I wouldn't do anything. We can do what? Fib extensions, the FEBs. There we go. Bring in the FEBs. Swing low to swing high, this bigger move. That's going to give me 127, 1618, 1414. Let's bring all three of those in. Those are the ones we pay attention to. We don't care about the rest. We can bring in a smaller fib extension from this previous move. That's going to give me a 127, 61 flat. And all I'm doing is what? I'm asking myself, thinking like the other trader. If I were looking to get short, where's the next spot I'd be looking to get short at? Let's just do one more, Fibonacci inversion. Boom. Again, we don't have a lot of structure here, which is going to hurt a little bit, but let's just bring some fibs in. What do we have here? Well, it looks for me that I've got a nice cluster. Well, see if I can, there we go. I've got two 127s right here at this 160 even handle. I've got a few 1414s, the minor ones at 161. Right? Let's make this green. And I've got a few up here around this 160, a little bit over one. Let's call it 162. And of course, I got the ABCD pattern up there at 160, 164. Now, the issue in this particular case is we don't really have any structure. We've got these minor structure levels, but nothing really too major. If I had to pick a level of structure, I would say this zone between, this one's tough. There's really, it's a wide zone. I would say 6250s to 6,300 is going to be that first level of structure. So a lot of it's going to be on your risk appetite. You can see we're going to get a 618 retracement here as well at 62. 62 is probably, out of these three, 62 is probably going to be the level that has the most lining up with it. The first level to be aware of, though, is going to be this 160 even handle. Now, you can also do something like this. You can take Fibonacci inversion from your D leg back to your A leg and see where that 127 comes up at. 59.64. 1618 at 60 even. I would say 160 even is going to be the first level you should pay attention to. Again, this one's tough because we just don't have any structure or a set zone of structure. But I would say the 160 even handle is the first level to pay attention to. That's the most, I would expect to see some type of resistance there. Now, you could hold for longer. And the longer you hold, the better reward you could potentially have, but also the more riskier the trade is. So that part has got to be up to you guys. So I can't help you with that. That's going to be on your risk appetite. If you're someone that is risk adverse, you're like, I don't like being risky at all, you probably want to get your targets off at the safest place. If you're someone that doesn't mind, you're like, man, let's go for it, roll the dice. You can shoot a little higher. And of course, as the market's going up there, we typically just don't see, we typically don't see a move like this, right? We could, pound news has been crazy. We typically don't see a move straight up. We do something like this, right? We we ebb and flow. We come up here. We get to these highs, and we come back to previous structure, and then we come up here, and then we do stuff like that. As the market is ebbing and flowing, what you should be doing, and this is what Jason did with New Zealand dollar, you should be protecting your stops. You should be rolling that stop from break even to up here, to up here, to up here. So you're shooting for that higher target, but you're also protecting yourself. You're also protecting yourself on the back end by rolling those stops. You're saying, well, I may not get the gold here. My little boy is going crazy in the background. Hopefully you guys can't hear him, but he is going wild. But yeah, you're rolling stops on the way back. So you may not get the big move. You may not get everything from right down here to 61. You may not get the full 200 pips, but you're locking yourself in for, well, a minimum of 36 on second targets at minimum. And then as the market moves, you're locking yourself in for another 71 and then another 100 or whatever it be. So it's kind of that game we play of being risky, but protecting ourselves on the back end. And again, pros and cons to everything. You can see this happen to Jason. What happened to him with the New Zealand trade? He got stopped out, and then it rallied his direction. So, if you're going to be a trailer of stops, you'll have to deal with that. You have to mentally say, I have to, if I get stopped out on trail stops, I can't get upset if the market rallies on to those targets. It stinks, but I can't get upset because that's the life I chose. But the key, what I wanted to talk about was these are the type of situations where I would shoot for extended targets. Not every pattern, only the ones that line up with that higher time frame analysis, that identify and predict part of our analysis. When everything's lining up at once, those are the ones where I would say, you know what, let's take a chance. If you do it on every trade, you're going to get burnt because the majority of the time we don't get extended targets. Most of the time we don't get them. But I'll tell you what, if you can hit something like this once and you can turn a simple little Gartley pattern like this into, a 250 pip total trade, that trade can make your month. You just allowed yourself to take what, maybe 4 losers on that one trade? That can make your month. That can make your year in some cases. He does love the keyboard. I got a fake keyboard set up for him so he can play around with it and whatnot. So that's what I want to talk about today. Is there anything else that you guys wanted to discuss? I am in this trade. I showed you. I told you guys in Syndicate. I got out early. I'm going to be trailing this now. I haven't done another thing you may want to take into account. Again, I hate saying this, but it's in situations where you're trailing, it's okay to have a fundamental bias. It's okay to have a fundamental bias, meaning if you know news is coming out for the pound and you're making a prediction that news is going to be good. We've been seeing good reactions off all pound news, and there's no reason to think that as long as positive news comes out, we shouldn't see positive moves in it. Those are also scenarios where you can trail, you can shoot for those extended targets. I told you guys about last year with the yen, where the yen was like, hey, we're going to devalue our currency. And he just came out and said it. Well, that's kind of a nice green flag saying, okay, well, if I can get long the dollar versus the yen, it's not a bad idea to shoot for extended targets because the yen already told us that they're going to devalue their currency. So on the fundamental side, you're expecting bad news. You're expecting the bias to be sell yen, sell yen, sell yen, because they want it to be weak. So you can also use stuff like that. Again, we don't want to trade based off fundamentals, but if you keep them in the back of your head, sometimes you can use those as clues as well to when, hey, should I be holding on to this a little longer? Should I let that winner go longer? Or do I need to should I attack this in true counter trend style where I'm a sniper, a mercenary, I get in, I do what I got to do, I get out, I get paid. And it's the game, guys. That's what's fun about trading. It's the game. It's the game. You never know. That's the fun of it. That's what puts a smile on your face playing that game. It's like being a quarterback. Being a quarterback, you go to the line of scrimmage, you're reading the defense, and you got to make your best move. You got to make a decision. You never know what's going to happen after the ball is snapped. You just hope that you did enough pre-read or pre-market analysis to be prepared on how to take advantage of it or how to protect yourself. Akil, what are your thoughts on binary options? I have no thoughts on it. I guess they're the next big thing. I don't know. I see all this scammy stuff on them. I've never been an options person. Options can be very good. They're just they're complicated. I wouldn't say they're rubbish. No, I mean, we saw the same thing when Forex came out. It's the next big thing that brokers want you to trade so they can take your money. And people are going to put out all types of earn your year's worth of salary in one day. I've never been, I thought I am the next big thing. I've never been a fan of just options in general. It's just not for me. Just not for me. So, wish I had a better opinion. I don't want to badmouth them because I don't have anything against it or no reason to be against it or for it, but just not for me. Quick question, back testing CTS. If I'm testing CTS but using top-down analysis, should I stay on the trading time frame or lower time frame? If my entry reading comes from lower, if your entry reading comes from the lower time frame, you still need if your entry reading comes from a lower time frame, yeah, you need to base your entries off that lower time frame. If that makes sense. But using time analysis, should I stay on? Yeah, you should still go to you should still bounce to your lower time frame to see if something on there would have occurred that would allow you to enter a trade. Yeah, so you should still go to your lower time frame if that's what your rules say. If your rules say after I identify a zone, then go down to my lower time frame for entry, you should definitely shoot down to that lower time frame. Now it's a pain in the butt doing testing on that. Typically, you got to load up 2 charts, but it's how you do it. you can kind of cheat on NinjaTrader in a way where you load up. Where is it at? You can load up two charts on Ninja at the same time. Just don't remember how to. Where is it at? I never use it. Do you guys remember? Data series. Yeah, you can load up another chart. You can load up pound dollar. Boom. Minute. Let's say 15 is my lower time frame. You can do something like this, where you have your hourly up top, and then your 15 below. It's still a pain in the butt, but you can do it. If say you only have like one monitor or something like that. Yeah, it's just tough. Gretchen says, can you discuss a trend continuation trade, like how Lax does it? Now I gotta get rid of this thing. Sure. Lax is looking for essentially the same thing we just discussed, Gretchen. That's what Lax is looking for. Lax is looking for a move like this. He's looking for, let me get a clean chart here. Lax is looking for something like this. Higher high, higher close. Same thing, the market trending, you're looking for the ebbs and flows, something like this. Boom, swing low to high, swing high. Outside return, he's looking for that higher high, higher close. And he's looking for a pullback. He's looking for, again, a move back. If you're doing the Fibonacci failure strategy, a move back into that 3D2. And then a chance to get long, just how the same exact way we talked about with the pound dollar, just at an earlier point. So essentially, it's just this type of move. Boom, swing low to swing high, waiting for a pullback, and then saying, how can I get long at this pullback? And then looking to ride it up to that next swing high, whether it be a 127 extension, whether it be an ABCD pattern. Very, 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 very simple strategy. Again, reading the market, new structure high, outside return, new structure high. He's trying to hop on, in trend continuation traders, they're trying to hop on at the outside returns. So each time that market puts an outside return, each time the market does something like this, boom, they're asking themselves, how can I hop on here? How can I hop on here? In your experience, what's more profitable, trend continuation, channel trend? I'm not a trend following trader, so I would not know how profitable trend following is. A lot of it's going to depend on how risky you are with your targets. So yeah, I couldn't answer that. A lot's going to depend on how far you're willing to let these things ride. But do you follow me, Gretchen? How it's the same thing that we just looked at when we looked at this on a daily? You're waiting for new structure high, outside return. Same exact amount. Now I'm sure he has some filters, but he's looking to catch it mainly. He's looking to catch it early at the first possible move, and that's the difference between me and him. I'm looking for a deeper pullback. So when we're looking at a trend following move like this, where we're shooting for an extension, right? I'm typically looking for me personally, just like in the pound dollar scenario, The closer price action gets to here, right, to our previous outside return, this is where I want to get involved. Have you guys noticed that? The closer we get to this previous outside return, this is where I want to get involved, right? Because I'm not a true trend following trader. I'm not shooting for an extension in most cases. I'm shooting for a pullback in the structure here. So the closer we get to this outside return here, right, I know stops have to be here for me. The closer we get to there, the tighter my stops can be. The tighter my stops can be, the much happier a trader I am, right? I'm shooting for something like this. So in those type of scenarios, I'm shooting for a much deeper retracement. A trend following trader, it's a little bit different. Their whole key is to say, where is the first possible place I can hop on this trend and catch it? I want to hop on the strong trend. If a trend the market is trending strongly, that first possible point is typically that 382 retracement, right? 382 equals strong trend. 618 is the golden mean. That's the nice one, the nice waves coming in from the ocean. The 382 is the fast one, strong trend. So the difference between me and him is he's looking to get involved at this point, really, really high in the pullback, where I'm looking for a deeper pullback. Does that still make sense, guys? Yep. Now, with me, my structure or my stops are based off structure. Obviously, his stops aren't going to be based off structure. They could be, but I don't think he trades that way. Because if your stops are based off structure, you're consistently giving yourself a lot of risk in here. So what I believe he's doing, and what I would do if I were trading this way, is I would look for some type of candlestick formation in here. Double bottom, 3-bar reversal, higher high, higher close. Something where stops don't have to be all the way down here, but stops can be somewhere in here. So he's getting a risk like this. And then again, the different in targets are, I'm shooting for targets at a retest of previous structure highs because I don't want to fight that. Again, unless it's a special scenario like this one, I don't want to fight this. With each trade, because he's trend following, his expectations are that the trend is going to continue. So he's looking for an extension on every single trade. Every single trade, he's looking for a break of previous structure and an extension, a continuation of that trend. Are you in this trade, pound dollar? Yeah. Mm-hmm. Heck yeah, I've been watching this all last week, waiting for a reason to get long. I don't know how many of you guys follow me on TradingView. I've been doing a pair, following one pair a week, and last week was pound dollar. So I've been waiting, patiently waiting for my moment. Can you do a combination? Sure. The main question I would have for you, Gretchen, though, is, and this is going to be a question that's going to determine everything. Targets. Where are you comfortable taking targets at? That's going to determine how you set that up. Are you comfortable shooting targets as a trend continuation, like an extension, or are you only comfortable shooting for targets at a retest of structure? That's going to determine how you can set this up. First, at a retest of structure. Well, I'll tell you this. If you're only shooting for targets at a retest of structure, you may find it difficult. You may find it difficult to get the risk reward in your favor. That's what you got to make sure. You got to make sure this risk reward lines up because you're only shooting for a little bit. If you got something like this, you know, if you got something, let's take this trade right here and see how we would do this with a higher high, higher close. If you got something like this, boom, here's your swing low to swing high. If you're planning to take this at the 3D2, you're saying, well, 3D2 comes in right here. As soon as I get a higher high, higher close candle, I'm getting long. Right? Let's eliminate the rest of these febs. You're saying if I get a higher high, higher close at the 3D2, I'm going to get long. Boom, your higher high, higher close comes in right here, right? 58.86. So you're long at 58.86. Here's the issue you're going to run into. You're only shooting for targets at a retested structure highs, right? So your targets are looking right here. Your risk, even if you're taking this aggressive approach, let's say you're doing one ATR below, one ATR below the lows here. I want to zoom in. I want the data. You're looking at an ATR of 26. You're looking at your lows here being 58, 48, 38, 28, 22. Your stops are right here. You see the, do you see the dilemma? Probably not a risk reward you want to take on a consistent basis. Am I right? Probably not a risk reward you want to take on a consistent basis. That's the hard part. Now, if you're truly a trend following trader and you're looking for a 127 extension, well, guess what? Same trade. Does that risk reward look a little better? Right? Looks a little better now. But now you've got to wait for targets to get all the way up here. So it's difficult. It's not easy to do both. And again, this is why I used to trade this way. I used to trade this way until this structure became very important to me. And I can't trade this way anymore because I just can't consistently get the risk reward. So someone like me has to wait for deeper retracements down in this area in order to get the risk reward to work out the way I want. So there you have it. I've crushed your dreams. I apologize. Jason says news is out. What news came out, Jason? I haven't done. I typically do not do anything on Mondays. Go for a 50-mile bike ride. Maybe that's what I'll do. All right. Anything else, guys? We're about an hour in, so that's typically how long we go. Home sales. Typically, we go about an hour. Anything else I can do for you before we head out and at least I enjoy my day off? I had a rough weekend. Man. I need a day off. Busy all weekend. I don't know how summer gets more busy for me. Yeah, I was working a camp yesterday, so I didn't get to have much of a Father's Day. Although the wife got me a very good present. Or I mean, the baby got me a very good present, apparently. Got me a nice little, what's it called? Like a patio chair. So I can sit outside. I've been taking like I'm either cheap or lazy, one of the two, or a combination of both. I've been taking like this nice old German rocking chair. I've been carrying it outside. It's heavy. I've been carrying it outside to sit and rock and read. Now I got a nice little patio chair. I can sit back and sit in the sun, talk to the birds, look at the flowers, allow my allergies to go crazy while I'm reading a book. I love doing that. Gardening, oh man. We got a whole bunch of rain and these weeds just they made a comeback. These weeds just made a vicious outside return. Institutional money there. Oh man, yeah, they're out of control. One side of my garden is good. One side's legit. The other side is, man, I don't mind the big weeds. We got these little vines that I have no idea where they initiate from. That's the problem. I have no idea. These things are underground, deep, and I have no idea where the start is at. So they randomly pop up and just take over, and they're like spiky ones. So I'm gonna get an industrial size thing of weed killer and strap on the hard hat. And if you guys don't see me tomorrow, it's because I lost, but I never lose. So let's end today's session. Appreciate. All right. Hello. Good morning, 12-week transformation members. Welcome back to another week. To talk a little bit about back testing. But first, Charles, I had a question for you. I got a few things I want to show you first. I sent Todd an email, and I know this is not the place. I cannot seem to upload this constellation to MT4 ever since it was an expert instead of when it was an indicator, it worked fine. The experts did not load at all. Like I went to the thing, it showed me the code, and nothing comes on my screen. Okay, so I'll look at that. I'll look at that then. Cool. Yeah, I'm like, man, this is, maybe I missed the email. I thought I saw it, but I'll check it out. Cool. Secondly, Anthony, one of our 12-week transformation members, sent me an email about this morning. It's this site called, I guess it's a site and an app called Trello, which is basically like a online sticky pad. This is my first time hearing of it. You guys know I'm not too internet savvy. But he was, let me see if I can find the email. He was using it very heavily. He's not a big fan of trading journals and stuff like that. Like, well, not trading journals, like Excel spreadsheets. So what he did was he sent me an email and of how he was using it. And it was pretty cool. He was using it to basically track his, so I can get this up here. He was using it to track his trades. He was going through CTS checklist on here. He had watch list, identified, predict, decide, ready to execute different trades, and just keeping pretty cool notes on this. I guess on this this platform. So I want to share with you guys. Again, I haven't. I played around with it a little bit this morning. I'm actually enjoying it a little more than I thought. I think it'd be pretty good for an educator and just to keep stuff on my to-do list on another screen. It's giving me an excuse to get another screen, Jason. But did want to share it with you. You can see he has New Zealand CAD double bottom 2618, and he has a CTS checklist on here. And I guess as he's tracking his trades, he's going away and checking them off, going, hey, got this, got that, got that. So it's pretty cool. I was, again, playing around with this morning, just putting some charts up here, checking out on the radar, or notes I have for fundamental analysis. New Zealand has a chance of decreasing interest rates this week. So wanted to share that with you guys just in case you want to check it out. Again, that is it's Trello. We don't promote this, or we have no affiliation with this at all, but I actually think it can be pretty cool. Especially, well, now it would bring more work for us as educators, and I probably would never do this, but I think you can also, like, I think you can share, like, everything I have is private. I think you can make it public. So like if we were all in the same Trello group or whatever it would be, you can kind of watch what's on my watch list. Whenever I add something here to my watch list and put notes, you can view it as well, which would be pretty cool, especially for the new syndicate online software we're doing. I don't know if this email got sent to Jason. Maybe he's looking at it and getting some ideas from it. Again, it would be pretty cool for you guys' point of view. That means I would be obligated to update you on everything, and that gives me more work. But we'll see. Spell the name out. Spell what name out, Robert? Trello. It's just Trello. Trello. Go to Trello.com. Yeah. That's all it is. Yeah. Again, I've never heard of it. It's simple, I guess. And then there's apps for your phone, phone, tablet, whatever you have. So wanted to share that. I'll be playing around for this week. Again, I'm old school, but I don't know. I can see the use in this. But want to talk a little bit about back testing today. I've been getting a few emails from a few of you guys that are doing back testing, and want to just talk about a few of what I feel is important. And of course, guys, if you have any questions, this is the time for you to ask questions as well. I'll make sure to save some time for that. But I know Jason in our 12-week transformation. He's got to legally change your name or something, man. He's been doing some intense back testing on different pairs and different patterns, and we get a lot of questions from you. And you know, I kind of just want to let you know, I guess, what I feel are the most important aspects of back testing. Now, if you guys are on back testing, obviously there's a video on the 12-week transformation that goes over everything. But there are a few aspects that are very important, because when you do your back testing, you don't want to be like me and do it a million times. Here's what I did when I back tested. Probably did the same thing. I would back test something. Then halfway through, I would get another idea of like, hey, maybe I should keep track of this. So I would scratch everything and go all the way back. And then I'd back test it again with the new thing I added, and then get halfway through again and be like, well, what if I did this? And then start over again. Then back test it again and be like, well, I'm not really awake during this time, so I wouldn't be and then start over again. Essentially, I would do about 5 rounds of back testing the same thing, because each time I would get halfway through, something else would pop up. Now, there was a positive to this. I trained my RAS a lot. My reticular activating system was very, very well, going through the same charts and the same patterns over and over again. But it wasn't the most efficient use of time. So I would say this: the first thing you need to decide before doing back testing is, what type of trader are you going to be? And there are differences in back testing, the process you go through, depending on what trader you want to be. If you are a swing trader, meaning if you're someone that's going to trade, I would say anywhere from 60 minutes up, especially 4-hour and up, you know that you're trading around the clock. You're going to be a 24/7 trader. Now, it doesn't mean you have to be awake 24/7, but it means that whenever a pattern forms, you're going to be involved in it. For example, we have a pattern setting up. We have a lot of patterns setting up today. We have a pattern setting up on, let's go to euro dollar. Cipher pattern euro dollar, I believe. Where's my other chart? Oh, we'll just take this. What's this? Bat pattern on pound Aussie. Bat pattern on pound Aussie completing down here at 198.15. Now, as a swing trader, you have no idea when or if this is going to complete, but you're able to recognize this. You're able to recognize this early enough where your position could easily be put on. You can easily put your buy order down here, your stops below, and whenever it gets filled, you're going to get filled. All right. Does that make sense, guys? If you're a swing trader, you're expected to take trades around the clock, 24/7. Give me a yes if that makes sense. I want you guys to understand that. There should be no filters if you're a swing trader. It should be, oh, well, if it completes at 12, then, all right. Yeah, if you're longer term, you're taking them around the clock. Now, if you're a day trader, it's a little different. If it's a day trader, you really want to work around your schedule. So the first thing you want to do is you want to write down your normal work schedule. You know, what time do I wake up? What time do I have to be in work? Do I have a job that allows me? Do I have a job that allows me to look at charts? Do I have an office job where, you know, I'm doing stuff, but I'm not really doing stuff, and I can have my laptop out and look at charts all day? Do I have a job where I'm more hands-on, where I'm gone for hours during the day and I may not be able to look at it this time, but I can look at it this time? You really want to write that out, and that's going to be different for each person, because that's going to determine what type of trader you're going to be. If you have a job where you're not able to actively look at charts, well, you probably shouldn't want to be a day trader, right? If you have a job where you may be on call, you know, half an hour, hours at a time, you know, you probably don't want to be a day trader, because there's not going to be a lot of consistency in that,
because you never know when you have to go. And when you go, those could be missed trading opportunities. So you may want to look for another style. If you have a job that maybe starts later at night and you have a few hours during the day before work or maybe after work that you can, then yeah, you want to be a day trader. But as a day trader, when you back test, you want to back test the hours. You want to back test the hours that you're able to day trade. Now, Jason said, I would never trade when I become preoccupied with something else. I will only trade when my full attention is on trading. And even that's a little risky, Jason, because you want to make, you still want to make sure there's consistency in when you're watching the market. It's good that you only trade when the markets have your full attention, but is there a consistent time during the week or during the day that you know the markets are going to have your full attention, or is it going to be random? Because you don't want to do this. You don't want to be a day trader on Monday and Tuesday this week, but then you can't trade Wednesday, Thursday, Friday, but then next week you can trade Wednesday and Thursday, but you can't trade Monday and Tuesday. You want to have some type of consistency in it. You want to have some type of consistency in that approach, because then you're going to run into the habit where, hey, well, maybe I'm catching the good days, but I'm missing the bad days, or now I'm catching the bad days, but I'm missing the good days because I didn't trade this Wednesday, but last Wednesday was good, and it ges really rocky that way. Then you're kind of it just adds more randomness to the market, and that's not good, because it doesn't reflect our back testing results. But if you're going to be a day trader, again, when you're back testing, you want to back test the time of day that you plan on day trading. So if you know you can only trade from 11 o'clock to 6 o'clock your time, or 11 o'clock to 5 o'clock your time, I would only back test those time periods. Yes, it trains your RES, but aside from that, there's no statistical advantage in tracking results that happen during a time when you're not going to be trading. So you can save yourself some of that work. Then, of course, if you are someone that, you're retired, you've got all the time in the world to look at charts, if you want, and you can day trade for maybe 7-8 hours a day if you need to, but you only want to pick 2 or 3 hours, I would back test that entire time period and then just see where most of the action occurs. See during that 8-hour time period that you can day trade, hey, if most of my trades occur during 8 o'clock to 10 o'clock, but not a lot from 11 o'clock on, then you may want to dial down that you may want to dial down those hours and say, hey, I'm only going to day trade from this time to this time, and I'll spend that other time doing something else. So you really want to determine what type of trader you can be before getting into the back testing process. Now, once you're in the process, here's what you want to do. A few things that are often, well, I would say this, here's what most traders do. You guys already have ideas for, and we'll take patterns because patterns is a simple example. You guys already have an idea for what to look for patterns, right? You know how to enter a pattern, you know where the entry's at, right? You know how to place stops, you know how to place targets, correct? Give me a yes if that's right. If it's a bat pattern, I enter at the 886, stops go 10 pips above X, right? Targets go to 382, targets go at the 618, blah, blah, blah. And it's really easy to get sucked in just to testing those default rules. But what you want to do during your testing period is you want to look for, maximum adverse excursion, maximum favorable excursion. You want to see, you want to test the limits of what you're looking at. So let's just take a bat pattern, for example. We'll just take this bat pattern because it's here. Let's take this bat pattern, for example, and you're doing your testing, right? Two things that you want to test. I wouldn't worry about entries too much. I wouldn't worry about entries. Entries are going to be, you don't want to mess with those too much. But here's what I would test. I would make sure to test stop placement. And I would come up with, at least 2 ideas for stop placement. Maybe test a 10 pip stop, or, and I'm just using 10 pips as an example, a set number stop. Maybe test an ATR stop, maybe test a 113 stop. But you want to have, maybe a stop that is traditionally further away, a stop that's traditionally closer, and keep track of those numbers to see how it affects your trade. For example, a 10 pip is usually going to be a little bit closer to X than ATR or 113. So you want to test these two levels. You want to get the numbers and say, well, if I risk less per trade, how does that affect my overall number? Right? Does risking less, that obviously that means if I get stopped out, I'm taking less of a hit on each trade, but am I also keeping myself out of this many winning positions? Are the wins that I'm missing worth the profit that I'm saving by getting out a little early? You want to ask yourself that question. And the same thing with targets. You don't just want to test 382 target 1, 618 target 2. Yes, we know they're good. I would test all of them. I would say 382. Let's put a test at 50%. Let's put a test at 786. Let's put a test all the way at a retest of the A leg and see how those numbers compare. I did some testing a few years ago on the lower time frame. A few years ago, back in 2011, I think I did it. On the lower time frame, because I had never traded the lower time frames before. So obviously I always heard that patterns work on any market, any time frame, but I still had to go through the testing process just to make sure. And one thing I noticed is that the 618 was more profitable than 382, right? Now this shouldn't come to any surprise because your target 2 should be making more than your target 1, right? So this is how it should be. Your 618 should bring in more profit than 382. But one thing that I decided to do for the lower time frames was, instead of taking targets at the 382, my first targets would come at the 618. Because that would be a more efficient way. That would be a more efficient way of trading. Now that comes with a price, of course. What do you think? What's the price that comes with this? There's always a give and a take. Everything in life, right? That's how things come balanced. If you add something, you got to take something away. Positive and negative. Life, I'm a Libra, so I'm always balanced. Yeah, lower win rate. So yes, the profits were bigger, but what it did was it decreased the win percentage of my patterns probably by about, I think it was by about 10%. I think 60% patterns went down to 50, probably about 5 or 10%. So realize there's always a give and take. It may be more profitable to skip the 618 and shoot all the way for the 786. Same thing. Are you willing to accept more of a loss in that again, in that win percentage? Could you put stops at break even when it got to 382? That's exactly what I did, Gretchen. I want to protect myself on the back end. So one thing I did was this. Say I'm trading this, I'm long at 198.15. I used to do exactly this. Price get to 382. In my rules, if price got to 382, stops get moved to break even. Stops get moved to break even. That way, if the market did something like this, boom, I didn't take a loss. So I protected myself on the back end. And again, what did that come from? Yep, great minds. That came from the backtesting process. In the backtesting process, I was able to see how many times does the market hit that 382 and come back to stop me out versus how many times does it hit the 382, come back to X, and then rise up. This was very rare. This was very rare. Now, there were some very, very small trades on the 5 minutes where it happens, guys, and you got to deal with it. There are going to be a good amount of trades where you get stopped out for break even. You're like, and it rolls up, and you're like, oh man, I knew I could have got that. But for the majority of the time, right? If it goes to 382, it's going to go right through. And if it goes back down, then the move is done. But it's a way of protecting yourself on the back end. Yep, great minds, great minds. But these are the questions we want to ask with backtesting. Again, we don't really want to know if the pattern works. I mean, I guess we do, but it works. These patterns work. The question we want to ask ourselves is, how can we make it work for us in the best way? And a lot of it's going to have to do with your personality. Same thing with extended targets. Are you going to shoot for an extension? One thing you can track on there is, what is the underlying trend of the market? And you can kind of do a comparison of, hey, when I have a bullish Gartley in a bullish market, and these are notes that you take, when I have a bullish Gartley in a bullish market, is there a better likelihood that the market keeps going and either goes to our A leg or extends past our A leg? How does that compare to a bullish Gartley in a bearish market? And you can start making rules for that too. If I have a bullish Gartley, in a bullish market, then I add an extra position or I keep an extra position on. I play for that extension. And little stuff like that is going to help us maximize these trades. You can even test. I didn't do much testing on overall markets compared to the pattern, but you can even test, hey, maybe a 382 works better in a counter trend. Patterns are all counter trend, but in a counter trend market situation than a 618. If price action's in a bullish market and I have a bearish Gartley, maybe the 382 brings more profit than the 618. It's really as much as you want to do, as much as you want to dig into it. But the point that I want to get across is, you want to do it all at once. You don't want to go through hundreds and hundreds of trades and then have an idea and be like, maybe I should test this too, and then go back through the whole process again. You want to really sit down, give yourself you want to sit down and give yourself a few days. I always do the eye test first, guys. Before I start back testing, I just take some charts and I scroll through it. I always want to do the eye test first, but sit back and really think hard about, what exactly do I want to test? We're no different than scientists. What exactly do I want to test? And yes, it's going to take a while to do it if you're testing multiple things, but trust me, it's a lot easier to do it all at once and get it out the way. Then do it, start over again, do it, start over again. Jason says, I've been making notes on certain pairs where they complete at different ratios to the 786, 886. Yeah. That's the fun part about testing, even if you're going to go into strategy development. I love back testing to a point. It's like a mystery. Now, I hate it when you're halfway through and you're bored and your brain's about to explode and you just want to trade it. But typically, when you're done your back testing, something good's going to come out of it. But yeah, the two things, like I said, two things you want to pay attention to are stop placement. Where's the most efficient place to put my stop? And then also targets. Where is the most efficient way to take targets? And it doesn't mean you have to take it there. Again, I understand win percentage is important to the psychology. It's a lot easier to be a 70% trader and stick to your rules. It's a lot easier to be a 70% trader and make less money than it is to be a 40% trader and make more money. I understand that completely. So don't think that you have to take the most efficient way. You don't have to. But you should know yourself. You should know your personality. If you're someone that, gets frightened by if you're someone that gets easily rattled, I would certainly take the higher win percentage. If you're someone that gets nervous watching the trade go, you may even want to take just single targets. Get your money and get out. If you're someone that's a little more risky, or a little more little cold-blooded, then yeah, it's okay to shoot for the bigger risk, because you know that you can handle being stopped out. Because that's the hardest part, guys. What Gretchen mentioned earlier about shooting. The hardest part about shooting for the 618 targets was knowing that I would have made money right here. essentially what it's doing is you're passing up on in a way guaranteed profit for potential profit, and that's very hard. That's like me holding a $100 bill, me holding a hundy in front of your face and saying, hey, I'll give you this right now if you want to take it, or if you pass, I may give you more later, but you may get nothing. Does that put it in perspective for you guys a little bit? That's a tough deal, right? That's a very tough deal. You want this hundy right now? I'll give it to you. Come on, just take it. But you get nothing more. Or I may double it, but you may get zero. Yeah. Throwing hundies, yeah. That's how I roll, man. All hundies. Big faces. So it's tough. But again, if you when you do your back testing, you gain confidence in your system. When you gain confidence, it's a lot easier to deal with. And that's what a lot of traders are lacking. They don't have that confidence in their system. They don't have that confidence in their system because they never tested it. So when they start seeing 3D2 and it gets rejected, they start getting scared out and making mistakes where you're like, all right, I knew this was going to happen because I saw it in my back testing. It happened a lot, just, but at the end of the day, it worked out. So that's what I wanted to, that was my spiel on back testing today. Again, thought I wanted to bring that up for you guys. What is with your money management that allows you to trade 11 pairs? Because you have a large account and you trade minis. I'm not sure what your question is, Jason. What is with your money that allows me to trade 11 pairs? Are you asking how come I chose 11 pairs, or is why do you trade 11? Well, I actually traded about I traded 13 in the syndicate early. I traded 11 because I want to give enough. Oh, when you recommend 4, strictly because I'm an educator, and I'm a little bit better than you guys. No, I don't mean that in any. I don't mean that to put you guys down, and that sounded horrible. But I'm more experienced. I can pay attention to more pairs. Now, if I were day trading, I would only trade 4. Understand that what I'm doing in the live room is for educational purposes. There's no way I would trade 11 pairs day trading. There's no way. I would not get away with that. I missed too many trading opportunities. I would trade 4, 6 would be max. However, as an educator, I do have an obligation to show you guys a certain amount of action, to give you guys a certain amount of like, not opportunity. I need to show a certain amount of examples to get the point across. What happens when I used to trade 4 when I first started in the live room, we'd have plenty of days where it's just like, okay, well, there's nothing, guys. Let's just hang out for 2 hours, right? And although there's nothing wrong with that for trading, that's perfect. That's what you should do. Again, from an education standpoint, it's not the best. It doesn't give you guys the best bang for your buck. I think you guys get a lot more when we can see different opportunities and break down different price charts. The more reps we get, the more it helps you guys. So that's why I watch 11 in the live room. But it used to be 4 because I didn't. Education was secondary back when I first started. It was like, hey, I'm here to trade and make my money. You guys are watching me, but it is what it is. Now education is kind of taken over. The more we get. So I do want to show a certain example. So day trading, I would trade 4. 4, I would probably trade 6. I can handle 6. 1 per monitor. Yes. Had to throw a 6 monitor over there. Which would I trade? I would trade. I always started with euro dollar, pound dollar, euro yen, pound yen. Those 4. Aussie dollar, New Zealand dollar are always next up, but for day trading purposes, they don't really move too much. So I would say a Euro Aussie, and I would throw in some type of I don't know right now what I would do for a 6-1. I would have to find a pair that move. Canada's ATR isn't too big. New Zealand doesn't offer a lot of opportunities day trading. Aussie isn't bad. I'd probably find some off pair like maybe an Aussie yen or New Zealand, something different. But certainly euro. I always start with euro dollar, pound dollar, euro yen, pound yen. So I know those are four of the most popular pairs. I know they're going to give opportunity during the time period which I trade, and that's what I want. I want a pair that gives opportunity. And when the U.S. market's open, a lot of those dollar pairs will move. The European market's open, those pairs are going to move as well. So those would be my 5, and I'd have to find the 6th one. Typically, I go with like dollar Canada or something. Those things don't have big ATR, so it's they're not as good. But that's why I trade 11 in live room, just to give you guys more example. Yeah, those are the 4 I always start with for day trading. Really for any trading, those are just in my opinion, those are the 4 most popular pairs. Pound yen is probably under discussion, but those 3 are definitely the 3 most popular pairs in Forex. So I would always start with them for day trading. But yeah, I would always keep it simple to day trade. You don't want to do too much. Aussie CAD is so profitable for ciphers though. Yeah, but is it day trading though? I know on a swing trading time frame it is, but day trading, I don't know. I've never looked at Aussie CAD really from a day trading perspective. Does it offer those same opportunities that it does on the 4-hour during the 5-minute charts during the time period? And you said no, it's more profitable. Yeah, so that's one that probably wouldn't make the day trading cut, but would certainly make it for the swing trading cut. Aussie CAD. And you got to remember, guys, some pair, all these pairs they have individual personalities. They all move different. Some pairs are great with fibs. Some pairs are horrible with fibs. Some pairs respect patterns really, really good. Some pairs don't, and you gotta take that into account. Some pairs move very, very slow. You look at euro pound. Euro pound is a slow mover. It's not too bad when it comes to patterns, but it just moves slow. So you're not going to get a lot of opportunity. So would you have more pairs? Yeah, I would definitely have more pairs. Yeah, swing trading you can handle a lot more because swing trading, guys, remember, even on a 60-minute chart, you could do something like this. I shot over how many trades to you in the trade floor today? I shot over. Here's what's on my radar that I put into the trade floor: euro dollar, pound yen, Aussie dollar, or euro Aussie. All of these trades right now, have entries set and stops set. And I did that all during my swing trading analysis, which took less than an hour this morning. So swing trading is a lot different because we see these things in advance. We've been looking at pound dollar here for how many days? Like 2 weeks, right? We've been looking at pound dollar for 2 weeks. You can easily put entries here, put stops here, and then go about your business. So swing trading, you can look at a lot more because you have a lot more time. Day trading, you don't really have time. Time isn't our friend. These things are like boom, 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 boom. You've got to be pretty quick on your analysis. So it's you don't want to overwhelm yourself. Again, the worst thing you can do is start missing trades. Once you start missing trades, it takes away from that consistency again, and that you start getting in the risky business there. You start getting in the risky business. What about max drawdown? You can always just decrease your position size. You can always just trade less. If you wanna increase your portfolio, you can always just trade less. Trade a smaller position size instead of going off of a 4 lot. Go to a 2 lot. If you want to add more pairs to your portfolio. If you want to decrease them, if you want to say, hey, I'm going from 10 to 6, hey, you can increase that position size. It's a very delicate game. It's a very delicate game. But remember, we don't want to overthink these things. That's an issue a lot of us get into. I started using TradingView, and I don't see the pictures of the drawing tools on the left-hand side. Can you help me? Try reloading it. I know sometimes it just stalls. Try just reloading it and logging on again. Adam says, do you cancel orders if it gets too far away, such as if you identify a pattern early in the morning and it's not filled by night? No, I typically don't place orders until on patterns. I typically don't place orders until the B leg is broken. I typically don't place orders until we get into a range that I think we're going to hit it. So I know what the ATR is on most of these pairs. So if we're 100 pips away, for example, on pound dollar, I'm not in too much of a rush to place the order there if it's during the day. If we're like 30 pips, 50 pips, and I know it may hit it, then yes. But typically I don't place it until we're getting close to that entry. And that's just me personally, because I have a habit of leaving orders on. I have a habit of leaving a lot of orders on. So I don't want too many open orders on at once, because then I'll, hey, I got an order on for pound dollar BAT, but then I also have the pound dollar CTS trade setting up that may hit there. Then I've got like 4 orders on the same pair. So I wait until really it's the next opportunity, until it gets close. And if it starts getting far away, I'll cancel it. Yeah. So if we start, if I have orders on right here and we start rallying back up here, I'll cancel it and wait till we're back down in that range again. Yeah, non-farm Friday. This is going to be a big. This should be a big non-farm Friday. Jason says, I'm not into that. Once I finish, yeah, you don't need to worry about max drawdown too much. The easiest way to do it, Jason, throw those numbers into your money management spreadsheet and play around with that equity curve. And say, hey, took a big dip here. You don't want to do that. Adam says for like a 5-minute chart. Well, I don't place any orders on 5-minute charts until I don't day trade until the live room starts. So I'm not allowed to place any orders until 8 o'clock. And I'm not allowed to take any new trades until 11. So whenever those smaller time frame trades are on, I'm actively watching the markets. I'm not trading before 5 o'clock or before 8 o'clock. I'm not trading after 11 o'clock. So something, like Jason hit me the other day about, hey, Keel, did you get involved in this pattern? I said, no. He said, well, why not? You looked at it in the live room. Well, it didn't complete by 11. So I canceled those orders. Do you periodically update your backtesting data every quarter or something like that? No, I don't. I don't do any backtesting anymore. I think what you're referring to is, am I adding do I add my live trading results to my backtesting data? I don't. I do take a look at it at the end of every year, the live trading results, and just see if there's any red flags that come up. But I don't add it to the backtesting data. I look at it as being completely separate. A great example was last year when we had low volatility. halfway through the year, I went through my data and noticed that, hey, target twos aren't cutting it because of the volatility. Target twos were bringing in less than target ones. And that was a big red flag for me because essentially it meant I was wasting a position, that I would make more money. If it doesn't make sense, let me know. I would make more money just taking target ones and not shooting for target twos. That was a big red flag that happened last year during our historic time of low volatility. So I made the switch in June. But I had to wait 2 quarters. I didn't want it to be, I had to make sure it was, I had to make sure I had a big enough sample size. I just didn't want to react to it. I had to make sure that the numbers were really telling me the true story. So I do think it's important. I wouldn't add it to backtesting data. There's nothing wrong with that, I guess. You could. But I would look at your live trading results as being separate. Good questions today. Akil, what I was gonna do is take the 4 pairs I want to trade and combine. Why is this small? There you go. Combine all the results in the Money Man spreadsheet, then get the total max drawdown, etc. Then work it out from there. Yes, you're 100% correct. Yep. Now, what I would do first is, well, I guess you're saying I take the 4 pairs. Yeah, I said now. I would say this: if you plan on trading 4 pairs, backtest 6 or backtest 8. And then look through those individual numbers and see which ones are the best. Yeah, test 11 and then choose the best. Choose the best out of those and then put it together. Now, you may want to diversify a little bit. I don't think it matters as much on the day trading and the swing trading because it's only 4 pairs. But you do want to have some type of diversification, Jason. You don't want to trade, like you don't want your portfolio to be euro yen, pound yen, dollar yen, Canada yen. Because then you have the risk of overexposing yourself in a very difficult pair like the yen. So you do want to have some type of diversification in there, which I think you will naturally get, but don't trade 4 yen pairs. That's what I'm saying. And I'm a little, I have some hatred against the yen because you guys know my story of blowing a massive amount of money in a quick amount of time, and I was trading yen pairs, so I hate the yen. Stupid. Oh, I'm so serious though. I have a personal grudge against it. All right. Do some people change their position size depending on the CTS score they get? Like if CTS is 5x, I had an idea popped in my head. Yeah, sure. Adam, I want you to check out. When did we talk about this, guys? Was it 2 weeks ago? Last week was the holiday. I think it was 2 weeks ago. We had a discussion on that in the CTS, either 2 or 3 weeks ago. But check the archives for our Q&A sessions, Adam. Yeah, we had a really good discussion on adjusting your position size based on your level of CTS score. Now, what's important with that is you don't want to add position size. You want to take your natural position size. If your natural position size, meaning your normal position size is, say, 4 minis, you don't want to have a high CTS score and then trade 8 minis, but you want to say, hey, if I have a CTS between 0 and 3 is no trade, between 3 and 6 is half position, so 2 minis, between 6 and 12 or 6 and 13, whatever it is the full mini. So you never want to add, you don't want to add position to it because then you risk that overexposure type of deal. But you can certainly say, hey, if the CTS is at this score, then I trade half a normal position size. And again, it had to be a couple weeks ago, at least within the last month that we had a discussion about that. But make sure don't double your size. Just split it. Take your initial size as being your max, and then split that in half. What are the real reasons for an 8/11 trading window being open? That's just one of the best times to trade in the market, Gretchen. You're finding a sweet spot between the London afternoon and the New York Open. London's done at 11, basically, or London's done at 12, and then 11 to 12, that area, people stop trading over in London. 11 to 12 is when people start taking lunch breaks here in New York or here in America. So you're finding that overlapping time spot where you get the second half of London and the first half of the U.S., which makes for the most active trading time. So that's why 8/11. That's why 8/11 is typically the best time to day trade. Now the London session is very, very good by itself. You can certainly day trade the London session. It's very, very good by itself. I'm just not waking up that early. What is TI units on the pip value sheet? Let me look. I have no clue. I know the pip value sheet is probably how many dollars is actually it should be how many pips actually equal a dollar figure when you do pip to units, and that number's going to change. That number's going to change every day, basically. Not every day, but yeah. So this would be oh, this would be up based off how many units you're trading. So if you're trading 2 units, this is what it would be. So whatever your unit size is, I think it defaulted to 2. It looks like this one has a default to 2. Whatever your unit size is. So if you were to do 1 unit, let's see if that would change everything. Yeah, see, 1 unit would change it back to 1. So just your position size. Just your position size. The London arm of trading power. We could use a London arm. There would be, I think it would be pretty cool to not run 24/7, but to open up a live room in London. You have that run from 2 to maybe 3 to 6. Take a little lunch break, and then have me take over from 8 to 11, something like that. That'd be pretty cool. Do we have that pip value spreadsheet? It should be on the Money Manager spreadsheet. You're gonna have to. This hasn't been updated since 2013. You should be able to, whatever trading platform you're looking at, you should be able to find the pip value on there. If not, you can just check your results deal. Let me see if I can find a pip value. It should be somewhere. If you just check your results and put it into dollars, it should give you a pip value. I'm not sure if you can find it here on Ninja. Yeah, if you check your logs and make it to dollars, you'll see how many actual physical dollars you made. This really, you don't really need to be concerned with this, to be honest with you. This is the least of your concerns, pip values. It honestly doesn't mean too much. So there's a link at the bottom of the site. Get pip values. Oh, there we go. Go Forex. But again, this really shouldn't mean anything to you, to be honest with you. If you're concerned with that, you're concentrating on the wrong thing. Anything else, gang, that you would like to discuss? Fast session, man. Time flies. Todd sent me an email, Charles, about I guess about the constellation thing. I'll have to hit you on Skype. I hate MT4, man. Gosh. I'm not good with stuff like this. Yeah, I'll Skype you after this. This is why this is what I pay other people to do for me. This is a perfect situation where I'll just pay someone to do it. Like, look, here's $10. Go set it up for me. Just give it to me when it works. I don't care how it works. Just give it to me when it works. That's all I want to know. How do you deal with anger during your trading? I don't really get angry. So I'm a pretty even keel type person. Despite my latest week in review video. I'm really not I really as just a person, and this is one of the things I'm very similar to Jason in this. I really don't have many emotions. It's really bad for other things in life, but it's great for trading. I really don't have any emotions. I have some, but I don't have a lot. I'd probably make a great poker player. I bet my wife. Hey, she knew it before we got married, so she knew what she was getting into. Like I'm one of those guys where you tell them straight up like, hey, you know, everyone's asking, Keel, are you gonna cry at your wedding? No. Are you sure? I think you are. And you know, it happened, and I didn't even bat an eye. It's just, you know, just the way I am. But it works great for trading, and that's one of the things when Jason was first talking to me, you know, I'm like, he's like, man, this guy Keel, he's like a robot. Everyone calls me like a robot in the live room. He's like, you know, this guy will have a bad day and be like, man, Keel, you're getting hammered, and you'll be like, yep. Or he'll send me this message about, hey man, we're for like we did when I got my first paycheck from Trade Empowered, I did my first training course and I got my first paycheck, and it was more than I've ever made. It was the single check I got was about the same as I ever made in a year in life. And he's like, you know, Jason's excited, like, hey man, you did it. You did your first training course. You know, well done. I know it was a lot of hard work, but it pays off. How do you feel? I'm like, feel good. He's like, that's all. I'm like, yeah. He's like, you're cold-blooded, man. So I show very little emotion, but the real key is to just you gotta switch what you're thinking about as far as emotions. You know, anger only comes. You know, a lot of us we associate anger when trades are losing and not going our way, and that shouldn't really be anger. Frustration, yes, but there's no reason to be upset or mad at a losing trade. Again, if it all depends on what matters most to you. For me, the process is what matters most. Am I doing it the right way? That's what matters most. It's the same thing with anything in life. It's not, you know, whether you're competing in sports, you're going for a job interview. It's not about the outcome. It's not about the results. If you go for a job interview and you don't get the job, well, tough. It happens. Did you nail the interview? If you felt like you went to an interview, you did everything you could in the interview, you just weren't the right person for the job, then you did well. One thing we have to remember, Norman Howlett and BJ Nash are good. One thing we have to remember is we have no control over the market. There's nothing we can do in the market. We have no control whether this thing moves up or down, right? We need to stop thinking that we can control it, that because we predict something that it's going to happen. A lot of traders, oh, I made a prediction, so it's going to do this. It's going to go bullish because of my prediction. No, it's not. We have no control over it. So why is it worth getting upset or stressing over something we can't control, right? There's no point. It's just a waste of energy. So the only thing we can control is did we do it? Did we attack it the right way? Did I go to the job interview and hit all my points? Did I answer every question? Was I prepared? Did I do everything I was supposed to do? Yes. You know, if it's an athletic competition, you know, and I'm a coach, did I prepare my team? Did we execute the perfect game plan? But we were just outmanned by the other team. The other team was just better. Yes. Well then, hey, it's you lost, but you know, you did everything you could do. That's a win. Tap yourself on the back. So process over outcome is key. Process over outcome is key. What should make you smile is whether you execute the trade all right. You know, the best emails I get are from traders that say, man, Akil, hey, I got blown out of that dollar yen Gartley pattern, but I took it short right at market and put my stops exactly where they're supposed to be. Yes. The traders that get excited over that, those are the ones that make it. Because eventually you'll be rewarded. I mean, again, we go through the backtesting process. We know our system's right. Our system makes money. There's no doubt about it. We just don't know when. So anger is just a waste. It's just a waste of time and energy. It doesn't. Being angry doesn't make your trading any better. So why do it? Why we only want to do stuff that makes your trading better. By the way, there's a great. Let me see if I can get the link for you guys. I listened to this great thing on YouTube the other day by what's the Nightingale guy? What's his name? Earl Nightingale. Let me see if I can give you guys a link. It is great, and it talks about the process too. Yeah, The Strangest Secret. If you guys haven't heard this, this is amazing. It's about 30 minutes long. It's certainly worth the listen. Twice. It's Earl Nightingale. I think it's called The Strangest Secret. It is fantastic. Fantastic. Yeah, check out BJ Nash. He's good. Check out BJ Nash. He's really good. And then you know, books like Mark Douglas's Trading in the Zone. Those are excellent books too. I don't know what BJ Nash's course is called. The Disciplined Trader. I think that's Norman. Earl Nightingale's is called The Strangest Secret. Yeah, I just posted a link for you. I'll do it again. It's fantastic. It's a fantastic listen. He says this one thing where it's like he's like the mind. It's all about positive thinking and stuff like that and achieving goals, which is perfect for us and separating the losers from the winners and how most people are losers, which I fully agree that most people are losers, just because they're scared to go for it. But he says this one thing about how the mind and the brain is like land, where the land doesn't care what you plant in it. If you dig 2 holes in the ground and you plant, you know, corn in one hole and you plant this venomous plant in another hole, land will grow both of them equally, right? Same thing with your brain. Your brain won't, you know, whatever you put in your brain will grow it, right? If you put negative thoughts in your brain, that poisonous plant, it will grow it. If you put corn in your brain, that food that will nourish you, it will grow it. Whatever you put in your brain, it will grow. It doesn't discriminate. So the only choice is, you know, why put those negative thoughts in your brain? Just plant the good stuff, right? Just plant the good stuff and it will grow. Um, I love stuff like that. I'm all about positive thinking, and I'm all about, you know, if you want something bad enough, you'll get it. The only question is when. How long will it take? That's the only question. I know I will achieve all my goals. It's not even a question. It's not a question at all. I will. Yeah, I don't have a choice. Now, when? How long will it take? You know, I don't know. But I will achieve it because, you know, I'm going to. That's just what I do. If it's something that's under my control, I will do it. There's no doubt about it. But it's positive thinking. And positive thinking means thinking unlike everyone else. He did the math. Well, I forgot at the very beginning he was talking about if you have 100 people, this many people will be successful, this many people won't, this many people will be moderately successful. And I think it was like, ended up being like 5 out of 100 people that were that were of somewhat success. Which is crazy because that's the same thing we tell in trading, right? 90% of traders fail. It's probably a little higher than that, but it's the same thing in trading. So Anything else, guys, before we head out? Fantastic session. I've got an interview later, guys, with I'll give you guys the heads up. I don't know what's gonna be posted. I'll put it on Twitter whenever you post it. It's with a guy, Brandon Clay, tradingstory.com. He's doing like a new age market wizards. So I'm excited about that. I really like it. He's doing a thing. I think I showed you guys the website. I'll bring it up again. He's doing a thing where he's just trying to encourage new traders, and I think it's really great because he's interviewing a lot of traders across the board. Some are like professional prop traders. Some were one guy was like a roofer.
All right, gang. Good morning. They're messing with you already, Jason. They're messing with you already. Good morning, gang. Welcome to another 12-week transformation Q&A session. Hope you guys all got a chance to see Jason's war room this morning. It was a spectacular meeting, in my opinion. I think he cursed me a little bit with these trades as pound yen and pound dollar not looking too hot for me, but we shall see. Now, I got an email this weekend from Gretchen wanting to talk about the DSR level. So we're going to start off there. And I would tell you this, Gretchen, as far as the actual coding for them and all the arithmetic that Todd Brown used to make them, I have no idea what goes into that. So I can't break down the actual coding of the DSR levels. I can tell you how to use them, though. I think, let me just take a quick look at, over here. I add another monitor, so I got another monitor to look at. Let me just take one quick look at your email just to make sure I address everything. Greatest teacher ever, awesome person. I'm having trouble accepting DSR as part of my future trading plan because I know absolutely nothing about it. I watched the DSR in module 3, can't figure out maybe interest. Okay, well, first things first. Yeah, first things first. You don't need to understand how to. And I know the difference between need and want. You don't need to understand DSR levels for it to be an effective tool. It's very similar to a car. I'm not really sure how a car works. I know the basic points, but I don't know the details of what wires go where and how the engine is made and whatnot. I know when I get inside a car and I put the key in and I turn it on, I push the gas, it goes, right? So you don't need to know all the intricate details behind the DSR to know that it works. Just if you've used it and you see that it works, that's all you need to know. But I can tell you this, the DSR is based off swing points. So if you were to go to your indicator section and go down, there's an indicator called your swing indicator. And the swing indicator measures high and low swings in the market. For example, let me just put on a naked chart. If I were to take my swing indicator here on the dollar yen 5 minute, now, well, if I were just to put it on, you would see it would give me highs and lows of the market, right? You guys can see this on your screen? Give me a yes. The green and orange lines? Yep. That's a swing based on a 5 period strength. Now, if I change this from 5 to, say, 13, that's going to give me different swing points on this market. So how the strength of the swing is measured, I don't know. You can probably do some research on that. But these swing points is what the DSR is going to be based off of. And then as far as the levels go, what you're looking at is you're looking at it drawing a box, say something like this, drawing a box from the highest high in this point to the highest close and giving you that zone. Does that make sense so far, Gretchen? So the DSR is choosing its levels based off the swing. And again, I don't know how the swing indicator measures it. I don't know if it's probably the strength is measured by, it's got to be a certain amount of candles and I don't know. But it's measured off the swing. The actual area that it's giving you
is going to be between the highest high point at that swing and the highest close. So I bet if we were to put a DSR level here on the 5-minute chart, let's see how it lines up. And I don't know what I have my swing set to here. The swing set is set to 3, so it's going to be probably going to give you a little more level than the actual swing indicator is giving you. But let's check it out. It's going to be a lot of them. Come on. All right, so while it's loading, now here's the gem of the DSR level. And again, it's just a tool. It's nothing that you need for your trading. It's a tool to help you. Yeah, you can see at these same swing levels a little bit more because it's at the strength is set to 3 while the swing indicator is set to, I think I had it at 13. But you can see just as I measured out here, you guys see what I'm talking about? The high to the close like that, it's going to measure out that zone. Now the key to the DSR level is that we use it for top-down analysis. So what I use the DSR level is for this. I go to I do top-down analysis. So I go from the daily chart all the way down to the 60-minute chart. So what I want to do is this. I want to identify key levels of structure on the daily. And that's what I have my DSR set to. You see, this is set to 1 day. So if I were to go out to a daily chart, this would be a dynamic support and resistance zone based off the daily chart. Now, instead of me going from the daily down to the 60-minute, seeing a level and saying, okay, well, is that structure the daily, then going back to the daily to confirm and then drawing it out there, then going back to the 60, it makes my life easier. It makes our life easier as a trader because we can set this DSR level based off the higher time frame structure levels, and we don't have to do all the back and forth between charts. We can simply look at our chart and say, well, I know this is a daily support zone because this DSR is here, right? That's the gem of the DSR level. Again, it's to make our lives easier. It's nothing you need in trading. You don't, and I know you said you don't feel comfortable trading it. You don't have to trade it. It's really nothing we need. It's just like anything else. It's a tool. It can make our lives a little bit easier when identifying structure. For some of you guys, it builds a little bit more confidence when you identify a structure level and then you throw a DSR level on later and you see that it's at the same area. But it's nothing that's needed. You don't have to say, hey, I'm going to trade every time I hit a DSR level. Again, just use it as a tool in your trading to help with recognition, to help with finding those major and minor support and resistance zones. Now, Jason says, what setting do you use? Do you have 2 on each chart in front? No, I use 1 DSR level. And again, I don't really, in full disclosure, I don't use the DSR as a strategy. So I typically keep it on the daily just because that's where I do my top-down analysis from. And then I essentially know what structure zones are important to me. So I don't really need it as much as maybe a newer trader. But here's what you typically want to do. There's two types of DSRs. There's the major DSR, and then there's the minor DSR. The major DSR, you want to be 4 times your time frame. So if you're looking on a 60-minute chart, that would be what? That would be a 4-hour chart. You have your minor DSR, which is going to be 2 times your time frame. So if you're looking on a 60-minute chart, you're going to base that off of a 120-minute chart. So again, the major is going to be 4 times. The minor is going to be 2 times. I'll go ahead and bring this on for you so you can see. But before you write that down, I'm going to tell you a little trick. So let's say the major is 4 hours. Let's make that red and green. The minor is going to be 120. Make sure we change that to minutes so we don't do 120 days. I'll make that black and blue. And if you're looking for major and minor structure levels, again, major is going to be red and green. Minor is going to be black and blue. All right? Now, typically, I only use the major. Again, I'm not really too concerned with the minor structure levels. again, I also like to have the cleanest charts as possible. I don't like having a whole bunch of junk on my chart. What I would also do is this. Once you, if you're, I would say once you go down to the lower time frames, it's worth having the major and minors on. If you're trading on a 5-minute chart, then it's really worth having, maybe a 10-minute and a 20-minute DSR on. Once you go to the higher time frames again, by this point, structure should be popping out to you guys. You should be able to identify these key swings, these new structure highs and outside returns. I don't really think there's a need to do 4 times and 2 times. I would just base it off whatever the higher time frame is in your trading. So if you're a trader that typically goes from daily, 4-hour to hourly, I would make your major to daily, make your minor to 4 hours, something like that. I don't think there's a need to go to 120. I would stick to on the higher time frames, I would stick to the time frame that you actually look at. A 120 DSR, well, if I don't usually look at a 120 chart, there's no real point of it. So I would stick to 4-hour and daily. Once you get to the lower time frames like the 15 or the 5, then you can do the 4 times, the 2 times. But again, in full disclosure, I don't really use the minors because it just adds extra junk that I just don't need on my screen. But those are how to use it. Major 4 times time frame, minor 2 times time frame, or in my opinion, just base it off your natural progression down charts. Just answer that. What determines how wide horizontally the rectangle is? That just goes until new previous structure is created. So it'll keep printing it out until that structure level is violated, or until a new DSR is created. I don't know if there's a stopping limit on how far it goes. Again, I don't know the details of it, but typically you'll see a DSR print until a new DSR is created. So this DSR prints, as soon as this DSR is created, this one's going to stop because this is the new most recent DSR level. Same thing, this DSR level down here, and then once this low is created and this becomes the DSR level, this one's going to stop. This one stops once this one's created. Where can we find the setup instructions for DSR indicator? It should be all on the 12-week transformation on our website. What questions do you have about it, Adam? You just go here, go to indicators. You find your T2, your trading power DSR. Just double click it and put it in there. But there should be a video. Okay, yeah, there should be a video on the website, or you can email Charles. Either one of them. And how I think I can program it. Okay, yeah, cool. Yeah, again, guys, and I know everyone's different. Some of you have programming minds, but you don't need to know how the stuff works to know that it works. I understand why a lot of people want, email Charles. It should be on there. We have a video on how to, right? There's a video on how to install the DSR levels, correct? Emailing Charles that's always a good thing. There should be a video on there. It may be in the first, we've done this for years, so there should be a video. If not, Charles will help you out. Any more questions on DSR level? Again, you don't need to know how it works, just know that it does work. Yeah, and there is a video on there. But remember, they're visual indicators. You can use it as a strategy. I know Todd Brown has strategies, a dynamic support and resistance strategy, but it's just a visual indicator, something to help with trading, something to help build your confidence. When we first created the DSRs, the plan was never to actually sell it as an indicator or use it for anything like that. But we just had it on there to, I don't think Jason was just playing around with something and created it for teaching wise. And we gave it to a group of traders at one of our live trading seminars, and our mastermind members loved it. And then we're like, you guys realize it's just support and resistance with a big shiny box around it. And they're like, yeah, man, but it's awesome. Like it's not, you can just do it yourself. They're like, yeah, but you know, I don't know. You get something big and shiny, you get I think it just gives more confirmation, builds more confidence. Just like the FEBs, a little different than FIBs. FIBs are a little different. But yes, it's a little different than FIBs. All right. All right. What else do you guys have on the mind for today as we get away from DSRs? And hopefully watch these positions come back in my favor. Got a few people typing in, so I'll give them a few seconds. Here we go. Griffin says, on the ABCD pattern, one reason for limiting retracement to less than 382. One reason for limiting retracement to less than 382 is that it already reached target 1. Is there any limit to following retracement leading to the 2618, 2618 trade? Like if it goes to target 1 and target 2 before reaching 6. Okay. One reason for, all right, I'm not sure about the ABCD pattern question about limiting the ABCD to 382. I think you have that a little confused. There's no limit on the ABCD pattern. There's no limit of a 382 retracement on the ABCD pattern. I mean, it's technically a 382 is a requirement. Is that what you mean for an ABCD pattern? Oh, double top, double. Okay, yeah. Is there any filter for the 2618? Okay, that I get you now. So the first question is, you guys know how I filtered about double tops and double bottom. I will not take a double top or double bottom if price action comes back to a 382. And again, that's a personal filter. You guys don't have to use it. You guys don't have to use it. I use this because, again, I once was a trend continuation trader that traded a strategy called the Fibonacci failure. And all the Fibonacci failure pattern, all the Fibonacci failure technique was this. If price action comes back to 382, then I buy it up. This was the entire strategy. And I traded that for a while, back when I was undisciplined and whatnot. So, of course, it didn't work out in my favor, but I always had that in my mind. Whenever I see that 382 retracement, I think trend continuation, mainly because I spent so much time back testing and trading the strategy. So a filter I have for double tops and double bottoms is if we get something like this, I will not take it because I'm assuming trend continuation once that 382 is hit. 382 is also, that's the number you should get for a strong trend. So the question that Gretchen has is, do I have any filters for 2618 trades? And indeed I do. So say we're going off a double top like this. With a 2618, let me start by asking you guys this. Where would I expect price action to come to it? If you were trading this type of setup, this 20, oh, didn't want to do that. Didn't want to do that. All right, I just broke it. There we go. All right, if you guys were trading this type of setup, right, 2618 trade, where would you expect price action to get to? What would be your ultimate prediction of where price action will go? Actually 2618 trade looks like this, right? We're looking for something like that, and we're looking for a move to where? Let's play the guessing game. Where is price action likely to go? Point 1, is it you expect here? Is it here? Point 2? Is it further? 0.3? What do you guys think? One, two, three. Vern says 2. Jason says 1. Jason says 1, then 2. 1, 1, 1. All right, so I think we can all agree, right? First targets, you guys kind of know the rules, right? First targets is right here, right? First target would be at number 1, am I correct? This is where you guys would first start thinking about taking part of your position off. If you were taking a target 2, where would you guys look for target 2 at? At the number 2 or the number 3 here? And let's just base it on just pure structure. Let's not, because we don't know what the fib's going to be. Pure structure. 2. All right, so our expectation is that we would expect the market at a maximum to come down to retest our previous level of structure here. If we didn't, we'd probably take second targets off further away. So at maximum, we would expect price action to take previous, we'd expect to take targets off at this previous level of structure. So here's my filter for the 2618, right? If we get something like this, boom, this is a 2618 that does not interest me. Why? Can you guys guess? Risk reward may not be good. Yeah, but this is a 2618 trade that would not interest me, mainly because we've already come to the level that I would expect to get hit. And I'll say it again. This 2618 trade would not interest me because we've already come to the level that I expected to get hit. If I'm taking, remember, a 2618 is essentially a second chance at getting involved with double top, right? We're seeing something like this. Price action is ebbing and flowing. Let's get this off the chart here. Price action is ebbing and flowing. Boom, boom, boom. We're coming up to a previous level of structure. We're saying, okay, this is our decision point, right? We're either going to see a trend continuation with the market shooting up, or we're going to see a hold in a counter trend trading opportunity. Now remember, as counter trend traders, we're not expecting what? We're not expecting a full reversal in the trend. We're expecting a move, what? Back down to our previous outside return at maximum. Because if you were a trend continuation trader, right? And I hope I don't confuse you guys. If you were a trend continuation trader, you'd probably be looking to get long right here. So if a 2618 comes down here, boom, I already consider that being the outside return. I consider that being the move that I expected being made already. Therefore, I don't want to involve myself in a second move down here if what I've expected already occurred. Follow me, guys? Did I lose you? Did I lose him, Charles? Darn it, Charles. Stop going through your millions of emails. But yeah, so that's a filter that I have in Gretchen. Now again, I'm not, a 2618 is not a strategy I trade, meaning that I will take 2618 opportunities. It works into CTS, it works into just my price action and structure trading in general. But I don't have in my plan that says, you know, I'm a 2618 trader. I don't have in my plan that says I'm a 2618 trader and I need to take every single opportunity. Now, if I were a 2618 trader, if this was a strategy that I wanted to follow, similar to a Cypher pattern, similar to a Gartley, what I would recommend is doing this. I would, you know, when you do your back testing, I would make sure to take into account and filter the results of how many times a 2618, what are the performance comparisons between 2618s that come down to test previous structure before retracing to the 618, and then ones that don't. I haven't done any back testing comparing the two. So I can't tell you if by having this filter in, if this is going to, if you're a 2618 trader that trades every single 2618 trading opportunity, I can't tell you if this is going to help or hurt you. So that's something that I would certainly look into in back testing, especially if you're going to be someone that says, hey, I'm going to trade every single 2618 trade I see. For me, I look at it as a structure-based trade, essentially. So when I do my price action structure-based trades, I have certain filters in there. But that would be the filter that I use for that, for 2618. And of course, risk reward too. If I can't get a one-to-one risk reward, it's not going to be worth my time taking, especially since I know that 2618s are about 50-50. I certainly don't want to put myself in a position where I have more at risk than what I can potentially obtain as a reward. Now, Jay says, Akil, do you also not trade double tops or 2618 if the initial retracement does hit some? Yeah, well, for the 382, yeah, same thing. We talked about filters for double top hitting the 382. If the retracement for the double top hit like previous structure, like this would be like this, that would be the same thing. If we came back to hit previous structure, I look at that the same as a 382 if we get previous structure. But I hope you guys are seeing that essentially everything that I look at the market starts from what we went over in the first 2 weeks, right? Everything I look at starts from just having the general knowledge of how the market ebbs and flows. Is that starting to make sense to you guys? Everything has to do with the basic principles we learned in week 1 and week 2 about new structure high, new structure lows. That is the backbone of everything in my trading, right? Is price action. You can take, patterns out of it, double tops out of it, ABCD patterns out of it, whatever fancy stuff you want to throw in there. Everything starts with that fundamental knowledge, that fundamental skill of being able to read a price chart. And I never want to go against what those basics tell me. If we're looking at something like this, I know exactly what side of the market I want to be on. I don't want to go against, what I'm seeing. A perfect example, let's see if I have it up. I know we had the German DAX. We had a structure-based trade on there. Let me see if I can bring it up real quick. There we go. A perfect example is this right here. I've gotten comments about this. I posted this to TradingView earlier today. I got comments about this about, Akil, why the heck are you looking short and X, Y, and Z? And it's pretty obvious. Structure price action is lining up. Let's get down to a 4-hour chart. I mean, for me, this is a simple trade. What are you guys seeing here, right? Correct me if I'm wrong. Are we not seeing, right? Starting point, boom, structure low, right? Outside return, new structure low. We break previous structure right here, previous structure support. We get an outside return. We get a lower low, lower close. What is this right here? This is an outside return, correct? Right in the previous structure. I want to go with what the price chart tells me. Why would you get short here? Why wouldn't I? Look at the risk reward. Where do stops need to go? Above previous structure highs, right? Why wouldn't I want to get short? This is a 5-to-1 risk reward. Probably more than that. I'm actually curious to see what this is now. This is probably a 1, 2, yeah, about a 5-to-1 risk reward. Now, going off of this, I know a few of you guys had questions about CTS trading. Let's walk through the CTS system with this. The question is, can you build your case for entry? Let me just do this real quick. Again, no one actually emailed me this question, but I know someone brought it up. Here's our combined technical score. Here's our checklist. I'll give you guys a few seconds to bring it up if you have it loaded up on your computer. You should have it printed out in front of you if you're this far. Jason says, Keel, I have a question. As you know, I'm backtesting the cipher pattern at the moment. I'm dreading CTS backtesting because you can literally build a case from pretty much any point in the market. Could you give me some guidance? Hey, how structured and backtesting the CTS? Well, here's the thing, Jason. If you give yourself requirements, you won't be able to. My screen freeze. Let me. There we go. If you give yourself requirements, you won't be able to build a case. In fact, using the CTS system is going to. Let me say this. Not using the CTS system. If you don't use the CTS system, you can make a case to get long or short at any point in the market. If you use the CTS system, it's going to give you built-in filters. It's going to give you built-in filters for your structure-based trades. I'm going to put this on my other screen, and we can walk through this. I'm going to get hammered on these trades. Ugh. That's going to stink. Anyway, we can walk through our CTS system one by one. So first, is the RSI overbought or oversold? And real quick, is this black chart bothering anyone? Would you guys rather me go to a white chart? I've gotten comments in the past about the black charts versus the white charts. Okay, seems like it's okay. So the question is the RSI overbought or oversold? In this case, we'd be looking for the RSI to be overbought. And we're not on this time frame. The 4-hour time frame, we are not overbought. So boom. RSI overbought? No. Let's start a little text deal here. RSI, OB, no. Let's change that to white and background blue. There we go. Back. RSI overbought? No. Next, do we have minor structure? What do you guys think? Do we have minor structure here? Should be obvious, but I got to ask you guys. Do we have major or minor structure here? What do you think? If we just follow our chart, right? Seriously, do we have major or minor structure here, guys? Support, boom. Support, boom. Support, boom. Resistance, boom. Yeah. I would say major structure. Major structure. Look at how many times we hit this thing, right? 1, 2. It's not exact, but 3, 4. 4 times in the last couple months or so. I would consider this major structure. A polar flip is a term I've heard before. And a polar flip is just this. When the market is putting in resistance, 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 and basically when that resistance flips to support. That's all a polar flip is. It's a very good sign. So yeah, we have major structure. Let's give ourselves a point. 2 points. Bang. We have major structure, 2 points. Next, do we have ratio confirmation? Well, let's see. Let's take a Fibonacci retracement. Let's go from our swing high to swing low. We know how to use this thing, right? Swing high to swing low. Bang. We're above a 382, so we can't really count that. Let's see if a 50% comes in there. Nope, we're below a 50% retracement. So nothing from this leg. Let's see from our most recent pullback right here. Okay, we got a 618 retracement right here, right? So you guys would agree? We've got ratios, not a lot. We've got ratios here. So let's add this in. Ratio, confirmation, 1 point. Next, higher time frame confirmation. Is there confirmation on the higher time frame as far as Fibonacci ratio structure and the direction of the underlying trend? Let's go higher time frame confirmation. We're on a 4 hour, so we got to go to a daily. Come on, TradingView. Do we have higher time frame confirmation? In this scenario, I would say no. We're looking at being with the underlying trend. We're not. The underlying trend, although when we go down to our 4 hour chart, you can see we clearly have a break below structure. The underlying trend is still heavily bullish on here. The underlying trend is, I mean, just scrunch up your charts. The underlying trend is bullish. So we're not with the underlying trend. So I would say no to higher time frame confirmation. And that's one you can choose. I typically never use that in my CTS, mainly because I just do higher time frame confirmation no matter what. But higher time frame confirmation, I would say no. So we're going to give ourselves 0 points for that as well. And really, this is all it is. The question is why? Well, we're technically still in an uptrend. We never have. Remember, to get a trend, we need something like this, right? We need boom, boom, boom. This isn't a lower low, lower close right here. So this is just a pullback right here on the daily chart. This is just simply a pullback. We can't technically say we're in a bearish trend because we don't get a new structure low outside of return and another new structure low. If we were to do something like this, if we were to go down, retrace back up, and then put in a new structure low like that, then we can make that case. But all this is a pullback right now. All we're getting right here is a pullback. So we're looking at this as being basically starting point to new structure high. This is just an outside return. Yeah, on a higher time frame. When we go down to the 4 hour time frame, it's pretty clear that although we're still in a pullback, we're stair stepping down, which is a good sign. But on a higher time frame, we wouldn't be able to give ourselves that point. Why do I keep dragging this fib? Yo, get out of here, fib. Get out of here. What is that? There we go. All right, so let's work our way down. Do we have an ABCD pattern completion? No, we don't. So we know that's going to be 0. Do we have an advanced pattern completion in there? I don't think so. Maybe in a lower time frame, but I don't think so. Do we have additional tests of structure? So this would be a double top at this level. We don't. And do we have RSI divergence? Now we don't. So if you're looking at building as a case, right now you have a CTS of 3. Right now you have a CTS of 3. So the question is, can you trade a CTS 3? If yes, then you take the trade. If no, then you can't take the trade. But you see how it filters us out of taking trades, mainly aggressive trades. We got to build that case. Now, here's one thing you can do. You're looking at this level and you're saying, man, this is a perfect point to get involved. And I know I do my entries based off what? I do my entries based off the lower time frame. So this is when I go down to my hourly. This is not a double top now. I do my entries based off my hourly. Come on, trading view. There we go. So let's say I were to get a double top here on the hourly chart. Boom. Let's wait for my RSI to come in. Look at my RSI. RSI is what? Over bought. Boom. So if I get a double top by hourly, what does that do to my CTS system? Well, if I get a double top here on the hourly, that's going to give me a point here. Boom. I'll have RSI divergence, a point there. Boom. I also have RSI overbought, a point there. Boom. I just took myself from a CTS 3 to a CTS of what? 1, 2, 3, 4, 5, 6. Make sense? Jason says, so you need a CTS of 4 plus. So you need a CTS of 4 plus you must have divergence and a double top that you are still in this trade, aren't you? You don't have to have a CTS of 4. You can set the CTS to whatever you want. It all depends on the trader. If you're an aggressive trader and you want to have a CTS 2 is enough for you, that's fine. If you're a very conservative trader and you need a CTS of 7, that's fine. Here's the thing about the CTS system, guys. You can make it fit whatever you want to be. When I first started off, when I first started trading the CTS, I was a very, very conservative trader. I had the CTS, but I had certain requirements in it. I needed RSI to be overbought, no matter what. I needed for there to be a double top, no matter what. I needed RSI divergence, no matter what, and I needed some type of structure. So I needed a CTS 4 at minimum to take a trade. Plus, if I had a CTS 4, but I didn't have, overbought, structure, double top, or RSI, I still couldn't take the trade. So I could potentially have a CTS of 1, 2, 3, 4, 5, 6, 7, 8, and not be able to take the trade. So I put filters in there for myself. I said, here's what's important to me. And it mostly went off my entry style because a double top was my reason for entry, right? And if a double top was my reason for entry, I also needed RSI to be overbought and divergence. I need all 3 of those things. So those are filters I put in to really make it a conservative strategy for me. But you don't have to do that. If you're a trader that doesn't need double tops for entry or anything like that, you can easily have a CTS 3. You can have major structure and ratio confirmation. You make it what you want, and that's based off your trading personality. Akil, why is the 60 minute on over? Well, RSI is over 80 here. You see this? It's over 80. Yeah. Yes. As soon as we get over 80, as soon as we touch 80, that's considered overbought. So it's not overbought right now, but it's overbought on our first top here. And that's what we're looking for when we search for our double tops. We're looking for this type of move right here. So we're looking for overbought on the first top. We're looking for a retest. With that retest, we're looking for divergence. So we're looking to have an equal high here with a lower high on our RSI. I was talking about you, but I now see that you have a double top and low tracker. I no longer require a double top. You don't have a double top down here yet. I don't require a double top, no. I don't personally trade this. I look at this because I have a lot of traders that follow different indices. So I don't personally trade the German DAX. But I no longer require a double top. I don't need that type of confirmation anymore. I did at one point, but over time, as I've learned more about the market, as I got more experience, I've become a lot more aggressive a trader, especially when the risk reward is in my favor. I would have taken this on the Sunday open. If I were trading this, I was talking to Neil about this, one of our former 12-week transformation members who follows this. I would have taken this on the Sunday open. At minimum, I would have waited for a lower low, lower close, which would have came right here. But this one, the risk reward is so great, guys, that I would certainly have no problem being aggressive. I think this is a great trading opportunity. But I no longer require a double top. I like to see it. I like to see it. Don't get me wrong. I love that type of confirmation, but it's not necessary. No, I don't personally need a double top now. How about higher time frame confirmation? Can we use the 4 hours higher time frame confirmation for the 1 hour? If that's your natural progression. If your natural progression when you do your analysis is look at the 4 hour and do your trading off the 1 hour, then yes, the 4 hour will count as your higher time frame. I know I personally use the daily. That's why I count the daily. But yeah, if your natural progression is 4 hours is my higher time frame, 1 hour is my trading time frame, then yeah. Whatever that higher time frame you use is gonna count as your higher time frame confirmation. So for some of you, it may be the weekly. For some of you that are day traders, if you're on the 5 minute, it may be the hour. Whatever that normal higher time frame is, but keep it consistent. Ooh, skunked out of pound yen. Out of pound yen. Are you going to re-enter pound yen trade if you get a double top on the 15 minute? Pound dollar trade. I'm still in the pound dollar trade. Am I gonna re-enter? Probably no. I don't day trade on Mondays, so I wouldn't be looking at the 15. But no, I wouldn't. That bird is annoying, guys. No, there's no reason to re-enter. No. Let me close that window. No, well, even if I did get stopped out, we broke and closed above previous structure. Why would I re-enter up here? Why would I re-enter a short and this is, yeah. Same thing. Look, we're still above structure here. Right? You see? Higher high, higher close right here. I would have no reason to take this. Isn't this a double top? Yes. But what we just had a conversation about, right? What did we just have a conversation about earlier, guys? What is the fundamental of my trading? The fundamentals is what? Not even that. We talked about this all last week, right? I said double tops and ABCD patterns are really dumb if you want to trade every one. Structure. Look at what we've done here, right? Swing low to swing high. Outside return. Higher high, higher close. Do I want to involve myself in a short trade based off a double top when we put in a higher high, higher close here? No. I don't want to take this double top. We're above structure, right? I think the market's going long. Does that make sense, guys? Higher high, higher close. New structure high. But the best double tops are at the top of the market, aren't they? Jason, what do we have here? What is this? Right? New structure high, right? What does a new structure high tell us? What do we expect from a new structure high? Trend continuation, right? So we expect the market to go bullish. Why would we want to get bearish? If we're expecting the market to go bullish, why would we want to go bearish? Can anyone answer that for me? Why? Why would we want to go bearish if the market, the chart is telling us, based on our use of the new structure high, new structure low principles, that we're going to continue bullish? Why would I want to get bearish? It doesn't seem like the best use for my hard-earned money. The best double tops are at the top of the market. Then at some point, a double top will be at the top. The best double tops come at previous structure. You want to see a good double top? If I go out to what's the daily chart, this is a good double top. Let me just draw this in. This is what you're missing. A good double top is this, right? Previous structure right here. Boom. Market does whatever it's doing. Blah, 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 blah. Ebb and flow, ebb and flow, ebb and flow, right? Here's a good double top. A double top that comes into previous structure, right? A double top at previous structure resistance. A level where the market has held before. This is a good double top. This is a trend continuation trade. We're above previous structure. And again, you just answered the question for yourself. You said that a new structure high tells you what? A new structure high tells you that we should continue bullish. So you need to take a second to think about it, right? If the market is telling you bullish, if your analysis is telling you bullish, 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 do you really want to go bearish? Probably not. Now, some of you are saying, Akil, new structure high, why did you take the trade then? If you're thinking bullish. Well, why did I take the trade, guys? A double top is not a strategy at all. An ABCD pattern is not a strategy. Again, I've said this a million times. I'll continue to say it a million times. If you think that you can go into the market and just trade every ABCD pattern or every double top, double bottom you see, you are going to lose money extremely fast. You're going to lose money extremely fast. I've done it before. Your life as a trader is going to be over quick. Go through your correct analysis. Identify, predict, decide, execute. That's why we do this. As soon as you identify higher high, higher close, your prediction should be trend continuation higher. Where is the market going to go higher? Once you do that part, that IP part, identify, predict, and your confirmation bias is saying, okay, look for long opportunities, look for long opportunities. Well, then you look for long opportunities. You don't look to get short because you're going to get blown out the water. The only reason I took this trade is because it was a Gartner pattern. And my rules say that I must trade every Gartner pattern. Is it a trade that I want to take on this time frame? No. I thought we were at an okay spot in the daily, full disclosure. But on the 60-minute time frame, did I want to take this trade as far as a counter trend trade? No. But it was a valid Gartley pattern. So guess what? Got to take it. Double top? No way. Higher high, higher close. Stay away. Red flag. This is trend continuation. We may have even hit 382 here. Nope, just missed it. No, we did hit 382. Even more reason for trend continuation. So don't get ahead of yourself, right? Work through the process. IPDE. Work through the process. And use those fundamentals of price action analysis. Use those fundamentals, use them to your benefit. It's really easy to get excited over different opportunities in the market. The market's going to give us a lot of them. It's going to give us a lot of double tops, double bottoms, ABCD patterns. It's going to give us a lot of opportunities that look good at first glance, but are really toxic. The market wants to trick us into getting into trade. The market wants to trick us into going short right here. It's out to get you. It's a living, breathing organism. It's out to get you. The market is out to take your money. Let's always remember that. Any other questions today? Have you backtested Gartley's on all the pairs you trade them on? Yes. Some pairs I've done a lot more extensive back testing than others. But yeah, I always test out a pattern before trading it on a pair. But there are certain pairs that I did a lot more back testing on than others. Now I'll tell you this: if I were strictly trading Gartley patterns, some of the pairs I trade, I wouldn't be trading with Gartleys. If education wasn't the main goal right now, I would certainly have a list of what patterns I can trade on different pairs in my portfolio. I just don't have the time to do that anymore. But I would definitely filter out a few pairs. For an ABCD pattern, does the retracement have to come to a 3-2? Yes. If it doesn't, you can still call it a harmonic move, but we can't technically call it an ABCD pattern. But there are ways around it. You can always change ABCD to harmonic move or 1-to-1 measured move if you want to cheat. There's tons of ways to cheat. Just make sure you're changing your plan, so it's not really cheating. It's in your plan. All right. Anything else? That was a quick hour today. Did it seem quick to you guys? Quick hour, man. I guess we didn't do much small talk. We kind of got right into it with DSRs and CTS. How many of you guys are interested in actually trading CTS, or is that something you're just gonna kind of push it aside for a while? Just curious. Most people push it to the side. Patterns are usually the more they're a little more sexy than the CTS trading. And it's easier in all full disclosure. It's a lot easier to start with patterns. I think it's easier to forward test CTS than back test it. I wouldn't necessarily say easier. I think it's more beneficial to forward test it than back test it. And that's for anything. I think it's a lot more beneficial to forward test any strategy than to back test it. Now you need to back test it to get those numbers, but unless you want to just forward test for years, but which some traders do. There's nothing wrong with that. I think forward testing will do a lot more for you because it's more realistic. Back testing, you can miss something, but like, oh yeah, I missed that. Look at that, and go back to it. In the real life markets, you miss something, you're done. And again, with the CTS system, guys, it's all about making it to your own. So understand that as you evolve as a trader, you're going to add stuff, you're going to take stuff away. You may get like me where I don't even use it, right? I don't trade the CTS. I don't require a certain point score. But do you guys know what the real gem is of the CTS system? I know Charles does. Charles has been through this type of stuff. Before we leave today, answer me this. What is the real goal of the CTS system? What do you think the best aspect of it is? It gives me belief before CTS in any system, complete disaster. Increased profitability, trains RAS, filters out bad trades. You guys are all wrong. All of you are wrong. Maybe not Yan. Yan's over there. The key to the CTS is consistent analysis. If you take anything from the CTS system, it doesn't matter what you use. That's going to be on you guys. It doesn't matter. The key is that each and every time you're looking in the market, you're going through the same process, right? If you have this checklist in front of you, each time you look for a structure-based trade, each time you analyze a chart, you should be going through this checklist, right? If you guys pay attention to how I, in the live room every day, when I look at charts, what do, right? I look at the RSI, I draw a fib on, I draw an ABC, right? Do I not do the same thing every time? I look for RSI, I look for structure, I draw a fib on, I draw a harmonic move, maybe a fib extension, an inversion, right? I do the same thing each and every time. That is the key to the CTS system. It's going to be, when you look at a chart, you're going to look at the chart the exact same way every time. Every time you look for a chart, in your mind, and again, I started with this printed out in front of me, you're going to get to the point where you just know it, but in your mind, you're saying, okay, look at the RSI. All right, look for structure. Put some fibs on. Look for higher time frame. It doesn't have to be in this order, but you guys get what I'm saying. All right, draw out a harmonic move. Is there a pattern? Is there a retest? Every time you look at the market, you're going boom, 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 boom. Okay, nothing. Boom, 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 boom. Nothing. Boom, 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 boom. Nothing. Imagine your consistency as a trader once you become this robotic. Just imagine. Once you have this type of structure in your trade, no pun intended. Once you know exactly what you're looking for each time, it's going to do wonders for your trading. Now, again, my recommendation is to print it out in front of you. Print out a couple copies, and each time you look at a chart, take a pen and just check it off. Boom, boom, boom. I did that for years. I literally had hundreds of CTS pages printed out, and each day I would go through it. I'd take a pen and I'd cross it out. Do we have this? Yes. Do we have this? No. Cross it out. Do we have this? Yes. And before you know it, when you run through your analysis, you're going to be as quick as me. Because in your head, you're gonna know exactly what you're looking for. You're not going to care about anything else. Well, hey Gary, what do you think about that? I don't care. It's not my CTS. I don't care about it. Who cares about pin bars, right? Where's the RSI at? Where's structure at? Where's higher time frame? Where's a harmonic move? What do we have here? It's going to be so simple. Are there points on the CTS that you must have now? No, I do not trade CTS. I would say this, I do need structure. I won't take a trade without structure. You guys have seen that. If I don't have structure, I won't take a trade. So if I were using a CTS, structure would have to be the key. I will not take a trade without structure. That is now the most important thing. So the only way I can take a trade in the middle of nowhere if it's something like a 2618. And that, by then, structure is already created. So you're more, I'm a lot more aggressive now than before. Even up to probably 2 years ago, I was very, very, very conservative. Very conservative. I always had intentions of being more aggressive. I'm still pretty conservative of a trader. I plan on being a lot more aggressive. I plan on no longer needing, depending on the scenario, no longer needing any type of confirmation. I plan on getting to the point where once it's in that kill zone, I'm just going to take it. But I'm not there yet. Not there yet. Are your results better the more aggressive you become? My results are better. I can't tell you that it's because of the aggression level. I am catching more trades that I wouldn't have taken before, but that's for better or for worse. Some of them are very, very good winners. Some of them are very, very good losers, and they're good because it was a good trade. So I can't say that my results have improved because I've been more aggressive. I just think that I just become better as a trader. I think that just the more experience you get, the better you become naturally. So I don't know if it's hand to hand. I know I am catching a lot more. I used to have a lot of opportunities where I would call it and I'd say, man, it's going to do this here, but I couldn't get involved. I am catching a lot more of those, so I'm sure that helps. But I think just naturally, I'm just getting more experience as a trader. I'm just evolving. I'm just getting better. Keep in mind, guys, I've only been doing this for what, 5 years, 5, 6 years. maybe 2009. If you don't count, just count Forex, 2009. So I'm still rather I'm in my infant stages, I would say, as a trader. I plan on getting a lot better. I plan on being the best trader ever. In case you guys want to know, I plan on being the best trader ever, and I hope you guys plan on being better than me. That's what I would expect. Yeah, and I would invite that, because once you're better than me, I would hope that we stay connected and we can just be very, very good together. That I can shoot you a, hey Jason, what are you looking at? You know, that's kind of how me and Jason work right now. Me and Jason Stapleton. So it just makes everyone better. So I don't, I'll still try to be better than you. Don't get me wrong. That's just the way I am. But all right, let's get out of here. Don't different strategies have different sets of rules? Yes, yeah. Yeah, I mean, pattern trading has its own separate set of rules for CTS trading, yes. So, all right, we're heading out, guys. I got to get ready for this webinar. Remember, that's coming up at 1 p.m. today, New York time. If you haven't seen the link, it's on the Trading Power homepage. So I'm going to go report in all these losses to the syndicate, make myself look bad, and then I'll see you guys later. If you're not there, I'll see you guys tomorrow in the live room. Until then, plan your trades. Are the questions? Hey, no. Hey, that's what I'm here for. Use me. Look, use me as much as you guys can. I will never get upset with you guys asking questions as long as they're positive questions. Now, if you're asking the same thing every day, then I'll get pretty upset. Yeah, but trust me, ask me questions. You guys, let's make no mistake about it. You guys are paying for a course. And in this course, I promise to be your coach. I promise to be your mentor. I promise to tell you everything I know about trading, right? If I don't do that, I'm doing you a disservice. So never, like Charles said, it might be tough love. It might seem like I'm annoyed sometimes. It's usually not because of you. It's usually because of the other traders that aren't in the course that want to ask me specific questions that they just don't know about. I got an email a few days ago about a guy that gave up on patterns after trading it for like a week. He's like, patterns don't work. I took 5 trades in a row that lost. I'm like, and he's been emailing me back and forth about filters and what if I don't trade this anymore after it loses one pattern? I'm like, those annoy me. So that may spill over to you guys, but it's all love. You guys, again, I love teaching you guys. Use me, even after you're done, Jason, and for any of you guys, even after you're done. When your 12 weeks are over, use me. You're here for life, as far as I'm concerned. So, all right, I'm out, guys. Until next time, plan your trade your plan. Thanks for the link, Charles. I'll see you guys tomorrow or later today. Take care.
All right, mic check 1 2 1 2. Can all you guys hear me clear and okay? See my screen as well? Charles says yes, yes, perfect. All right, guys, welcome to another live Q&A session. Didn't get a lot of questions during the week. I did have one though on. Actually, I did have a few regarding really just what pairs to start off with and what type of portfolio to trade. The question was, hey, Kale, I'm developing my trading plan. All right, Charles. I'm developing my trading plan. I have a dilemma about the portfolio. I plan to start trading bats and ciphers on the London session using my rules, 1 ATR stop loss, and an 8-pair portfolio on the 15-minute chart. Last week, I tried live trading on a demo account, of course, and felt underused. Today, I'm thinking in adding another time frame, 5-minute. My question is, in your opinion, should I trade more pairs and look for less time frames, or less pairs and more time frames? Or am I starting to complicate the plan? And should I stick with 8 pairs on the 8 pairs on the 15-minute time frame? And you know, some of you guys, many of you guys heard it in this morning's war room meeting with Jason, but you guys got to understand that trading it's not about seeing a certain amount of action. You know, obviously you do need to trade a strategy that sees a certain amount of trading opportunities, but by no means does that equate to, you know, if you don't have, you know, 5 trading opportunities a day, then you need to go out there and hunt for more. What we want to do is we want to trade a portfolio, and we only want to take the best trades. We only want to take what the market gives us. And sometimes we're going to have really active weeks where the market gives us, you know, 20-something trading opportunities a week. Other times we're going to have boring trading weeks where the market may give us 5 or the market may give us 2. And we gotta be secure enough in our trading plan to be able to adapt to both instances. And what I see a lot of traders get into trouble when something like this happens, when they're trading let's say an 8-pair portfolio and there aren't that many trading opportunities a week. So they start going on trading blogs or trading forums, or maybe looking at what Jason and I are looking at, and they start adding a few more pairs to their portfolio. And before they know it, they're trading, instead of trading 8 pairs, maybe they're trading 12 pairs. And basically they when you start doing stuff like that, you end up having the risk of overexposing yourself. And by that, I mean, you know, having too much money on the table at once, and really giving yourself the chance of blowing a lot more than what you should and what you should prefer. So to that question, Ricardo, again, I would stick with 8 pairs. Honestly, if you're trading in 15, if you're going to be day trading, and I would look at the 15-minute chart and the 5-minute chart is going to be very similar. If you're going to be an active day trader, I think 4 is a really good starting point. I think I wouldn't go any higher than 6, to be honest. I think 8 pairs for a day trader is pretty tough. That's a lot to look at, unless you're trading. You know, a lot of it's going to depend on what you can handle, obviously, as a trader. But I would stick with 4 pairs and just really focus on those 4 pairs, and that's it. Once you get into 8 pairs, 10 pairs as a day trader, you're going to start missing a lot of opportunities, and that's gonna slowly eat into the expectancy of your system. Now, again, if you're a swing trader, it's different. If you're a swing trader, you can afford to watch a little more because there's not going to be as much action. You know, you can load up a 240 chart like what you see in front of you. You know, and you may not have a trade this week on Eurodollar. You may not have a trade this week on Aussie CAD. So you have plenty of time to you have plenty of time to wait out those trades. But as a day trader, the action comes pretty quick, and you want to make sure you're not missing valid trading opportunities, because that's going to get you into trouble down the line. So wanted to address that. I know a lot of you many of you are at the point where you don't really care too much about portfolio right now. Am I correct? I know everyone's coming in at different points in their journey, but I know a lot of you aren't really concerned with that right now. I hope that answers your question, though, Ricardo. Building my portfolio. Yeah, you want, of course, back testing is going to tell you what portfolio you should trade. I always like starting with the basics, just when you want to get an idea of, hey, what should I be looking at? I always like starting with the majors. So you got euro dollar, pound dollar, euro yen, pound yen, Aussie dollar, dollar yen. These are the ones that are typically going to be, these are always at the core. Excuse me. Some good water. These are always going to be at the core of some of the pairs that I want to test when I get into the testing range. Then after that, I may look at some of the minor crosses, so stuff like New Zealand dollar, Kiwi, dollar CAD, and you get into your Euro Aussie, pound Aussies. You got your Euro New Zealand if you want to do Aussie Yens, Aussie CADs. There are tons of these minor crosses, but when I typically look to set up a portfolio, I always look at these first. I'll say, hey, I'll have an idea of how many I want to trade, but I'll start with these majors, and then whatever I need to fill in, then I'll go to my minor. So let's say I do, let's say euro dollar works, pound dollar works, euro yen works. Let's say pound yen doesn't really work with whatever I'm testing. What I'll do is I'll scrap that out, and maybe I'll add another yen pair. Say I got $3 crosses in. Say I want to have 3 yen pairs in. So I'll take pound yen out, and then I'll go to an Aussie yen that I tested and say, well, let's put an Aussie yen because I want to have 3 yen pairs. And let's say I want to diversify a little bit. I don't have anything that trades Canada. So let's test out, do I want to do dollar CAD? Well, maybe not, because I already have $3 crosses or $4 crosses in here. And I don't want to put myself at the risk of overexposing myself in dollar pairs. So let's add an Aussie CAD. So now I have 2 Aussie pairs. I've got 1 Canadian pair. I've only got 1 Euro pair or 2 Euro pairs. Say I want 3. Let's add a Euro Aussie, something like that. Well, now I have 3 Euro pairs. Now I have 3 Aussie pairs. And you go through that diversification process. Again, at the end of the day, your back testing is going to tell you a lot, because you're going to be able to say, okay, well, back testing tells me this just doesn't work, so let's not even worry about it. But I like a good amount of diversification in my pairs. I don't want to, I don't mind the dollar pairs too much. The dollar is a major currency pair, so you're going to see different movement on many of the dollar crosses. But pairs like the yen, I really fear being overexposed to yen, because the yen typically moves the same on almost every cross. There are times where you can look at an Aussie yen, New Zealand yen, dollar yen chart, and they will look exactly the same. And I don't want to put myself in a position where I've got I got a Gartley pattern on Aussie yen, and I've also got the same exact Gartley pattern on New Zealand yen and Canada yen, and I've got to enter all 3. Because then I'm putting myself in a position where it's like, well, if it wins, it's great. But if I lose, that's going to be one big drawdown at the same time. And you guys know me. I like to keep my drawdowns to a minimum. So diversification is always key. But as Jason said, the best way to start, of course, one time frame, one strategy. Once you feel comfortable, once you've mastered the Gartley pattern, and you've proven to yourself that you're able to trade that consistently on the euro dollar, then you go ahead and add one more. It really is baby steps, guys. There is no benefit. There's no benefit to trading a million pairs at once. There's no benefit. All that comes is more confusion. So, my advice is always, and this goes for trading strategies as well, take your time. Pick one thing. Pick one thing that you like in the 12-week transformation so far. And it could be structured trades. Usually you guys pick patterns first because they're a little easier. The rules are more black and white. But pick one thing, master that one thing, start trading that one thing consistently. Trade it effectively. Then, as you're making some money with that one thing, as you're trading well with that one thing, then you can go add more. And you start that. You can do that back testing process on those slow days. So when you get a day where say you're only trading euro dollar and pound dollar, with Gartley patterns, and it's just a slow day. You got nothing. You're like, man, the market is just doing sideways. What do I do? Where in the past you would say, well, let me force a trade. Let me go find Aussie Canada and trade that. Now you're like, well, there's no trades today. Guess what? I've got 3 hours. This is my 3 hour trading block. Let me do some back testing on Euro Yen. And maybe you spend a week back testing Euro Yen. By the end of the week, you see that Euro Yen also gives you positive results. Well, guess what? Now your next trading week or your next trading month, well, now you have a portfolio of 3 pairs instead of 2. So always kill that boredom time, kill that downtime, doing something on the educational side of things. And you have access to this information for life, guys. You have the 12-week transformation videos don't go away, so there's no rush to consume everything at once. Master one thing, and then could be a year later, go back to the cipher pattern, learn ciphers. There's no rush. I am wondering how to start, maybe looking at pairs with the largest ATR to get more movement. Again, I think I'm a little late to these questions, but you do want to have a certain amount of ATR. You do want to watch that, though, because certain pairs may get you in trouble. If you're starting on the day trading side of things, if you're a day trader, I always say you want to pick pairs that are going to move during your day trading time. So, when I day trade, I have a lot of euro pairs. I have a lot of dollar pairs in there because, well, I trade during the London, New York crossover. I trade in that session where both markets are open. Would I want to day trade Aussie New Zealand when the Australian market, the New Zealand market, all those, it's 2 o'clock, 3 o'clock in the morning? Probably not. So I want to pick pairs that move while I'm trading. Same thing. I've never traded to London, but I'd be, I'm not sure if I would trade dollar Canada during the London session because those markets just aren't open yet. But that's for day trading. As far as swing trading goes, you do want to pick pairs that give a lot of opportunities. You do want to have something that has a good ATR, but just be careful that ATR works into your risk profile. Certain pairs like pound yen or pound Aussie, Euro Aussie have really big ATRs. So trading a 4-hour chart position-wise is really like trading a daily chart, and that may not be something that you want to do, meaning that many patterns on the Euro Aussie, you're going to have over 100 pip stop loss on a 4-hour chart. Now, if that stop loss is too big for you, maybe that's a pair that you want to say, you know what, I'm just going to move that pair to the side and pick up something else. So you do need a certain amount of range. Excuse me. You do need a certain amount of range, but you also want to make sure it stays within your comfort zone. Gretchen says, when they say the market trends only 30% of the time, please explain what that means, and are they counting all the little consolidation pieces such as those within outside returns, or are they counting only significant longer periods of consolidation? Well, it's just in general. The market's going to move the same on lower time frames and higher time frames, just in smaller waves. But when they say the market trends only 30% of the time, they mean just essentially like this, like movement where we had basically upward movement and downward movement like we had the other day. A great example is this. This would be the market. That would be the help menu. This would be the market trending. Let me go ahead and delete this. This would be the market trending where we're just, that move, bang, bang, swing low to swing high, consolidation, this whole period right here where the market's just going sideways. You can see, boom, swing low to swing high. And then, again, just sideways. You can see this. I don't have a lot of data loaded up, but this would be the market trending. We're putting in this consistent motion. And consolidation. Now, again, this means, to be honest with you, it means nothing for your trading. This shouldn't affect your trading at all. But that's what they mean. Most of the time, the market is in consolidation, but they don't mean by, and I have no idea who they are. Just in general, that's just what the market does. But it doesn't mean a specific time frame. It doesn't mean like, hey, on the daily or on the 4-hour, because you're going to get the same type of movement on lower time frames, just at a smaller level, of course. Akil, would you say I should now go back and back test Bat or Gartley on the same pair on all time frames? Jason says, I've just finished back testing the Aussie CAD pair with ciphers. Would you say that I should now go back and test Bats or Gartleys on the same pair on all time frames? I would finish your back testing on cipher patterns first. I'm a big fan of mastering one pattern before moving on to the next. So whatever other pairs you wanna test on, well, is Aussie CAD the only pair you plan on trading, Jason? Yeah. So I would stick with ciphers, and then back test it on the other 3 pairs first. Then once you've back tested on those 3 pairs, then move on to bat patterns. Again, I mean, that could just be me. How my brain works. I'm kind of a task completion type guy, so I like, hey, whatever I want to do on ciphers, I want to get all of that out of the way and have my cipher portfolio, and then add my bats later. I don't want to do ciphers then bats on one pair and then move on to the next pair. I'd much rather have a 4-pair portfolio I can trade and then make some money while I'm back testing the other things. Gretchen says, makes a difference when choosing which type of trading to concentrate on. Trends generally give you enough time to regroup and trade, but consolidation is only tradable if it lasts a reasonable amount of time. I don't think it makes a difference. Again, if we know the market consolidates, I mean, you can make money trading trend continuation and counter trend. Now, the difference is that with a trend continuation trade, your targets are going to be much bigger than a counter trend trader. So you're just shooting for a lot more. So although the market may be trending less amount of time, and as a trend continuation trader, you're going to have a much lower win percentage than a counter trend trader, it doesn't mean you're going to make less money. The win percentage really doesn't have that much of an effect on how much profit you're making. Again, a counter trend trader, you may be doing something like this. You may be getting 20 pips here, up 20 pips there, up 20 pips here on 4 different trades, and then take a 5th trade like this and get busted out. Trend continuation trader, you may be taking a loss here, a loss there, get 1 winner, and still make the same amount as the counter trend trader made. So the win percentage of your system doesn't really have too much of effect on your profitability. It's just different. As a trend continuation trader, you're catching much bigger moves. You may catch something like this. For a counter trend trader, you may catch something like this, but then catch something like this. So it's just different. It's just different. So could you point me to a pair in your experience prolific for patterns like the Aussie CAD? Like I said, I test the majors first. I always start off with euro dollar, pound dollar, euro yen, pound yen, dollar yen, Aussie dollar. I always start with those. Yep. Now the key is going back to the trending consolidation. It's very important to remember, guys, that we never know what the market's going to do, and that's why it's key that we be consistent in our plan. And really, it's key that at least in the beginning of your trading career, you choose one way to trade. Don't try to do both, because a lot of traders come in with the assumption that, well, I'm just going to, when the market's trending, I'm going to be a trend continuation trader. When the market's in consolidation, I'm going to be a counter trend trader. And the problem is, we don't know that the market is trending until after it's trending, right? The market's doing something like this, right? We don't know that the market's in trend until we've done something like this. We don't know the market's in trend until we get that higher high, higher close. So by then, it's, you know, if we're a trend continuation trader, we're late, right? We don't know that the market's consolidating until we get to here and we hold. So if we're a counter trend trader, we're entering here, we're too late. So we can't guess these things. We got to be consistent. We got to follow our principles. If you end up guessing, you're going to strike out. And a lot of us, I've done this in the past. A lot of us have done this in the past. You're going to see this breakout and be like, oh man, trend continuation. I got to hop on. And then you get long right here. You get long right here, and then the market does what? Boom, retracement, and then you get stopped out. And then as soon as you get stopped out, the market continues on its way, and you're like, oh man, missed it. But you trade both. CTS can be used for counter trend. Well, yeah, well the CTS system, here's what I do, and I'll tell you this, I'm not a true trend continuation trader. Because let's talk about a potential trade. Let's say the market does this, right? Let's say the market, I wonder if I can actually find a good opportunity here. All right, let's look at, I wouldn't want to get long here, would I? All right, well, let's kind of crunch down this Aussie. Let's say I would want to get long here. Let's go to, I thought I had a trade on my radar. Aussie dollar. All right, yeah, let's look at Aussie dollar. So Aussie dollar, we have just done what? We've just did this, right? We've put in, right, higher high, higher close, right, guys? We just put in a higher high, higher close, and we're getting a retracement back in the structure. Now, there's not enough here for me to want to take this trade. I thought there was. Not enough for me to want to take it at this level. I don't really have a structure level to put stops under, which may make my point. We have a double bottom on the 60, which is good, but there's no major structure. But so you guys are me, right? Let's say I entered a trade right here. I go down to the 60-minute. I see the double bottom. I don't think it's not a bad trading opportunity actually at market, guys. There's just not enough. I don't think it's a high probability trading opportunity. But let's say I enter right here, right? Put yourself in Akil's shoes. Where would I take targets at? Where would Akil take targets at from what you've seen in the live room, right? I'm taking targets probably somewhere at the highest point, probably right here, right? Previous structure. Right? Would all you guys agree? Just based off what you've seen me do so far? Yep. Well, this is not a true trend continuation trade, right? Because I'm not trading for a continuation of this trend, right? If I were trading for a continuation of this trend, right, I would be looking for what? I would be expecting the move to go higher, right? I'd probably do this. I'd take Fibonacci extension, swing low to swing high, back down. I'd probably look for that, Fibonacci confluence, maybe do something like this, ABCD pattern completion, and say, oh, well, look at that. ABCD pattern completion, right at a 127 extension, right? I would be shooting for the trend to continue up here. You guys don't see me do that. And I always say I'm not a true trend continuation trader because I don't do this. Right? Where would stops be? Stops would be down here, right? Above our previous outside return. For a trend continuation trader, not a bad opportunity. Not a bad opportunity. 2-to-1 risk reward. So I'm not a true trend continuation trader. I don't shoot for this extension. I look for structure to hold. Now you can take the CTS system and enter, you can enter, you can use that as an entry reason for trend continuation type trades. So let's say, and this week a lot of you guys are on double tops and double bottoms, right? Let's say you are a trend continuation trader, right? You're someone that's shooting for this target up here, and you're saying, okay, well, I want to get long on this outside return. How can I do that? You can use that CTS system to build a case for entry. You can look down here and say, okay, well, I have previous structure looking left. I have RSI oversold. I have retested structure, double bottom. I've got RSI divergence. I've got fib confluence. Confluence. So even though I'm a trend continuation trader, I can use this CTS system. I can use the counter trend trading technique to enter the trade. Does that make sense with you guys? I know it's a little bit confusing. I guess I would break it up like this. Whether you're trend continuation or counter trend has to do with where you're expecting the market to go to get your targets. But there's always a difference between the type of trade it is and the type of entry you use. Does that make sense, or am I losing some of you guys? And if I am losing, just let me know. I know it's a little confusing. Gretchen gets it. Okay. I'm serious, guys. If you don't get it, let me know. But you can use this would be, say you were to enter here on this double bottom, this would be a counter trend trading technique as far as your entry, entering a trend continuation type trade. If you were to do something like this, if you were to I can't even tell you a trend continuation technique other than a breakout. A trend continuation technique would just have to be a breakout. So this is what you'll typically see me do. I may say a trade is a trend continuation type of trade because it is, but I don't personally take it as a full trend continuation type of trade. I look for a retest of structure. I always look for structure for targets. Very rarely do I look for that extension in the trend unless I'm shooting for secondary targets. And most of the time in a syndicate, you won't see me do that because we've made the decision only to trade one profit target. But I would always look for my first target to be here and base my risk reward off of that. Then if I want to hold on to that second position for a trend continuation move, then I look for that extension on the second position. But that's why I call myself, I take trend continuation type opportunities, but I'm not a true trend continuation trader because I just can't shoot for that extension, at least with initial targets, because it just goes against my principles of my counter trend principles and the importance of structure and whatnot. Would you consider being a swing? Would you consider being a trend continuation trader on the swing trading time frames and a counter trend trader, counter trend trader for your day trade? Yeah, you can do that. Again, you want to look at your swing trading and day trading as being two completely different techniques. So yeah, you can be on a swing trading time frame. You can say, hey, I'm a trend continuation trader on my swing trading. I'm looking for those bigger moves, looking to hold it a little more. But as a day trader, I'm counter trend, looking to get those short bounces. Yeah, there's nothing wrong with doing that. There's nothing wrong with doing that at all. And again, it goes back into that 70-30 rule. You're gonna get a lot more counter trend trading opportunities than swing trading opportunities. So if you want to be an active day trader, you're trading a system that's going to give you a little bit more opportunity than your swing trading. You kind of just keep an eye on that every day. You say, hey, you looking for this trend continuation trade, it may come sometime this week, and it makes that type of analysis a lot easier, cuts down on the time. Now realize if you're a trend continuation trader, you're not going to be taking advanced patterns. Advanced patterns are counter trend trades unless, and here it gets a little confusing again, unless you're using an advanced pattern as an entry technique into the bigger time frame trade. Which, again, that lost people, that would mean something like this. If you're a swing trader and you're seeing something like this and you're looking for a trend continuation trade and you're saying you're seeing this and you're using that Gartley pattern as simply an entry technique to get into that overall continuation move. And again, I hope I'm not losing people. If I am, just let me know. Slow me down. Trading can get complicated, which is more reason to focus on one style. And then once you've mastered that style, then move on to the next style. You can definitely use all these skills together. But mainly, guys, the difference between counter trend and trend continuation, at least the way that I teach it around here, is mainly what you're looking for as a target. Are you looking for an extension or just a brief pullback? That's how it's separating in your mind. Am I looking for a full extension and continuation or just a brief pullback? I used CTS to enter this exact trade earlier this morning, UK time. Nice. It's not a bad CTS trade, guys. You're looking at structure. You got structure, RSI. Probably CTS 5 or 6 you can make out of this. I was ironing it Friday night on TradingView. There's a similar situation on the pound dollar with an advanced pattern depletion. Also, however, the pound dollar is moving the wrong way currently. What's the cable doing? Yeah, looking at cable as well. Cable's got another interesting situation. This is, wow, that's a big candle we made this morning. I'd like to see this thing retrace a little bit deeper. Our structure level, this is, again, this wick is what ruins everything. This wick kills everything because our structure zone is now from here really to here. It's really hard to dial down on where this thing could potentially reverse at. It's a tough one. It's a tough one. And we did have a lower low, lower close here. Dion says, Akil, can I ask for 2618, from which peak do we take the high from? For 2618, when you're measuring the Fibonacci, you would take it from the most recent swing high. So if we were looking at it from, let's just use this. I wouldn't look at this as a double top, but on this time frame, but you would take it from here to here. So the right peak, the one on your right, the second test of that double top. So if you're getting a double, or let's do a double bottom, you're taking a double bottom like this, you would take it from the right one, this one. Yeah, it doesn't matter which one's higher. You take it from this one because this would be, when you break structure like that, this would be our impulse leg. This would be our sore thumb swing low to swing high. So we always want to measure our fib from that move like this. Yep. Even if this one's lower or higher, we want to take it from this last move. This is where we're going to get a valid Fibonacci retracement. Yep. Now, how many of you guys in here trade the 2618 or are considering trading the 2618? What are your rules up to this point for it? How are you thinking about trading? Are you thinking about being an aggressive trader, conservative, somewhere in the middle? What are you guys looking at? Aggressive. Buy after low, so waiting for some confirmation. Conservative. Okay, because there are different ways to trade the 2618. I put out a video this week on my YouTube channel about New Zealand dollar 26.18, and then I got a whole bunch of comments about it. They said the whole point of a 26.18 is conservative, correct? Yeah, it's to tell you 26.18 is the point is to wait for confirmation that a double top is truly a double top. So, or that we're really going to see a reversal. So you're looking at something like this. You're looking at a break and close below the structure level right here. And then we're looking for a retest. Now, here's the thing. What does a 26.18 trade look like? And full disclosure, I'm not a 26.18 trader. I'm not. I mean, meaning that I trade 26.18s, but it's not a strategy I trade in itself. But you're looking for, right? It's a trend continuation trade, right? Is it not? Right? Initial structure high, or initial structure low, I should say. We're looking for an outside return, right? Is it not a trend continuation trade? So if we're looking at an outside return, where do we expect our outside return to come to? What's our zone for where our outside return should come to? Right? Previous structure, which is right at this orange line, right? And we shouldn't do what? We shouldn't come above here, right? So this is our zone. So first and foremost, in 26.18, here's our reversal zone. And again, we dumbed down the strategy because we gave the strategy out free. We dumbed down the strategy to make it simple for people. But in reality, this is our reversal zone, right? So as a 26.18 trader, it's really just a trend continuation trade. And your reversal can come all the way from here to here. Now we made it simple by saying this. One way to predict where that zone is going to be, because if we're looking at a good trending market, in case you guys didn't know, the 618 is the most important Fibonacci ratio, and typically when you get a healthy trending market, that's the one that's hit. So we pinpointed this 618 and saying, well, if you're an aggressive trader, what you do is you just put a limit order on this 618 and sell it, right? Because guess what? If you're an aggressive trader, you see Jason do this all the time. If you're expecting the market to reverse in this zone, if you're expecting it to come down here, and if your stops are up here, you have a more than one-to-one risk reward, correct? Right? Would you guys say, yeah, more than one-to-one risk reward inside this zone? Right? So why wait? Just take the trade. Right? You have the edge over the market. Your reward is bigger than your risk. Right? Why wait? Just put a limit order right there, fire off the trade. So taking it at the 618 is a very aggressive way to do it. You don't have to trade it that way. And a lot of you said you're more conservative. There's nothing wrong trading it this way at all. But understand it's aggressive because you're just putting a limit order. Market could easily do this. If you're conservative, here's what I would recommend. You start using that if-then thought process. You say, if price action hits that 618, then I look for a reason for entry. And that can mean going down to a lower time frame. Yeah. And then once you're down to that lower time frame, then you got to go through your whole slew of entry techniques. Lower low, lower close candlestick formation, double top, pin bar, whatever it is that you use. But that's going to be the more conservative way of doing it. And there's pros and cons of it. Again, I feel like we talked about this before. Well, I mean, obviously we talked about it before. I feel like we talked about it maybe a week or so ago. I'm not sure. Anyway, it's a good refresher. Pros and cons to it, right? If you enter aggressively and the market just hits it, pings it, shoots down, you conservative guys, well, you're out of luck. However, you could see this. You could hit that 618. You could not get what you're looking for until up here. The market may retrace a little bit higher before giving you your entry technique. And now guess what? Your risk reward just got a lot better. So there's pros and cons to both ways of trading. I think it's a good technique. I do want you guys to understand that it really is just a trend continuation trade, though. A trend continuation type of trade. It's no different from. It's really no different from looking at what we just looked at on the Aussie dollar and saying, "Hey, retest the structure. Let's see if we can hit the reversal on this outside return and play for that retest the structure." It's no different, aside from the fact that it's coming after a double top, which is going to give a little more credibility because a double top tells us what? A double top tells us, just thinking about the market, that the market tried to beat down this level, got rejected. It tried to beat down this level again, got rejected. Lower low, lower close. This tells us this is the first sign at a rotation and trend that, well, the bulls have been defeated and the bears may be looking to take over. But you don't have to trade the 2618 as a strategy on its own. You don't have to say that, hey, I'm going to be a 2618 trader and trade every 2618 I trade. It's not like an advanced pattern. You don't have to do that. You can use it as a part of your CTS. You can even add it to your CTS score. Many of you haven't got to the CTS system yet, but you can add it in there. You can take out if you're an advanced pattern trader, you can take advanced patterns out of your CTS system because you're going to trade it anyway. And replace that with 2618. Maybe give it 2 points instead of 3 points, but you can easily replace that with 2618 and use that for building a case for entry. That's the cool thing about trading. You guys can make it your own. Questions? Either I lost you guys or I'm making perfect sense because no one's typing anything in. Hopefully that means perfect sense. Jay says top-down analysis. Sure, let me know the question. Now, just to finish this off a little bit, I talk about double tops and double bottoms. That was week. That should have been, I think, this week. Or maybe last week. Again, everyone's at different points, but I think many of you are at double tops and double bottoms. We talked about this before, but hope you guys realize that taking every double top and double bottom is not a good idea. You know, if you have something like this, if the market's been up here, you got something like this, and the market gives you a double top right here, that's not necessarily a good trade. If there's structures up here, let's say there's nothing in here, just because it's double top doesn't mean it's a good trade. What I would do is if you're someone that trades a 2618 technique, when you get a double top that's in an area that doesn't meet the rest of your CTS requirements, that doesn't meet your structure requirements or maybe your Fibonacci requirements, that's when you wait for that 2618 and that little extra confirmation. Does that make sense, guys? Yep. So you can say if I have a double top or double bottom at previous structure, then I look to execute that trade. If I have a double top and double bottom, if I have a CTS score that works, but I'm missing structure, so I'm missing that safety, then I wait for 2618 so you get a little bit more confirmation. And that's going to help you out on getting burnt by some of those random double tops and double bottoms that many new traders often get burnt by. So many new traders I work with just go and try to trade every day. They send me pictures and charts and say, hey, Akil, I got into this double bottom and I got blasted out. How come it didn't work? Well, because it was just randomly in the middle of no man's land. There's no structure. Why would you think it was going to reverse there? Yeah, but it was a double top. So a good rule of thumb is if you have this, and again, I haven't looked through many markets, but if you have that, wait for that 2618, and that can be a little bit more confirmation on how to get in, or on getting involved in that type of trade. Please, could you just run through a live market now if there's anything happening? I don't know. If you give me a chart and I'll answer a question for you. I'm not going to do my top-down analysis takes like an hour to do, like a half an hour to do. If you give me a chart you want to take a look at, I'll look at it, but I'm not going to run through my entire portfolio. Gretchen says, if you get a chance, can you please go through, if you get a chance, can you please go through one of the trade steps that goes from higher time frame to a kill zone and then a lower time frame for entry? All right, what? Give me a pair, guys. Well, yeah, I'll do this. We can do Aussie dollar. Aussie dollar was a perfect example, so we can do that again. Yeah, there's not too much that interests me out here. You can do Aussie dollar. Let's start on daily. And then we'll look at New Zealand dollar after that. So Aussie dollar. I'm looking at the daily chart, and the first thing I see, again, identify, predict, decide, execute. I see that we have broken and closed above previous structure. Looks like we're holding this minor structure level right here. We've broken and closed above our most recent resistance zone, and now we're coming back in to a previous zone of support, resistance, which is now support. So as I look on Aussie dollar, the only thing I'm looking for at this level, I say, hey, well, I would look for a chance to get long. We have a nice daily hold right here. Basically did nothing yesterday. It was Saturday or Sunday. And now we're fighting off that level right now. So I would identify this level, this structure level, as a place for me to potentially get long and ride this trade up. So I would then go down to my lower time frame, which is my 4-hour. I can even throw those same DSR levels on there. Boom. Throw my DSR level on there, and I can say that this was the DSR level, or this was the place where I was looking to get long on the daily, and I can measure out my zone. I can say that, well, here's my potential kill zone. I'm looking to get long. Do I have anything in here that tells me that I can get long at this level? How can I build my case for entry? And you can start doing Fibonacci. You can do Fibonacci retracement from our swing low to swing high. You can see we have a 50% right there that we just hit. Boom. We're not going to get anything from here. Nope. We could take our most recent swing low to swing high right here. Not going to get much there either. So all we have is a minor Fibonacci right here. If we're going through a CTS checklist, we can build our case. We can say, hey, we got minor structure. We've got fib confluence. We've got the RSI did go oversold. So we got a CTS of 3 right now. Now, say you're a trader. Yeah, we did higher time frame already. We did a daily right here. So let's say you're a trader that says, hey, you know, this is the level I want to get involved at. This was the kill zone I was looking for. what I want to do is I want to go down to a lower time frame to look for my entry technique. And let's say my entry technique is a double bottom. A double bottom is my entry technique I need to get involved in the market. So then you go one more time frame down to your 60. And you say, at this level, do I have what I need? Do I have my double bottom entry technique? And you can see right here, 1, RSI, looks like it goes oversold, yep. Boom. Your double bottom entry technique was met. And then you enter the trade according to your rules. So again, the top-down analysis is really just IPDE. It's doing your identifying your prediction from your higher time frame, seeing what side of the market you want to go on. Then as you dial down, do the majority of your analysis on your trading time frame, your 4-hour chart. For me, it's my 4-hour chart. This is where I do the majority of my analysis from. So I'll do my fibs and whatever else I'm drawing on there, structure, harmonic moves, and then once you come to the conclusion that you do want to take a trade at this level or you don't want to take a trade at this level, then you go down to your lower time frame for that entry technique. So your higher high, higher close in this case, which would have got you involved right here. Your double bottom, which would have got you involved right here. Your 2618, if it happens, which can potentially get you involved, anywhere back in the zone like that. Yeah, a double, understand this, guys, a double bottom isn't a strategy. A double bottom is not a strategy. It's I guess it could be a strategy. I wouldn't, yeah, a double bottom is a technique. You don't want to trade, you don't want to say, I trade double bottoms. That's not a good strategy. For structure-based trading, you want to use that CTS trader. Some people trade double bottoms. Yeah, but if you trade every double bottom, you're going to get burnt. For me, a strategy is something that you can use consistently. So advanced patterns, cipher patterns is a strategy you trade consistently. You want to trade every single cipher pattern. A double bottom is a technique. CTS, that's a strategy. You trade a CTS system. So you take a handful of items, you build your case for entry, and you enter during that. A double bottom by itself is not a strategy. It's just something in the market. It's a technique. I would highly recommend not trading a double bottom as a strategy because, again, if you try to trade every double bottom in the market, you're going to lose. You would have lost right here. You would have lost double top. You would have lost right here. You're going to lose a lot more than you're going to win if you try to trade every single double bottom or double top. Trust me. By itself, it doesn't mean a whole lot. It only has power when you combine it with the rest of the skills that are in your CTS system. When you combine it with, I have a double bottom with structure, with Fibonacci, with the RSI overbought, with RSI divergence. When you start building your case, that's when you turn it into a profitable strategy with the CTS system. So by itself, a double bottom is not smart. And I recommend trading it. I recommend doing some testing on just finding every double bottom. It could be, it doesn't have to be full back testing, but just scrolling through your chart and saying, well, what happened if I were to take every single double bottom I found in the market or double top? And I think you'll be surprised at the results. Same thing goes for ABCD patterns. You're going to be very shocked if you see what happens if you try to trade every single ABCD pattern with no filters. You're going to be on the losing side of things. Now, the CTS system is a strategy. Double bottom can certainly be an entry technique within that strategy. Someone said New Zealand dollar. We can do New Zealand dollar too. I have lots of back testing on my spreadsheet now. There was a video where Jason filtered down a time of day. Could you show us how to do that? I think it was on fine tune. I'm not familiar with that. I would check the video on the website. I'm not familiar with that. I'm not too familiar with that trading spreadsheet. I don't personally use it. I do it old fashioned. I create an Excel sheet myself and just crunch the numbers myself. I'm not sure how to take the spreadsheet and fine tune the stuff. I can see if I can find it. I'm old school. If I can use a pen and paper, I would. I don't really like the fancy stuff, guys. I like the fancy stuff for the money management because I don't have to do anything. But as far as the back testing, I'm old school. I like creating the spreadsheet myself. And you guys seen that in the well, you haven't got to, many of you haven't gotten to the trading video yet, but you'll see that in the trading video. All right, let me see if I money management 12 week. Is this it? Nope. 12 week money management. Is this it? Got so many spreadsheets. Yeah, that's a question. I would say this, Jason. Either go back. We have a few videos on the money management spreadsheet where Jason's teaching it. That's a question where either go back to those videos and watch it, or go ahead and shoot Jason an email, and he can help you out with that. Now, time of day is only worth it if you're going to be a day trader. I would say that. If you're a swing trader, time of day is not going to mean anything for you. But for a day trader, it is interesting to see time of day. Really, more so day of week is going to be more important than time of day. But yeah, I do it old school. I just, when I back test and track a trade, I always write the date in there, and I'll just go back and I'll go back and go through the columns one by one and just say, hey, here were the trades taken on Mondays. Here were the trades taken on Tuesdays, or usually hour per day if I'm doing day trader. But here are the trades taken on Mondays, Tuesdays, and then or hour per day, and then see what the differences are. And testing, well, here's the thing. He said he also has different pairs, and his filter shows what pairs are more profitable for testing. That's the easy part. When you're back testing, you should only be testing one pair at a time. You should only be testing one technique on one pair at a time. You shouldn't be testing cipher patterns on Aussie dollar, Euro dollar, New Zealand yen all at the same time. It should be one at a time. And once you complete that back testing, you should be opening up a completely separate spreadsheet for the next pair. Or at least tracking your data, having a separate spreadsheet where you write down the core facts you want to keep track of before testing that next pair. So you should be able to tell after each pair whether it's profitable or not, and then what the exact profitability was. And then as you get more backtesting data, be able to compare the results, the finished product, to the rest of the pairs that you're testing. All right, top down on New Zealand dollar. So I see we must have gapped here. It doesn't look right on New Zealand dollar, does it? I got my candles messed up, don't I? That doesn't look right. Hold on, my candles are backwards. It's got to be, right? Yeah. So I see this on New Zealand dollar. Top down on the daily chart, I see lower low, lower close. So I don't want to get long. I know that right away. I don't want to get long because we just broke and closed above under structure. So the only thing on my radar as far as my prediction is, how can I get short in anticipation that our next structure level down here is going to be hit? So I keep that mindset as I go down to the lower time frame. So we'll go down to my 240, which is my trading time frame, and I say, how can I get short? How can I get short New Zealand dollar? And again, we're just in consolidation here. How can I get short New Zealand dollar? And I really don't have a reason to. If I want to force something, I can do this. Well, we've seen both buying and selling pressure in this zone right here. I can take Fibonacci retracement, swing high to swing low. I've got a 3D2 and a 50% right in that zone. So I can say to myself, if price action gets in this zone, then I look for, say, double top to enter. I forgot who asked about Kiwi. Does that make sense though? That's what I would do on Kiwi. But the first thing, again, higher time frame tells me lower low, lower close, think short. If I want to get short, what do I need? I need a retracement. So I need the market to get long, and I need a retracement to get short here. I was contemplating trading the London session, but want to know if there was an easy way to find out successful time of day on patterns, because when I back test, I'm not trading only New York. Yeah, just go through the time of day that you should be tracking. Track the time of day that you take the pattern, and you just crunch the numbers. So if you're going to be a day trader, one of the things I recommend as a day trader is, do your testing on the time of day that you're going to be trading. So if you're going to be trading, if you're considering trading the London session, when you do your back testing, test out those hours during the London session. Test out those hours during the New York session. Aside from the pattern recognition, the RAS part of it, I wouldn't even test stuff in the Asia session, because if you know you're not going to trade it. But yeah, take the times that you have. Either create another page on the spreadsheet, or do it by hand, and start breaking them down, saying, hey, what did my trades look like from, I don't even know what time it would be London, 8 a.m. London to 9 a.m., and then 9 a.m. to 10 a.m., 10 a.m. to 11 a.m., and do it hour by hour, and see if there are any big differences in those gaps. Now, the one thing you don't want to do, you don't want to be a guy that says, well, I'm going to trade from 8 to 9, take off from 9 to 10, but then come back and trade 10 to 11. So you only want to look for major differences. Hence why I asked for an easy way to do it. Yeah, watch the videos. Again, I still recommend doing it by hand, but that's just me. Again, I'm a little old school. I like touching and feeling and really digging into the numbers myself. But again, like that's how my brain works. It's also why it takes me so long to backtest. But it's why I have so much faith in my system as well, because I do get in there and get dirty with the numbers. All right, we're about over an hour already. Anything else, guys, before we head out for today? Akil, if we do top-down analysis on what can we infer, what can the pound dollar daily tell us? Well, we recently had a higher high, higher close above here. So we're retracing. We're in an outside return right now. We're also in an overall bearish, well, we're in consolidation, actually. We did have a lower low, lower close right here. So we're not in a bullish trend. We're not in a bearish trend. We're in consolidation. If I had to, I don't know. Yeah, we're in consolidation. I don't know. I just don't know. Yeah. I would say I would expect, again, I would expect a retracement because of this higher high, higher close. I would expect a retracement somewhere at this level, at the 150 even handle. I would expect this would be our next resistance area where we come down to and do something like this. But I don't know. We have this wick right here, so we can turn around anywhere in this level. If I had to make a prediction, though, I'd say 150 even handle is the most likely level that we would hit, just based off this structure shelf. But I don't know whether the market's going to go up or down. We're just in consolidation. We've done this. We've done boom, boom. We've been trending for a while now, and then we come up, and then we can do a lower low, lower close, and now we got a higher high, higher close. So we're in nothing. Yep, we're in nothing. And this could be one of those trades where, you know what, you just do nothing on pound dollar, yeah. But I would assume we're going to see some resistance at this level. Just from the pure fact that we had structure here. If I just drag this box over, you'll see it. Just because we had structure here, we got structure here. I think it's, and you guys would agree with me, I think it's pretty safe to say we'll see some type of resistance at this level or some type of support at this level. That would be my guess. Some type of support just by what the past has told us. Now, does this mean that we're going to see a continuation all the way up here? I have no idea. Does this mean that we're not going to break right through it? I have no idea. Or get a little bounce here and then break all the way through it? I don't know. But I will be looking at this level for long opportunities. And that's all I can tell you guys. Yep. Yeah. But pay attention to this level, 150. Now, it's probably going to be very, very hard to shoot for targets because, again, I just don't know. We don't have a lot going in our way for this. Yeah, again, targets are going to be difficult because I certainly wouldn't expect a retracement all the way up here. I have no reason to expect that. So it's going to have to, you may just be able to bring a Fibonacci and I don't know. We may do something like this. We may just consolidate here and then break out and then look for up here. But yeah, it would be a counter trend type move. I'd be looking for small profits. Nothing real big there. But we'll see. Yeah, wick ruins everything. All right, guys, we're going to call it a day. I will see you guys in the live room tomorrow, where I'm sure we'll break down the pound dollar some more after we'll see today if there's any movement today. But until next time, guys, plan your trade your plan. Have a great rest of the day, and we'll get ready for some trading tomorrow. Take care. All right, traders, good morning. Welcome to, I guess it is the live room, but today's 12-week transformation Q&A session. Hope you guys had a great weekend. I was doing some random internet searching. I forgot what I was looking for in the first place, but I ended up looking at nicknames for different pairs. And I was wondering, does anyone know why the dollar yen is called the gopher? Have you heard of that before, Charles? Again, I don't know how I got down this path. The internet is a wild, wild thing. You enter one thing and then you end up somewhere else and you forget what you're looking for. I don't even know what I was looking for. But there's a pair called it's called the gopher. Then there's the guppy. I know we knew the euro dollar is the fiber, the pound dollar is the cable. You have the kiwi, the Aussie, the loonie is dollar cad. I never heard the gopher. I personally call pound yen the graveyard. But just thought anyway. I don't know. I couldn't find it. I stopped myself before getting too deep into finding an explanation for it. But I don't trust half the stuff I see on the internet anyway. But just thought I'd ask you guys. Anyway, welcome to another Q&A session. I got a few things I want to talk about today. I am going to talk about, and I'm going to try and link all these together. I'm going to talk a little bit about the Fibonacci tools, mainly the Fibonacci inversion tool and how to use that. I'm going to talk, Adam says, can you go over RSI and how to use it on double tops, double bottoms? Yep. And I want to talk a little bit about the butterfly pattern for Gabor asked a question about that. So let me just write this down and see if I can, this is the cool thing of doing this live, guys. See if I can link this together. So let's go double top / bottoms. We can link that to fibs. And then we can link that to the butterfly pattern, hopefully, and this all should work out. All right, so let's first talk about double tops and double bottoms. I'm going to go over to my ninja charts because, well, I'm trying to get better with TradingView, but I'm an old dog. I like ninja. I've got a I haven't even told the boys this yet, Charles. I got an interview I'm setting up with TradingView for May. You know, they said I'm popular, and yeah, they said I'm popular, and people like hearing me talk. So I said, hey, why not? I like hearing myself talk too. So let's do this. And of course, it's with TradingView, so I'm going to have to use TradingView. So I said, hey, I should probably learn how to use this platform a little better. Wouldn't want to go up there and Ninja and just ruin their whole thing. Hey, TradingView guys, I'm using NinjaTrader. But let's talk about double tops and double bottoms and how I use the RSI. So we all know what a double bottom looks like, right? The market comes down. We get a hold. We get a retracement. We get a retest. And then hopefully, if it goes our way, we get a reversal. So it's a pure counter trend trading technique. You're playing for the reversal in the market. Now, it doesn't necessarily, you can use a double top technique or double bottom technique into entering a trend continuation trade. But again, the actual technique is a counter trend trading technique, meaning that as the market is selling, you're buying. So you're buying into bearish pressure. And here's what I look for. Now, I have two settings on my RSI. I've got my extreme overbought and my oversold. So my RSI, my overbought is going to be at 80, and my oversold is going to be at 20. And those are the key levels. Again, I want to look for those extreme points. The default settings on your RSI are typically 70 and 30, I believe. But I like, and there's nothing wrong with using that. I like to look for those really extreme overbought and oversold conditions, and it helps cut out a lot of those false signals. I also use a 7-period RSI. Now, again, the default is a 14-period. I just want to have a quicker look at price action. Now, do be warned that the lower the period you use on your RSI, the more false signals you're going to get, or the more signals you're going to get, but also the more false signals you're going to get. The higher the setting you use in your RSI, the less signals you're going to get, and you should get less false signals, but you're also going to miss a few good opportunities. So it's a balancing act. I would test it out. Try a 5-period RSI, try a 7, try a 14, try a 10. If you want to tweak with that sort of stuff. If not, just keep it on a 7 because Akil uses a 7 and Jason uses a 7. Nothing wrong with that. But as we get a double bottom, I'm trying to finish coffee at the same time. The first thing I look for is the RSI to go oversold. This is important to me. So if this is my oversold mark right here, this red line down here, if that's my oversold mark, the first thing I need when I look for a double bottom is I need the RSI to at least touch that 20 level. So we got to come at least to that extreme oversold scenario, right? You guys with me so far? Give me a yes. Good, good, good. And again, technically to have a double top or a double bottom, you don't need the RSI. Doesn't matter. The RSI is just a tool. You can have plenty of double tops and double bottoms without the RSI being oversold or overbought. However, again, we talk a lot about adding filters. This is a filter that I use. I want to have that oversold or overboughtness. And yes, that is going to be a word. I want to have that oversold or overboughtness, again, to find the best opportunities. I'm not just looking for trading opportunities in the market. I'm looking for the best trading opportunities. And to get that confirmation that not only are we double bottoming, but we're at a place where the market has been oversold, that's just adding more to my case. Now, what I'm looking for on the retest, on the second test, obviously we cannot have a break and close below the low of our first test. That's going to be a new structure low. If we get a new structure low, that's going to be a trend continuation opportunity. Are you guys, is that part clear for you, the actual formation of a double top, double bottom, that we can't have that lower low, lower close? Okay. I know the question was about how to use the RSI with it, but I just want to make sure. Good. So what I'm looking for on the retest is something like this. Looking for the RSI to bounce as well. If the second test gives us divergence, that's going to be another sign. And when you get to the CTS, combined technical score, all these are going to be points that you add to your trade. And what I mean by divergence is this, that price action and your indicator, doesn't matter what indicator is, price action and your indicator are giving you two different things. So price action is giving you equal lows right here, this straight line, while your indicator, the RSI in this case, is giving you higher lows. And what this means is that the market came down to test the same area. The bears pushed it down into the same area. However, we're seeing less strength because the first time the RSI was down at 20. This time the RSI is at 25. This is called bullish divergence, And you can use bullish divergence just in general with analyzing the market, but it's very important for me to see that on the double bottom. I want to see that the market has tested the same area, but with less strength. So again, if you paint a picture in your head, I always think of it like sports, or think of it like a war. You know, one side, the bulls push down, or the bears push down with full strength. They try to push the bulls back, and the bulls hold that line. The bears, get a little bit of relief. They go back to their camp, whatever. They reload, they re-game plan, and then they make one more effort to push back again. However, they do so with less strength than before. So it's only a matter of time before the bulls break them down. Again, you can use sports, you can use whatever, a rugby scrum, whatever you want to make it in your head. I always like creating a story just to kind of visualize and see it. I just don't want to see the charts and the candles. I want to see the story that the market is telling me. I'm not crazy. It makes sense. Try it. Try it. Can it be hidden bullish divergence? Is it still valid? Well, it can't be hidden bullish divergence, because hidden bullish divergence will only come in a trend continuation opportunity. So hidden divergence, you're looking at the opposite side of the market. Hidden divergence, you'd be looking up here. So it wouldn't even come into, hidden divergence wouldn't even come into account with double tops and double bottoms. Hidden divergence only comes into account with trend continuation, and you're looking at tops and not bottoms in that case. Yep. So don't worry about hidden divergence. Is the angle of divergence any indication for likelihood of move in our direction. The steeper divergence, the better the probability. That's a good question. I can't say yes. I can't say yes because I haven't tested it. So I can't say, I don't have any stats to back it up. But I would say yes. The less strength, the better. So if you have a lot of divergence here on that same test, I would say, just off my experience in the market, that yes, that's a much better sign. However, I can't statistically tell you that those trades complete better than other trades. And again, I haven't tested that. And also, there's a lot more factors that come into account. You got to analyze, if you're going to back test it, you'd have to analyze, well, is it the fact that we hit major structure this time and minor structure the other time that made it do that? Or is it just the divergence? It's hard to pinpoint that it's just the divergence that made the difference, if that makes sense. But from just my eye test, I would say yes. The bigger the divergence, or the more the divergence, the better sign that we're going to see that reversal. But again, I just can't statistically prove it. Good. Yeah. Hey, look, I want to tell you guys the truth. I don't want to lie to you, right? I don't want to send you out there. Oh yeah, it does. And then you've got false, because you're going to believe everything I say. I don't want you giving false information, and one day it's wrong, and then I'm that guy. I'm that internet guy that lied to you. But I would say, yeah, you typically the bigger the divergence, the more I look at it as a better sign. It doesn't affect my trading, because divergence is divergence. Doesn't matter if it's by 1 point or 10 points. But my eyes will start to light up a little bit. Gretchen says sometimes divergence is distorted if the close on right above the low. Has anyone tried using lows instead of closes for RSI calculation? I have never done that. No, I've never used lows instead of closes. Where's my for RSI calculation? I don't think you can use lows. I think it's all in the close. I don't know if you can adjust it to lows, Gretchen. That may be why I've never done it. I think it because the RSI only prints after. Yeah, I don't think it can be lows, because then it'd have to take highs into account. It can only print on the close. That's the only thing it could be on. Yeah. Yeah, because it would have to take the highs into account too. Then yeah, so it's only the close. Now you can use anything for it. I don't think so. Well, I don't think you can calculate it on. If you can try it, I don't think you can calculate it on the lows, because then you'd have to find a way to calculate it for the highs too, unless you can. I don't know. Charles is typing in. Yeah, you can calculate on bar close. This doesn't. If this is what you're looking at, this doesn't mean the close of the candle. This just means calculated on the bar close. So meaning this, I typically have this to false. I don't know why this is up. I typically have it to false. That just means that this is going to wiggle around while price is in motion. So if we get a big bearish candle here, you see how it moves down. If we tick up, it'll move up. So it kind of gives you a sneak indication of where the RSI is going to be once the candle closes. But it has nothing to do with the actual close versus the low. So you said if you can on TradeStation, give it a try. I don't think that would be a benefit though, because again, I don't see how it would. The RSI doesn't necessarily measure. I don't think it means anything versus the lower. If you measured it off the low, you'd have to also measure it off the high. I don't think it would make sense that way. So my answer is no. I wouldn't even mess with that. It just doesn't make sense, because you'd have to somehow distort it, where in a bearish market you only measure the low, but if it's a bullish candle you only measure the high, and so yeah, I would just leave it alone and not worry about it. Don't break what's already good. All right, what other questions you guys have on RSI? No, this is what the live Q&A is about. We can afford to get off track. In the live room, we're worried about trading. This is the time to ask all the questions you have and have good discussions. Sometimes I learn something, I didn't know you even have that option. I've never used TradeStation, so yeah, that's fine. Any questions? Any other questions on the double bottom as far as RSI divergence goes? I just want to make sure I answered that question before going on to something else. No, I don't want to try TradeStation. I've already paid for my lifetime license for NinjaTrader. I'm locked in for life, which is actually a very good deal, guys. Instead of paying $600, what is it? I don't even know what it is now. It used to be $600 a year. You used to pay $1,000 for, I think, for life. Any other questions on double tops or double bottoms? Not really interested in answering trading questions right now. I'm not trading any day, but trading today, but or day trading today. But I want to do the educational topics. Is there a minimum? There we go. Is there a minimum number of bullish bars required for the pullback? There is not. I would say it can't be a 1-bar pullback. What you want to see is you want to see open space. So if I were to scroll back on here would be a good example. You want to see open space. So you can see we have boom, swing low to swing high, outside return, or outside return technically, and our double top right here. You can see the open space that exists in here. So there's no minimum or maximum numbers of bars. It's one of those things where you got to train your eyes to see it, but it can't be a 1-bar double top like this. This would not be a double top. Maybe if you go down to a range bar chart or a low time frame, it is, but this would not be a double top, this 1-bar deal, or even a 1-bar, a 1-bar pullback. So you want to see that. You want to see that open space. See if I can find any other examples. You can see open. This doesn't come up here, but open space right here. But there's no minimum bars. What happens if you get a big wick down in the middle? What happens if you get a big wick down in the middle of this double bottom pattern? So you're saying if the second retest gives us a wick all the way down here, but we close up here? Something like that. We close above, giving us a valid double top. Oh, in the middle up here. If we get something like this, but a big wick. Something like this, Gretchen? Down. Oh, well, if the wick comes down, this would be our double top then. Or this would be our double bottom right here. This would be our retest right here. Because again, all we need is the wick. The wick has to test the close. The wick has to test the close. So the wick of this candle would end up being our double bottom. Hold on one second, guys. All right, sorry about that. Crying baby alert. There we go. This should be that. You guys hear me okay? I know my screen went away. You hear me? Yes, can you guys hear me? Okay, good. Baby crying, had to make sure nothing happened. It's all good. But yeah, if we got a big wick, if we got something like this where the market came down like that and gave us a big wick all the way down here, well then it'd be an ugly one, but this would be our double bottom right here. Cool. Now, here's something I wanted to talk about. I want to talk a little bit about the Fibonacci inversion tools. I got a question through email on how to use the Fibonacci inversion tool, or I guess when to use the Fibonacci inversion tool. And I use the Fibonacci inversion tool when I don't have, essentially when I can't use a Fibonacci extension. And there's a good example right now on pound dollar. Pound dollar has actually got a few good trading opportunities on here, but there's a good example on pound dollar. At least there was. So we know that there's structure on pound dollar, right? We all let's go out to a higher time frame. Let me answer this one more question on double tops and double bottoms first. Then we'll go to our higher time frame. Okay. Jason says, Akil, you don't trade a double top or double bottom if the retracement hits a 382. Did I hear you say you also do not trade unless the retracement hits previous structure? If the retracement hits previous structure, I will not trade it. So if we have something like this, I have a few filters in. One is the 382. So if we have a double bottom that, let's just say the market is moving, we're doing this, we're doing that, we're doing this, we're doing that, and then boom, the market comes down here for a double bottom, right? Get in here. There are two filters I have for me not trading a double bottom, and I do this because again I am both a trend continuation, not your traditional trend continuation trader, but I take trend continuation type opportunities and counter trend trading opportunities. So I need to have certain filters. I have to have certain filters to keep to basically so I don't get double signals. Because here's what used to happen, right? We used to get a move like this, right? Boom, boom. What is this right here, guys? What do you guys see in front of you in this section? What type of trade does this look like? We got Jason saying trend continuation. We got double bottom. We got possibility. We got double bottom, bull trend. You see it right there. We got half the traders saying trend continuation, half the traders saying double bottom. And here's what used to happen. When I started off as a trend continuation trader, and I would do something like this. Market would retrace right back into structure, all the things we were taught. I would get short right here. Hey, how come I can't do my little thingy? Oh, wrong button. I would get short right here. And as a trend continuation trader, and this was a technique called the Fibonacci failure, what we would be doing is we'd be shooting for an extension, right? A continuation of the trend. Make sense, guys? Give me a yes. We'd be shooting for a continuation of the trend down here, right? So here's what happened. I would enter up here. And again, my stops would be above previous structure highs. So you'd have a nice risk reward. Risk was looking like this. Reward had to be down here, which made it very, very nice. It was a pretty good strategy, but here's the problem. I would enter right here. Market would come down, come down, come down, come down. Ah, making money, making money, making money. Boom, we get a hold right here. What do you think goes through your mind at this point? You get something like this, right? The market comes down, and we get something like this. What do you start thinking? Yeah, you start thinking, oh my God, reversal, reversal. This is a double bottom, right? There's RSI, there's RSI divergence. Akil, why am I short? Why am I short? And what do? You take profits off early, right? So you do something like this. You take profits off right here, and you can see you start really messing with that risk reward where you're no longer one-to-one on a regular basis. So what happened is I would get in a scenario where I'd be like, well, what do I do? Do I hold on to my trend continuation trade, or do I stop and reverse and trade this as a double bottom? Because I had both in my arsenal, and really it ended up being how I felt on the day, right? If CNBC was saying that we're going to see some dollar strength, then I would hold it as a trend continuation. If the internet, if every trading forum, if the Forex Pip Jedi was saying I'm getting long pound dollar, then I would get out of my position and trade it as a counter trend trade. I was being basically I had no rule for what I would take. It depended on how I felt that day, and it was all emotional, 100% emotional. And that's the problem with. That's why I say don't try to be both starting off. Be one or the other. Pip Yoda. There we go. Market bias. Be one or the other. Be a trend continuation trader or be a counter trend trader at first. It makes life a lot easier because you don't deal with these dilemmas. Here, buy market. Now, right. Oh, Yoda. Everyone loves Yoda. Little guy. Little green guy. My Yoda voice is horrible, but I'm halfway waking up. So what I did was I started adding filters. And because the Fibonacci failure trade setup that I traded required a 382 retracement, I said this. For my double bottoms, what I'm going to do is I'm going to take a Fibonacci retracement, measure it from my swing high to swing low. We know that a 382 is a sign for a heavy trend. If my double bottom comes to hit the 382, I will not trade it. Right? You guys follow me? If it hits a 382, I will not take this as the double bottom because I know there's that chance of that trend continuation happening. And the same thing goes for structure. If we come into previous structure, boom, that's not, I mean, say it's not a 382, but we still come into a previous structure level, say right here, well, we know that this is what? This is nothing more than an outside return. It's a good signal that we're going to go on for trend continuation. Because if I'm looking to take targets on this trade, right, it's a counter trend trading opportunity. I'm probably taking targets around this structure level, correct? If you guys had a double bottom down here, right? Am I correct in saying you would probably take targets at previous structure? Give me a yes if you agree with that. Because again, we're not trading for a full reversal. We're counter trend traders. We just want a little piece of the pie, the American pie. Yeah. So I added filters to keep me out of opportunities that I didn't think were the highest probability. Because if price action already comes up here, well, that's the move I expected. Now what I have to wait for that move to happen twice. That's going to significantly change my odds. So a lot of it stems from me being a counter trend or a trend continuation trader as well when I first started. So that's why I have filters for the 382 and also filters for hitting previous structure. I just much rather wait for a different opportunity. Now, blending that into Fibonacci inversion. Let's say we get a move like this. How do I want to do this here? We'll use the pound dollar. Right. So we all saw Jason's Forex market preview. What do we see right here, guys? What did pound dollar just do here in the 4 hour? What is this? Type it in for me. Come on, what is this over here? What did price action do? Right here. What is this? Look at my red line. Higher high, higher what? Higher high, higher what? There we go. Yeah, make sure you guys are awake. Higher high, higher close. We're expecting an outside return. Where would you expect an outside return to come to? Shoot me a level. Previous structure, right? We've got a nice DSR level right down here, previous structure. So if I'm a bullish trader, I'm looking for a buying opportunity right here. If you're a day trader today, you actually have one right here. But I'm looking for a buying opportunity right here. So let's go down to our hourly chart. And here's what happened, right? So we have the market, and this is going to be in the Fib inversion lesson. We have the market doing this, right? We can start even back here. We got swing low to swing high, outside return. Swing low to swing high. We don't really test it yet. We can measure this ebb and flow. Doesn't really make a difference, but boom, new structure high, outside return, new structure high, and then we're starting to move back right here. Now, let's ignore this right here but let's pretend we didn't see this retracement yet. How would you guys analyze the next potential buying opportunity? I know I'll start it off. We could put a red line here right on our DSR level. We can say, here's previous structure that we looked at on the 4-hour time frame. This is probably a good level to look for a buying opportunity, right? I feel like I should be recording this too. What else can we put in there, guys? Again, I want you guys to participate. If you're wrong, you're wrong. It doesn't matter. If you answer the question wrong, it's not a big deal. Harmonic. Well, we don't have a harmonic move yet. We can't measure out a harmonic move. We looked left or right. We got short. Yeah, fibs, or febs, as Gretchen says. Fibs, right? So a few places we can again ignore this. But a few places we can draw fibs on, right? A few places we can draw fibs on. We can draw what? A fib retracement, right? Fib retracement, we can go from our previous swing low right here, our outside return, swing low to swing high, fib retracement. And we can see that we get what? A 786 in there. So let's isolate that. A 786 is going to come around right in that 50, 60 level that one of you guys brought up. Boom. Right near that structure level. How about this? We can take a fib from our lower point right here, this swing low to this swing high. We're going to get what? A 618 right down there. Boom, 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 boom. We got a 618 in there. And can we take one more? I don't know. Where's our lows at? Let's take one more. I don't think I did this one earlier. I'm saying 382. You guys with me? 382? What do you guys think? Without cheating, you guys think 382? Just looking at it. You say yes? Jan says yes. Jason says 382. Let's go for it. Swing low to swing high. Bang. 382. Right on the nose. Let's take a quick break to tap ourselves on the back. Oh, I got my volume down. I want to hear it myself.
Hey, good job.
He's so good. You guys are so good too. Look at that. So 382 right on the nose. Now, stuff is easy. See, you guys can go impress your friends now. So we got a 382, a 786, a 618, and structure all at that level. Now, normally, what's the next move I would do with my fib, right? We use Fibonacci retracements. What's the other fib tool that we have? And again, I want you guys to type it in. I know it seems elementary, but I promise you it helps you retain it more. I promise you. Look how I was that guy. That was the annoying guy in the class when I did my training. That was me. And it turned out well after a while, right? So we want to use a fib extension, right? So we want to take our most recent swing high to swing low, but guess what? We don't have it, do we? Right? Again, we're imagining price action is right here, right? I don't know where my swing high to swing low is at, right? Because this move is still in progress. Am I right? We haven't completed this move. So I can't really measure it from here to here because I don't know if we're going to go down to here. This is when I use that fib inversion. When I can't use my fib extension tool traditionally because the move hasn't happened yet. We're using it in a counter trend type of way. What I do is I take the same Fibonacci extension tool and I draw it backwards. I say, well, here's our most recent move before that, our swing low to swing high. So what I'm going to do is I'm going to take my Fibonacci extension tool and I'm going to draw it on backwards. Swing high to swing low and back up. And I'm going to see what that gives me. And you can see if I thicken that up some, if I add on my 1414, thicken that up some, we've got a 1618 and a 1414 right in that level. That's how I use the Fibonacci inversion tool. Does that make sense? Nice. Essentially, again, you use it in counter trend type situations where the market's doing something like this. Boom. We're retracing down. You're expecting a move below here, but we can't draw any type of extension because we don't have any of this yet. So what you do is you take it from the previous legs. You take it from this swing high to this swing low backwards, and you can often use that to predict on where the market's going to extend to in a counter trend type of way. So predicting that we're going to break this previous structure level and then hopefully see some relief. Do that one more time. Sure. Trying to think if I want to use the same example or a different example. Yeah, this is one right here. So here's what I did. Hey, you missed the best part. With the Fibonacci inversion, here's what I do, Jason. I took, we're predicting a move down here, right? So we're predicting a break of our previous structure. Now we can, if you're a day trader, this can be an excellent trading opportunity. But we're predicting a break in structure. So I'm predicting a move that breaks our outside return. I'm predicting a break in the trend, right? Now, it's still going to be within the overall trend because this is where I'm predicting. But the most recent current trend, I'm predicting a break in that current trend. So I always do the same thing, right? I take my Fibonacci retracement tool. I draw out some retracements, boom, 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 different swing lows, different to swing highs. I get a 786, a 382, a 618. We're so good, right? Right at structure. And then I want to take a Fibonacci extension tool. When I'm looking at my chart and I'm saying, well, this move we're still on the down move. This downward move, this outside return is still in progress. So I can't really take a Fibonacci extension to it yet because I don't know if this is the end of the move, right? I don't want to do something like this, draw it on, and then come back, put orders down here, then come back and see that prices went straight down to here. Well, because now my Fibonacci extension tool is just in the middle of some random leg. Right? I'll have to just keep readjusting it. So what I do is I take the previous move. I take the previous swing low to swing high. This is the previous move in this trend. And I take my Fibonacci extension tool and draw it on backwards. I go from swing high back to this previous swing low and back up. And then I look for that Fibonacci confluence within that leg. And you can see we're going to get a 1618 right in that area. Follow me? I'm hoping the sound didn't go out for you, Jason. Oh, look at that. Nice. Yeah. So it's just a different way. And again, and if you go to where's it at? Jason has a great video on it. I'm sure there's a recorded, there's like 40 videos up. I'm sure there's a recorded video. We talked about this before. I'm sure there's a recorded private session somewhere on here. But if you go to Jason's YouTube page and you go to, go to Jason's YouTube page. Go to all my best stuff. If you go down to craziest trading I ever saw, who is this guy? Skip the ad, of course. Look at that kid getting sharp. But he has a video where he's using this same Fibonacci inversion technique to catch the overall trend. And it's the same thing we're doing here. Again, I try not to get into Elliott wave theory and all that stuff. Oh, thanks, Charles. I try not to get into Elliott wave theory and all that stuff, but the market does move in waves, right? The Elliott waves are legit. The problem is no one knows which wave is what. But if Elliott waves, we got something like this, right? Boom. Is anyone familiar with Elliott waves? Good. Elliott waves are essentially, it's waves that the market moves, where you're looking at, was it 5 wave cycles? You're looking at 1, 2, 3, 4, or 7 wave cycles. You're looking at 1, 2, 3. I don't know. I forgot the wave count, but you're looking at something like that, and then you're looking at a retracement, but within that retracement becomes an ABCD pattern, and then it goes on the start over. So basically, what it's saying is that inside moves like this, outside returns, they don't go straight down. They often ebb and flow and you'll get little waves, little mini waves, little ABCD patterns within there. Does that make sense to you guys? And you see it all the time. You may see an outside return on a higher time frame. You go down to a hourly chart, and you've got an ABCD pattern in there. Well, Fibonacci inversion, the perfect way to use this is when you get one of these waves where you're seeing a short-term pullback, but you know the overall trend is still bullish. And that's when you can start using that Fibonacci inversion from this leg to that leg and trying to predict where that short-term pullback is going to come into before the greater move takes over once again. Yeah, you can now use a true Fibonacci extension because we're getting that pullback, and it's going to be the same thing because it's equal length. We came down to the exact same area, but that's why I dotted it out, because originally when I saw it this morning, we didn't have that pullback yet. But now you can use the same Fibonacci extension. It's going to give you the same level because it's the same distance. Swing low to swing high, swing low to swing high. And again, this is actually a trading opportunity down here. If you get a double, if you guys are day traders, you get a double bottom right here. Yeah, you get a double bottom right here. I mean, that's a good trading opportunity for you. But let's talk about entry. For right here, Jason, or for this level down here? So this level down here, well, if you're going to enter down at 50, 60s, again, it's all going to depend on what type of trader you are. If you're a trend continuation trader, you're doing something like this. You're taking this last move. You're saying swing low to swing high. You're saying where is structure at the higher time frame. You're going Fibonacci extension, swing low to swing high. Back up here. You're most likely looking 127 extension, 1618 extension. 1618 comes right back into previous structure. So a trend continuation trader, you're looking something like this. Boom, boom, ABCD pattern, right back into 50, 153.31. Actually, it wouldn't be an ABCD pattern, it would be down here. But you're looking for that extension past this level. So you can potentially set yourself up with a risk reward like this. Risk looking all the way back up here in the previous structure. Boom. Stock below previous structure lows. So stocks below this level right here. Your safer level is going to be below this major DSR level. But you've got a minor structure level in here as well. So one of these two levels for your stop placement. And either way, you're going to get a good risk reward either way. Now, if you're not a true trend continuation trader, if you're not trading for that extension, well, then you're going to have to shorten this up significantly, meaning that your targets are only going to be up here. If your targets are only up there, and you know you need a one-to-one measured move, can I copy and paste this, please? Thank you. And you know you only need you at least need a one-to-one measured move. Bang. Then you're not going to have the option of taking this bigger stop loss. Your stop loss is going to have to be right at this structure level right here, just because this is going to give you an inverse risk reward. So it all depends on what type of trader you are and where you're looking for targets at. Actually, that looks like another 1618 up there. Yep. So those are your options. And again, a lot of it depends on what type of trader you are. If you're a true trend continuation trader, you're looking for much bigger targets than someone that's just playing for a retest of structure. And you got to have the guts to hold that trade. You got to have the guts to watch this trade go up here and then wiggle and retrace and then come back up and then consolidate into a flag pattern and possibly break up. You got to have the guts to ride that out. You can't be doing that early profit taking stuff, or you're going to end up with something like this, an average risk reward like that, cutting yourself short, and you're going to have to win a lot more than you're going to have to lose just to break even. So, but our stop placement technique could be different as well. Yeah. Your stop placement could be different depending on the entry technique. If you get something like this, and that's why there's so many, if you guys have ever noticed on social media, where, I hate answering questions about targets and stops because it really depends on the trader. If you're someone that takes, say, a less aggressive approach and you do something, you wait for something like that, market comes down, boom, we double bottom right here. Well, you take your ATR stop. Your ATR stop may be right here. Again, I have no idea what the ATR is going to be by the time you get here, but you may have something like this if you're more conservative. And of course, that can be up to wherever our 618 is. Yeah, so it's going to depend on your entry technique as well. How conservative and how aggressive are you? Isn't trading fun? Pound GDP is out tomorrow. Would that worry you about going into that trade today? No, would not. That is not on my list of news events I'm going to worry about. Now, it could be one day if I notice if I notice a consistent reaction. If I notice a consistent reaction, then it could be something that I add to my my watch list or my do not trade list. But I just haven't done that yet. Right now, the only things on my watch list are FOMC meeting minutes, ECB press conferences, and non-farm payrolls. Those are the only things that red flag me. And Aussie news that gives me concern. Aussie news at night or at my nighttime. Yeah, that mainly gives me concern just because the markets are so thin. That you see reaction just because no one's trading. That's the reason. Charles is just dumping big money into the market and moving it himself at that point. So let's talk about. I want to talk about butterfly last quickly. The question was. It was about butterfly patterns, constellation, and why doesn't constellation take in more patterns? Well, I would say this. The constellation is only mapped out to measure 4 patterns. It measures out Gartley's, bats, ciphers, and butterflies. The reason being is because those are the only 4. Those are the only 4 patterns that we trade here at Trade Empowered. There are crabs, there are sharks, there are 5-0s, there are probably a billion other patterns out there. We just don't teach it. So we're not going to have an indicator that measures something that we don't teach. I know personally, I can't speak for Jason. Personally, I'm not a fan of crabs or sharks. They're just there's too much gray area in those patterns. And until you find, like we did the Gartley, until you find the optimal way to trade them, I don't see the point. And, also, I mean, there's really no, why is there a need to trade 6, 7, 8 different patterns? If you have 4, if you have 2 patterns that are working well, to give yourself some diversification, if you have 2 patterns that are working well, you don't really need to trade 3. Do you need to trade 4? There's no need to trade every single thing you see in the market. You just put yourself at more risk of blowing an account. So that's one of the reasons Constellation doesn't measure it, mainly because we just don't teach it. Those just aren't patterns that we believe in as much as the ones that we do teach. We try to get the optimal portfolio of patterns. Now, the second one was about the butterfly. And I tell you this, guys, I tell you this in the training, guys, I trade the butterfly different than Jason. I trade the butterfly different than Constellation. And Constellation goes off of Jason's rules for the butterfly. I don't really trade butterfly patterns, but I teach them differently than Jason teaches them because, well, like a lot of patterns out there, aside from, I'd say, the bat and the cipher, there's a wide range of where that pattern can complete. There's a big range. It can complete all the way from the 127 of this to the 1618 of that, and you end up getting something that looks like this. You end up getting a butterfly pattern, and technically you end up getting a range that goes from right here to right there. So what I want to do is I want to narrow down that range. And if I'm going to take one, I'm only taking it at the highs of that range. I just don't want to. One thing I hate doing is I don't like putting myself into a trade, being stopped out of the trade, and then knowing that the trade was still correct. That's the worst for me. So if I'm going to trade a butterfly, and I rarely do, I'm going to trade it at the highest point of that range. And I think the last question he asked was about sometimes Constellation measures the butterfly pattern. Looks like it's below X, and in that case, it's not really below X, Gaber. It's just that what most likely happens is the B leg just hits a 786, and if the B leg just hits a 786, I'll measure this out for you. If we just hit a 786, like right on the nose, and we take a 127 from swing low to swing high, you're going to see that 127 is going to be right at that X leg. So that's why sometimes you'll see butterfly patterns that complete right at the X. It may look like it's below it, but technically it's right at it, or maybe like a tenth of a pip above it. Does that kind of help you out with the question you had? But technically it's above that. Technically that 127 is above that X leg. It just, again, if it hits it right on the nose, it's going to be right there. And that's actually not a bad, that actually wouldn't be a bad butterfly, because you could put stops really above the X leg and kind of cheat a little bit. But yeah, there's just no need to trade a million patterns. You know, you can if you want to, but you don't have to trade everything. Trade what makes you money. Again, Darren, both Darrens, Darren Oglesby here at Trading Powered, he traded only cipher patterns back when he was trading. He had about a 20 pair portfolio on the hourly and 4-hour time frames. All he did was trade cipher patterns. Only, no double tops, no double bottoms, no Gartleys, bats, nothing, just cipher patterns. Darren Butt, trader from the UK, very phenomenal trader. All he trades is bats and ciphers. I'm not sure how big his portfolio is, but he only trades those two patterns. He knows Gartleys, but he went through his back testing, he went through his portfolio, and I'm sure he's seen that ciphers and bats gave him the best profit at the end of things, based on the time he was trading, based on his portfolio and whatnot. So he said, hey, I want to give myself some freedom. I just want to keep it easy, keep it simple. Look for these two patterns, maximize them, and that's it. I backtested 85 ciphers on Aussie CAD 60 minute. It was 75% profitable. Ooh, man, that's nice. Well done. So yeah, some pairs are going to be more than others. It all depends on how they move. That's one of the reasons Aussie CAD made my portfolio list. Again, I don't like giving you guys backtesting data, but it was a pair that I found that is pretty nice with patterns. Pretty nice with patterns. Yeah. Aussie CAD we just ran up a bat pattern on Aussie CAD. What did we just have there? We just had like 3 back-to-backs on Aussie CAD. Speaking of it, now that you mention it, we just had, I believe, 3 ciphers. We just had we had this bat pattern, I believe. I'm not sure if we caught this. I think we did. We had that. We had this. And then we had this. Not bad. Not bad at all, right? Target 1s and target 2s hit on there. Not target 2s yet, almost target 2s. Well, yeah, if you're front running, target 2s might have been hit. Not a bad. Probably want to add this to your back testing portfolio. It's nice because it's an exotic pair too. You do want to have some exotic pairs in there too. You don't want to have just the majors. Have something to mix it up. And some of these exotic pairs work really, really nice with patterns. Some of them don't. Some of them are horrible. Some of them are horrible. Some of them work really, really nice. Just in general, the Canadian currency and the Australian currency are pretty high volume currencies in the Forex market. So you can get those two together, you're going to see a lot of opportunity. That's what you want to look for. Swiss pair. I don't think I trade any Swiss pairs anymore. I like the dollar Swiss is a good pair to trade. The problem is it's the exact opposite of the euro dollar. So there's no point of trading both. You're gonna literally find yourself, oh, bullish Gartley on euro dollar, bearish Gartley on dollar Swiss, because it's the exact same thing just flipped around. Vern says I'm having problems identifying XLEG. Why is that, Vern? Is it identifying the swing lows and swing highs? Are you able to identify impulse legs when scrolling up your charts? What do you think is the main? Is it just seeing it not popping out to you? What's the main issue here? I forgot we had back-to-backs on here. All of the above. Well, again, what you want to do, and I think we talked about this in last week's video. You want to take a chart. You just got to train that brain. Take a chart. I like to scrunch it up all the way and just look for those swing high to swing lows. Look for those moves that stand out. Swing high to swing low. Bang. Swing high to swing low. Boom. Scroll up that chart and just identify them. Draw them out. Boom. Draw out those swing high to swing lows, those outside returns. New structure low. Outside return. New structure low. Outside return. Draw out those ebbs and flows. You just got to train your mind. You got to train your mind to see this stuff. Yeah. It's not always easy. Just go out to daily charts again. Scrunch them up. Just draw them out. And you practice this enough, they'll get easier and easier to identify. I find it helps if you draw horizontal lines and move. Yeah, draw lines like that. Just identifying support and resistance. But it just takes a lot of practice for your eyes to catch them. And again, and last week I think we talked about using what, the swing indicator for a help. There was another indicator on here that I must have deleted it when I changed computers. I wonder if it was let's see if I have here. I must have. That was a pivot point something. I wonder where I got it from. Yeah, I must have deleted it. But yeah, bring on the swing indicator. That helps too. If you bring on the swing indicator, every platform should have it. And just use that. You can use that to help with visual identification, and just look for the swing high to swing lows, green to gold, green to gold, green to gold. That's going to help identify those swings. And again, you'll have to play with the setting to get it to the right way. 13, try 9, try 7. I don't personally use it. I don't know the maximum setting, but you can see those swing high to swing lows right there. The zigzag helps too. I certainly don't know how to adjust the settings on the zigzag. I know I think I do 0.05, so 0.02 points. Let's try that. You'll have to play around with the settings, but zigzag indicator 2 will help draw out those swing low to swing highs. I don't know what the settings are for zigzag. Seems like really. Yeah, it's play around with it. You see the blue lines on there. It'll draw out swing highs and swing lows. You'll have to mess with the settings to find out to get that smaller level, but it's really just training your eyes. Oh, you got to practice it. It's like riding a bike. Just do it over and over again until it starts to make sense. And then once it clicks, those things are going to pop out to you. Anything else, guys? Any more questions before we shut down shop for today? Confirmation bias. I'm confusing myself way too much doing top-down analysis. What specific point are you confusing yourself with? Where is it, at what point is it getting kind of cloudy and gray and lost for you? If I should be looking for bullish or bearish opportunities, okay. Well, it's a quick look through the IPDE. You find a chart, you say something like, let's go back to the pound dollar, it's one we already used. You look at the pound dollar and you identify what has price action done. Identify. What has price action done? In this scenario, we have a higher high, higher close, right? Higher high, higher close means that we should be thinking bullish. So for this particular chart, all you're thinking is bullish, right? So immediately right now, you eliminated any bearish trades out of your mind, right? You cut your analysis in half. There's no bearish trades should be in your mind. It's all bullish. So the next thing is predict. Where is the market likely to go? And you do your analysis, you look at structure, you say, well, there's previous structure up here, so the market can go up here. Or the market could retest back in the structure here. So you make your prediction. Then you decide what you want to do. If you're thinking bullish, well, you know the only way you can get involved in a bullish trade is waiting for an outside return, waiting for a pullback, and looking to hop on that trend. Right? And if you're a bearish trader, if you're a counter trend, and all you're doing is waiting for this, you're saying this is the only chance I have to get bearish. So you already know you've done your identify, predict. You know what you want to do. So it should be easy right now. You want to get long. This is the area where you can get long. Then you go down to your lower time frame. You do all the fancy Fibonacci analysis that we did. And you decide, well, you do your prediction and you find out your kill zone. You decide at that point, well, what technique am I going to use to get long? Is it going to be a double bottom? Is it going to be a higher high, higher close? Is it going to be a 26.18? What technique am I allowed to use to get long? And you just simplified the analysis. But it all starts with that higher time frame. Identify, predict. That's going to tell you what side of the market you want to be on. Once you've determined what side you want to be on, just eliminate all other opportunities from your head. Why would you look to get bearish? Right? There should be no thoughts, oh, Keel, double top right here. Well, no, my higher time frame analysis told me that we're bullish, higher high, higher close. I don't care about a double top, right? I can care less about a double top here because I'm only looking to get bullish. Make sense? Simplify, yeah, simplify it. Identify, predict. That's the first half. Identify, predict. Determine what sides you want to be on. Now, what may be the problem is when you go to the day trading time frames, you may get a different story. If you go down to the 15 and the 5-minute chart, you may get a bullish entry, but you got to keep in mind, day trading and swing trading are two completely different beasts. Your swing trading should not affect your day trading. The daily chart, aside from being at a major structure level, should have no effect on what you see on the 5-minute chart. No effect at all. They're two completely different beasts. So don't let your daily time frame analysis affect your 5-minute time frame. And that's where a lot of people get into trouble. They try to do both. They try to day trade and swing trade, and they don't separate that analysis. So I would start with one first. You can get a double top though, and then trade that. Nope. Well, you could, but I don't think it would be a smart trade. Why would you trade a double top with price action above previous structure? Why would you trade a double top here when all the analysis is telling you that we're in a bullish trend? I think you're just setting yourself up for disaster. Right? I got a higher high, higher close above structure, right? We should see this. So why would I want to get short here? Is it worth the risk? Not in my opinion. Now, you could trade it. I just don't think it's a high probability trade. Right? Why would you want to get short here? Why does this double top have any importance? Because the RSI is overbought? Because there's diversions? Is that more important than having a higher high, higher close above structure? Not in my opinion. So I wouldn't even entertain it. Now, if anything, if you get a 26.18, that's a different story because now you've seen that the market has held, broken below, violated structure, and now is retesting. Still a little risky in this scenario because we got structure all over the place. But that would be a better way to get involved than just trading a double top here. Because this is setting up like a pure trend continuation. I bet we just hit a 382 up here. Aren't the best double tops at the top of the trend? Yeah, but here's the thing, Jason. We're not at the top of the trend. We have broken and closed above structure. Look, if this double top happened right at structure, yeah, this would be a heck of a good double top. We're not at the top of a trend though. We're above the trend. Higher, look at this. Higher high, higher close. Yeah. I don't want to trade it here. No way. If we didn't get the higher high, higher close, yeah, this would be a heck of a double top move. In fact, we were watching for that in the live room. But once we get that higher high, higher close, our mind should go straight to trend continuation, trend continuation, trend continuation. The break and close above structure is very important. Yep, yeah, that's why you got to do your top-down analysis. You got to identify and predict. You can't look for the trade out. You can't look for the trading opportunity first and then go backwards. You can't be like, oh, double top, let's trade it. No. Figure out what side of the market you want to be on first, then look for it. Go through the process. Identify, predict, decide, and then execute. Go through the process in that order. So that's it for today, guys. I think this was a very, very valuable live Q&A. You guys brought questions. See, it works well when you guys have questions. I got some good ones. So I will see you in the live room tomorrow. There's going to be no live room on Friday. I'll remind you guys during the week, no live room on Friday. I've got to travel again. Hopefully it's going to be one of the last travels for at least a month or so. I got to go out to Michigan later in May, but we'll see. Until then, plan your trade your plan. I will see you guys tomorrow in the live room, and best of luck trading the markets this week. Take care.